Happy morning, happy afternoon, and happy evening to all my Nanbas and Nanbis. Today I am gonna give you the marathon for auditing and ethics, and all the students who are writing the exams in September 2025 or Jan 2026 onwards, guys. From that time, you guys can watch this marathon. This is a newly recorded marathon. In fact, half was over, so I thought let's not waste much of time. I will give it to you, and I'm recording the second part as well, which is going to cover all the remaining topics which is not there here. Now, before I get into what are the topics which is covered into this marathon, I have a lot of things to tell you about what other things are coming from my side, who can use this marathon, who should not be using, and what is the duration of this marathon. Everything I will be telling you in this introduction video itself. Now, for me, I have a plan, guys, for you all, for students who are writing September 2025 onwards. I have recorded the part 1 of the marathon. I will be telling you what are the topics covered. Part 2, definitely you can expect from my side for this attempt itself. And I'm also planning a workout marathon. The workout marathon is going to consist of two things. One is for question practice and the other one is for MCQ practice. I will just show you the book as to what I am referring right now. The material that I'm using is my new material, new concept book that I have just done. If you see in this, in every chapter, guys, there will be a mind mapping, and then we will flow through the chapter. Any chapter you take, basics before essay 210, and then for essay 210 there will again be a mind mapping, and then we will go through that standard. That is how I have done in this marathon also. I have used this material. Please wait, I will tell you where to find this material. This material I've actually spent lot of time and effort doing this, only for the reason that one thing, I wanted to give this mind mapping so that you understand what you are studying, and the most important thing is giving the keywords, guys. In every standard you can see that the keywords are given in red, and if something as example is coming, that will be in gray, and apart from that no other color is used, no other confusion. So if something is in red or gray, you know that it is important, and obviously if something is in dabba, you already know that it is important. I told you I'll also be doing a marathon for workout, so this is the workout book which I have done. I'll just quickly tell you what is covered in this. 8 model test papers, 4 RTPs including the latest RTP and mock test paper, and 4 previous exam papers. So this is basically ICA level questions which is taken, and here also it is fully color. The keywords are given in red. Coming to the MCQ book, this is the MCQ book which is being done, and here for each of the chapters I've given chapter wise MCQ. Now this is ChatGPT based MCQs, and if you come down you can see the case study based MCQ as well. There are about 35 case study based MCQs. I will show that as well once all the chapters are done. Then the case study based MCQ starts. So there are 35 case study based MCQs. This is again from previous RTP, MTP and all, but for these MCQs I have used ChatGPT because ICA also uses AI only for making the MCQs, guys. That is the reason. Now coming back to who can watch this marathon and what are the materials to refer, I have told who can watch the marathon. Now, people who have attempted previously, or people who have attempted some other class, or people who have attempted my class, they can watch the marathon. If you are seeing audit for the very first time, if you are reading audit for the very first time, please don't see this marathon. Or if you have done the self study and then you are coming here, then yes, please use this for revision purposes. I am sure if you use this for revision purpose, you can get 60 plus 70 plus in your main examination. Yes, guys, it is possible. I have the confidence. I want you to have the confidence as well. Auditing is not a difficult subject. Please don't trust anybody who is telling you that auditing is a difficult subject. With proper level of efforts, 60 plus 70 plus is definitely possible in this subject also. Now, in case if you want to know about the full class, what part of the class are you actually giving as marathon, ma'am? The regular class is actually for 110 hours. The WOW Pro is for 50 hours. And this marathon, that is the part 1, part 2 and the workout together, approximately will be about 25 hours. For people who are studying for the first time, I'm showing the regular class as well for you guys. If you go to the CA Classroom website, there is WOW Pro which is given here. For individual individual subject also Wow Pro has been released just for 30 days. You can get the entire Wow Pro auditing for just very very affordable prices, guys. 1,999, and if you want auditing plus SM extra 500 only, you're going to pay 2,499. But this validity is for 30 days for people who are writing in September 2025. This is the perfect course for you in case you want to study from scratch. If you watch this entirely, this combo basically, guys, I'm telling you, it has regular and it has the Wow lectures. So you can start watching auditing regular. SM, obviously you can watch the Wow lectures, that itself is more than sufficient. But yes, auditing you can start watching the regular lectures, and for whichever lecture is completed, you can come to the marathon and use this for revision purposes. That is the right way to study, guys. Now coming to what are the topics which is covered in this marathon, part 1 of the marathon. 200, 210, 700 series mandatory, you have to watch in this order only. 500, 501, 570, 560, you can mix and match however you want. 220 SQC1, these are standards which people usually leave out. I don't want you to leave it out, that's why I've given here. And most importantly, SA 315 is a standard where people think that it is difficult. I want to show you guys that it is actually not difficult. 75% of SA 315, that is part 1, actually 80% of SA 315 is given in this part 1 itself. The remaining 20% I have split it in the next part, only for the reason that I don't want you to think that SA 315 is difficult. That is the reason why I have given this. All these standards are given here, guys. You can probably take a screenshot or something so that you know that part 1 covers all these standards, and whenever you're studying these standards, you can come to this marathon and you can listen to any standard that you want, guys. That's it. So yes, let's get into the lectures, and I hope you will enjoy the subject auditing, guys. I asked you a question. What is audit? Have you ever done audit in your life? Have you ever done audit in your life? Now you will all say, yes, you have done audit, because audit is not only just the audit which you do in your articles, it's also the bill that you take and you will be auditing everything. You will be seeing if everything is correct or not which is given in the bill. That is also a type of audit only. Other examples, you go for car test drive, you will be saying how the car's engine is, what is the mileage of the car, how is the seat, you will be verifying, you will be asking your friends, you will be doing external confirmation, you will be doing all of those things. That is also audit only. Not only financial audit is audit. One more example, a chef is being recruited. What are the things that you will be seeing? You will be seeing her cleanliness, hygiene, whether she is wearing a hat, what is the cuisine that she is expertise in. You will be asking all of those things. Then you will ask other places where she has worked previously. Then if possible, you will go to that place and ask, how is this person? Why did she quit her job? You will be asking all of those questions. All of that is also audit only. For financial audit purposes, our example was Daimler AG, where Daimler AG purchased a plant and machinery. What is the first step for this as an accountant? What is the first step for this? First there will be a invoice or a purchase order or something, then this will get translated to a journal entry, that will get translated to a ledger, this will get translated to a trial balance, that will get translated to P&L, P&L it will go to balance sheet, and this profit and loss and balance sheet together, it is called as financial statements. This financial statements will be prepared by management. It will be prepared by the management and it will be given to the auditor. The auditor has to take this financial statements and he will be giving something called as opinion. This opinion is going to say whether the financial statements are correct or incorrect. That is the terminology that we will be using for now, that the opinion will be correct or incorrect. In the later stage we saw that it will be unmodified or modified opinion. Is that clear? For now let's keep this as correct or incorrect itself. Now why should the auditor be extremely careful when he is giving his opinion? Why should he be careful? For this I gave you an example There are lots of movie reviewers. Yes? Favorite movie reviewer, blue satay. For Indian to movie, what will he say? Movie is super, 100 out of 100 I am giving for this movie. But when you went to the theater and when you saw the movie, how was the movie? It was below average. Not even 40 marks you will be giving, 30 out of 100 you will be giving for this movie. Will you get very angry? In interval itself you will go and you will message him, you will comment on his video. Asing you are going to comment on his video. So for a reviewer itself, for 120 rupees, if he has to be so careful, for an auditor there are so many people who are going to rely on his signature, so he has to be doubly careful. Who are those people? What are they called? They are called as stakeholders. They will be relying on the audit report which is given by the auditor. Who are these stakeholders? Shareholders, because shareholders are the owners of the company who are not involved in the day-to-day operations, so they will be wanting to know whether the financial statements are correct or incorrect. Shareholders, other than them, investors. Investors are prospective investors, whether I can invest in this company or not, they will want to know. Creditors, I have made sales to this company, I want to know whether they will pay that money back to me or not. I will see whether the financial statements are good or bad. The employees, whether I have security for my job, they will see the audit report. Bankers and other lenders, whether I can give the money to them, whether they will be able to repay the money back to me. All of these people together, collectively, they are called as stakeholders. Is that clear? Next, we went to this concept called as independence. The auditor has to be independent, because if a mother or father is going to be appointed as the auditor for your company, we saw Shwetalaya Silks, yes, Shweta wanted to have a silk store. So Shwetalaya Silks, if her mother comes and gets appointed as auditor, how will she be putting the signature? If revenue is 10 lakhs, she will always give extra. So she is going to add extra 2 zeros. So mother, father, brother, sister, mother-in-law, father-in-law, all of those people cannot be appointed as auditor, and the auditor has to be independent only. Is that clear, guys? Yes. Now 90 percentage creditor, can he be appointed as auditor? Can he be appointed as auditor? No, because he is also interested in the affairs of the company, so he also cannot be appointed as the auditor. Now going to our book, the mind mapping talks about what is audit, responsibility of management, interdisciplinary nature, and then we go to essay 200. Under that, objectives, analysis of objectives, scope, what and all it includes, what it excludes, what are the benefits of audits, and if advantages are there, disadvantages will always be there, limitations of audit, and requirement, whether it is mandatory or voluntary, and appointment, who is going to appoint and to whom you are going to give the report. What is audit? Audit is an independent examination of financial information. Wait, here they are using the terminology financial information and not financial statements. Financial statements means it is just this profit and loss and balance sheet. Financial information means all of these things together constitute the financial information. So we have to be extremely careful with the terminology. An audit is an independent examination of financial information of any entity. That means whether it is profit making, whether it is loss making, whether it is a big company or a small company, an audit can be carried for that, irrespective of its size, irrespective of legal form. When such an examination is conducted for what? With a view to expressing an opinion thereon. That means the intention of the auditor should be to express the opinion. That only is called as audit. In doing so, he has to see that financial statements will not mislead anybody. For that, he has to ensure 6 things. What are the 6 things? he will be seeing whether reference is given in the books of accounts. He will see that everything which is there is translated to the books of accounts. That means nothing is omitted in the process, and whatever is given is both clear and unambiguous. For that, what example did I tell you? Clear and unambiguous. What example? I told you, for balance sheet, debtors is given as 1 lakh, provision for bad debts is given as 99,000. This is one way of presenting, and debtors is given as 1 lakh, bad debts provision is shown as 99,000, and net debtors is shown as 1,000. Which is the right way? The second one is right, because this is more clearer. This is the actual amount I will be receiving from my debtors. It should be both clear and unambiguous. The financial statement should be properly classified, described, and all notes to accounts also is part of financial statements only. So it should be disclosed in conformity with accounting standards. And finally, the statement should present a true and fair view. Responsibility of the management, what is it? Preparation and presentation of financial statements. What is the responsibility of the auditor? To express his opinion. Interdisciplinary nature of auditing. As an auditor, not only audit, but we also need to have knowledge of all the other subjects. For this, how you are going to remember is, what are your foundation subjects? What is it? Accounting, law, economics, and maths. Wait here. For accounting, the keyword which you will remember is auditing reviews the financial statements, which is nothing but a result of overall accounting process. Overall accounting process is the keyword that you will remember. For law, you will remember business laws affecting the entity. For economics, the economic environment of the client you are supposed to know. For this, I told you, when you go for audit, they can ask any question to you, and as an auditor, you are expected to know. They can ask about stock market, they can ask about politics, they can ask about TVK, they can ask about literally anything to you, and as an auditor, you must have a response to that. For economics, it is economic environment, and for statistics and mathematics, it is statistical sampling and meaningful conclusions, and mathematics for verification of inventory. Now, we are in group 1 or group 2? We are in group 2. Apart from auditing, what are the subjects in group 2? Costing, that is only production, where you will be talking about cost system, production, marketing, etc. What other subjects are there? FM, what are the chapter names? You please see: ratio analysis, capital budgeting, fund flow, and financial techniques. And SM, in SM you will be seeing information systems, how they will be doing the audit, that is data processing, where EDP auditing in itself is developed as a discipline in itself. But after all of this, as an auditor, no, as a normal human being also, you need to know behavioral science, because when you are talking to people, you develop some kind of relationships, how they are telling the answers. You have to know that. If you ask something to client and if he starts sweating, you need to know that something is wrong there. So behavioral science is also important. Knowledge of human behavior is essential for an auditor to effectively discharge his duties. For interdisciplinary nature of auditing, how many did we see? 8 points are there. 4 foundation subjects, 3 other group 2 subjects, and 1 extra behavioral science is there. After this essay 200, what is the name of the standard? Overall objectives of an independent auditor and the conduct of audit in accordance with standards on auditing. Under this, objectives 2 are there: to obtain reasonable assurance. What is the meaning of reasonable assurance? That means it is a high level of assurance, but is it 100% assurance? No, something less than 100%. It can be 99.99999%. This is reasonable assurance about whether financial statements as a whole are free from material misstatement. What is misstatement? Misstatement means mistake. Material means important. Important mistake, whether due to Fraud or error. What is the meaning of fraud? What is the meaning of error? What example did we see? Example. Roshan went with his girlfriend to the beach. When group of guys Eve teased the girlfriend, he got angry and he hit them. When he hit, what happened? One guy mar gaya. Another day with same girlfriend, he was talking with her on call and he was going. He went and dashed one pavam tata who was walking on the road. And when he dashed the tata, mar gaya. When the tata mar gaya, it is called as error. And here when he bashed this guy and this guy passed away, that is fraud. Here intention is the matter. When a friend gets money from you, he knows that he is going to repay it to you, but still he got the money, but later stages he forgot. That is an error. A friend gets money from you. When he is getting the money itself, he doesn't have any intention to repay it back to you. That is fraud. So the intention is the matter here. So coming back to our text, to obtain reasonable assurance about whether financial statements as a whole are free from important mistakes, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether financial statements are prepared in accordance with applicable financial reporting framework. Basically, what we are seeing is whether the financial statements is as per AFRF. That is the objective of the auditor. Now, what is this AFRF? AFRF is a framework adopted in the preparation and in the presentation of the financial statements that is acceptable in the view of nature of entity and the objective of financial statements, or that is required by law or regulation. For example, Schedule 3, accounting standards. All the financial statements has to be prepared as per accounting standards. The financial statements has to follow Schedule 3 framework. That is the AFRF, Applicable Financial Reporting Framework. As an auditor, we will be seeing whether the financial statements which is prepared and presented by the management is as per AFRF or not. The second point is to report on the financial statements and to communicate as required by standards on auditing. In the first point they spoke about accounting standards. In the second point they are talking about standards on auditing, because essays are basically as an auditor how we have to communicate. As an auditor, how should our report be? As an auditor, what are the audit procedures that we have to do? As an auditor, what are the audit evidence that we have to get? Like that they are giving so many things. So we will be reporting as per standards on auditing. Accounting standards, what will be seeing? That the financial statement which is prepared and presented by the management, whether it is following all the accounting standards. That is the AFRF. As an auditor, we will have to just see that. Is that clear? Are you getting a better understanding? Yes? Analysis of the objectives, just 4 points here. The first one is talking about reasonable assurance. Reasonable assurance and absolute assurance. What is the difference? Absolute assurance means 100% assurance. Reasonable assurance means something less than 100% assurance. Now, reasonable assurance is to be distinguished from absolute assurance. It is a complete assurance. It is a guarantee that financial statements are free from material misstatement. Wherever you see guarantee, you will first say that this is not audit. Because audit cannot be a guarantee, it cannot be 100% assurance. It will always be something less than 100%, that is reasonable assurance. Audit is carried out by the auditor with professional competence and skills in accordance with standards on auditing. Audit procedures are applied in accordance with essays. Audit evidence is obtained and evaluated. On basis of that, the conclusions are drawn. The second point is talking about the misstatement. Misstatement only are of two types, where intention will decide what is the type. It can be fraud, it can be error, or it can be both also. Misstatements in financial statement can be due to fraud or error or both. The auditor seeks to obtain reasonable assurance about whether the financial statements as a whole are free from important mistakes which is either caused due to fraud or error. He must see the effect of the misstatement on the financial statements as a whole in totality. What is the third point? Obtaining reasonable assurance that financial statements as a whole are free from material misstatement enables the auditor to give his opinion. Now, this opinion is going to say whether the financial statements are prepared as per AFRF only. This opinion should be as per what? As per standards on auditing. That is the next point. This opinion which is reported and communicated must be as per the standards on auditing. Now, if they ask objectives for 2 marks or 3 marks, you will just be writing these 2 points. If they ask for 6 marks, you will be writing along with analysis of objectives. Is that clear? Now, important terminology called historical financial statements, because an audit is a post-mortem process. That means something has already happened, and as an auditor we will be doing the audit on the history which has already happened. Historical financial information means any information which is expressed in financial terms of a particular entity derived primarily from that entity's accounting system about economic events which has occurred in the past time period, or about economic condition or circumstances at points in time from the past. For example, any purchase you take, sales you take, expenses you take, rental expense you take, expense has already happened. After that, as an auditor, we will be seeing whether it is as per AFRF, whether it has been happened in the financial statements. You will be checking for that. What is AFRF for companies in India? Accounting Standard Schedule 3. Scope of audit. What it includes, what it does not include. It includes coverage of all aspects. First itself I told you, we will be giving our opinion for financial statements as a whole. So it covers all the aspects: reliability and sufficiency of financial information. Even the disclosure of financial information is also financial statement, so that also will be there. And finally, you will be expressing an opinion on the financial statements. It does not include, this is the important part, preparation and presentation of the financial statements is a duty of the management. So the first scope it does not include is preparation and presentation of financial statements. Duties outside the scope of competence, that means physical condition of asset, suitability, life of civil structure. As an auditor, we don't know what is the life of civil structure and all. There will be a separate engineer, there will be a separate expert for that work, so that is outside our scope. Authentication of document. If they give an invoice and ask the auditor to sign, that cannot be your work. You will not be signing the invoice and all, you will be signing only the audit report. So authentication of documents, we will not be doing that. To find the genuineness, it is not our job. And finally, investigation, which is absolute assurance, 100% assurance, that is also outside the scope of audit. Is that clear? The mind mapping we saw, first Roman number, objectives of audit. What is objectives? To obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether due to fraud or error, whereby enabling the auditor to express an opinion thereon. The second point, to report and to communicate as per standards on auditing. Is that clear, guys? The second one is scope, what it includes, what it excludes, what and all it includes. It includes all information, coverage of all aspects, sufficiency and reliability of information. Next, disclosures, proper disclosures, and finally, to give an opinion. What it excludes, 4 points are there. Preparation and presentation of financial statements, it excludes from the scope of audit. Second, whatever is outside the scope of audit, that is, example, civil structures, what is the physical condition, what is the life of that structure, all of that is excluded. Then genuineness, authentication of document, that is not our duty, somebody else will do that. And finally, investigation, because that is 100% assurance, and audit is always only reasonable assurance. Next, what are the benefits of audit? For benefits of audit, you have to remember all the stakeholders. Who are the stakeholders? The shareholders. That is the first point. In case of companies, the shareholders may or may not be involved in the day-to-day affairs of the company. So
they will be seeing the audited financial statements. That is the benefit of audit. Employees, you all told, they are the stakeholders. They also gets benefited because they will know how their job is secured or not. Audited financial statements help the government authorities because whatever profit you are saying, that profit only you will be paying the taxes. So the government wants to know whether this is the right profit and you are paying the right taxes. So they want the audited financial statement. That is the benefit for government authorities. Lenders and bankers, these people are the people who will be giving the money. Whether you will be able to repay back the money, how they will know? By seeing the financial statements. Whether the financial health of the company is good or bad, they will have an idea with the signed financial statements. That is the audit report. And audit will also detect fraud or error or both. And audit reviews the existing operation and internal controls which is operating in an entity. Hence it is useful at pointing out the deficiencies which is there in the internal control. This gives the confidence to the users. How many points are there? 7 points are there. The first point is it gives the confidence to the users of the financial statements. Next few points are who are the users of the financial statements? Shareholders, government, bankers, employees. 4 points are done. Confidence to users, 5 points are done. After the 2 points, this audit will be helpful for detecting the fraud or error or both. And finally, the last point, reviews existence and operations of internal control. What is internal control? What is internal control? Internal controls are controls which is made by the management for the management. Like this, if you write, you will not get the marks. Internal control has a specific definition. For now, for your understanding, internal controls are rules which is framed by the management for the management. Example we saw PVR. You will not forget that. Example is PVR. When PVR has one person outside the theater to check whether all the people who are entering have purchased the ticket or not. Who was the example? Chitappa? Chitappa was the example for this, correct? Harish was the example. Harish with his girlfriend, when he went, what he did? He got only one ticket in theater. This is the screen, he got this ticket, only single ticket he got, and he sent that girlfriend first inside. She went and sat and he just entered the cinema theater. He told that people are there inside. Will that person outside check? No. So two people have entered with just one ticket. That shows that the internal controls of PVR is not operating properly. So internal control are basically the rules which is framed by PVR only, for PVR only. So it is framed by the management for the management. Is that clear, guys? Now, audit also helps for existence and operations of the internal control. One of the benefit of audit. If advantages are there, disadvantages will always be there. Limitations of audit. The first one is nature of financial reporting. Why is this a limitation? Because financial reporting means what? Financial reporting means what? Financial reporting means accounting. It is your first paper in final, I told you. In final, paper number 1 is financial reporting, which is nothing but your accounting paper. So the nature of accounting itself is a limitation for audit, because your accounting has a lot of judgments to be made. Your provision for bad and doubtful debts, you will say it is 99,000. Is it really 99,000? How will we know? Based on your judgment, you are saying this value will not come, so I am creating a provision called as bad and doubtful debts. Tomorrow itself, he might become a good person and he will pay that money back. So what you told yesterday, is it false? No, it is your judgment. So the nature of accounting itself becomes a limitation for audit, because it involves judgment by the management, and this involves subjective decisions or a degree of uncertainty by the management. Nature of audit procedures. The audit procedures, there are two limitations: practical and legal limitation. What is the practical limitation? It is impossible for the auditor to do the audit for all the items which is there in the population. So what is he going to do? On sampling basis, he is going to pick a few items and he'll do the audit procedures on that, and based on his testing he will extrapolate it for the entire population. Isn't that what he will be doing? But in case if he picks a wrong sample, then isn't that a limitation? So under nature of audit procedure, the practical limitation is that he will form his opinion only by testing the sample. What is the legal limitation? If the management wants to hide something from you, they can easily hide it from you. You cannot pull the words out of the management's mouth. So legal limitation is they might not give the complete information as requested by the auditor. There is no way by which the auditor can force the management to provide the complete information. Audit is not in the nature of investigation. You are saying that audit is 99.999999%, but what about that 0.0001%? If that is material, what will happen? That is a limitation of audit. Timeliness of financial reporting. The relevance of information decreases over time. Therefore, a balance has to be struck between reliability and the cost of obtaining it. For example, an auditor will be appointed for a period of 5 years. If he sees that closing stock for the first 2 years, it is perfectly maintained by the management. In the third year, will he again waste his time and energy on closing stock? He will be sure that closing stock will be right only. So, the timeliness of financial reporting, what they are saying is, in this case, in the third year that the auditor feels that the closing stock will be right, but unfortunately in the third year only closing stock there is a problem. How will you know that? You are relying on the last 2 years, and based on your past experience you are extrapolating for the third year, which will backfire for you itself. That is timeliness of financial reporting. Future events or conditions may affect an entity adversely. Now you are saying everything is perfect in the organization. Next year COVID came. Can the stakeholders come and ask you, hey, you only told it is perfect, based on you I gave my money to them, I am a shareholder, I am a stakeholder, now you give that money back to me? Can someone ask the auditor? No. It is an inherent limitation of audit that future events can always affect whatever the auditor has signed and given. So there are 5 limitations that we saw here. Nature of financial reporting, nature of audit procedures, it is not in the nature of investigation, and finally timeliness and future events. All of these are limitations. Audit requirements, whether it is mandatory or whether it is voluntary. What is it? It is not mandatory, but for few companies, for few people it is mandatory. That is, any company which is registered under the Companies Act 2013, it automatically becomes mandatory. All the banking companies which is governed by the Banking Regulation Act, it becomes 1949, it becomes mandatory. Other statutory bodies which is required by regulators or specific act, that is the electricity company, cooperative society, public and charitable trust, under any other specified entity, for all of them it becomes mandatory. So for whom is it voluntary, and why will it be voluntary? For partnership firm, sole proprietor, LLP, for all these people who are not mentioned in this mandatory list, it automatically becomes voluntary. Why will they want to do this voluntarily? Why? When they go for loan, the banker will want to see the financial statements. Just seeing the financial statement, the banker will not give the loan. The banker wants proof that whatever is there in the financial statements is right. So the banker will ask for signature of the auditor. So the company will have an internal rule saying, let's appoint an auditor. So internal rule may require audit, or sanction of grant or sanction of loan may require audit. In these cases, they can have an auditor. Appointment of auditor. An auditor is appointed by whom? By the owners or constitutional or government authority in accordance with applicable laws or regulation. For company, it is appointed by the shareholders in the annual general meeting. For a government company, it is appointed by Comptroller Auditor General. For a firm, it is appointed by partners of the firm, and whoever is making the appointment, to that person only the auditor will be giving the report also. So for company, to the members of Reliance Industries, like that we will be seeing. Same way for government company, to whom will be giving the report? To the comptroller and auditor general. For firm, to whom will be giving the report? For the partners, he will be giving the report. So appointment of auditor for company, it is done by shareholders. For firm, it is done by partners, and for government company, it is done by C and AG. And whoever is making the appointment, to that person only we will be giving the report also. Is that clear? Essay 200, quick revision done. Basics before essay 210. What is engagement? Engagement means arrangement to do something, something you do, you call that as engagement. For auditing, engagement means formal agreement between whom and whom? Auditor and the client, under which auditor will agree to provide the auditing services. For this, they have something called as engagement letter. This engagement letter will be prepared by the auditor, and it will be given to the management, and it will be signed by the both the parties, that is both auditor and the client will be signing the engagement letter. What is assurance engagement? How many people are there in assurance engagement? Now normally for this engagement, how many people are there? 3 parties are there. Who are the parties for this engagement? No bride and groom. Bride and groom, nowadays only they have to come for engagement. In olden days, they won't even come for engagement. Yes or no? Who are the parties who are there for engagement? Both the parents of the bride and groom, they will be coming together and they will be setting the date for the future marriage. To whom they will be saying? To all the unnecessary people who came to eat and comment on the food. Yes or no? So there are 3 people here: parent of the bride, parent of the groom, and all the stakeholders, that is the people who came to see the engagement. Same way here also there is 3 people here: practitioner, responsible party, and intended users. Intended users are the users of the financial statements, that means they are the stakeholders. Practitioner is the terminology for auditor. Responsible party is the terminology for management or client. Now read here. There is a 3-party relationship: practitioner, responsible party, and intended users. What is the subject matter that they are doing the audit based on? The financial statements. The financial information in the financial statements is the appropriate subject matter. You are seeing as an auditor that the financial statements is as per AFRF. This AFRF is the suitable criteria because this is your benchmark. You are seeing that the financial statements is as per AFRF level, whether it is prepared as per all the rules, as per all the standards, guidelines, laws, rules, regulations. That is your benchmark. Sufficient and appropriate audit evidence. Sufficiency means quantity, appropriateness means quality. Written assurance report in appropriate form, that is the opinion, that is the outcome or the conclusion which is given by the auditor. Now read this sentence. Assurance engagement means an engagement in which the practitioner, in our case for audit engagement it will be auditor, expresses a conclusion designed to enhance the degree of confidence for the intended users. For what is the auditor giving the conclusion? For increasing the confidence of the stakeholders other than responsible party about the outcome of the evaluation or measurement of subject matter against criteria. Subject matter is nothing but financial information and financial statements. Against criteria is nothing but your AFRF, that is your benchmarks, rules, regulations, and all of those things. So as an auditor, we are giving our opinion for whom? To increase the confidence of the stakeholders, that is the intended users, saying that the subject matter against criteria. Subject matter is nothing but your financial information and financial statements, whether it is as per all the rules, regulations, AFRF, we will be seeing here. Types of assurance engagement. Quickly, let's see the mind mapping. What is engagement? What is assurance engagement? Elements of assurance engagement. Types of assurance engagement. Examples of assurance engagement. These 5 are together. Quickly, let's finish that. Before we go to types of assurance engagement, you need to first learn about this chart which is given here. ICA has something called as AASB, which is Auditing and Assurance Standard Board, which gives the framework for all the engagement standards. Now be very careful, I'm talking about engagement standards, and audit is only a type of engagement. Apart from audit, there are also other types of engagements which can happen. What are the other types of engagements? These engagement standards are split into two: assurance engagement and agreed upon service. Assurance engagement again split into two: historical financial statements and prospective or projected financial statements. Historical financial statements split into three. What are the three? Absolute assurance, reasonable assurance, and limited or moderate level assurance. How you will remember all of these things? If someone comes to our house, if they tell that they are coming 1 week in prior, then you will be able to get all the vegetables, everything, and you will be giving a feast for them. 2 starters, 2 soup, 3 main course, 5 dessert, like that you can give a proper feast for them. Here, time is not a constraint. Coming to reasonable assurance, they are telling 1 day before that they are coming. What you will be giving? Our favorite biryani. What biryani? Chicken biryani plus raita you will be giving, plus sweet bread alwa. Perfect combination. Yes or no? And you're telling itself, hunger is coming from stomach. This is reasonable assurance where time is there, but not as much time as absolute assurance. You can give a biryani, satisfactory level of lunch you will be able to provide. Limited or moderate level review. This is for all the listed companies where they have to file quarterly statements with SEBI. Now you all tell me, quarterly statements means April, May, June. 30th June, first quarter is getting completed. Within 7 days, they have to file it with SEBI. On 30th June itself, will the management prepare and present the financial statements? No, they will take 2 or 3 days, at least for that, for 3 months period. Say on 3rd of July only, they are preparing and presenting the financial statements. This is given to the auditor on 4th of July. Before what time limit they have to file with SEBI? 7th of July they have to file. Only 3 days to audit the entire 3-month period. Is it possible? It is like friend coming on the way and they are calling and saying, Macha, on veetla da dinner. What you will be giving him? Upma. So limited or moderate level means upma, where you will be doing only a review according to the time limit. You will be able to give only a upma. Audit means you can do the maximum you can with the limited time possible. That is biryani plus raita plus bread alwa. Investigation means in-depth examination. You are giving a guarantee, 100% assurance as to whatever they have done. You will be giving a feast here. This is based on historical financial statements. Prospective or projected financial statements. I told you companies like Ola and all, they want to sell their company. So they are not interested in profits. They are only interested in revenue generation and the data. That they want so many users, they want so many people to install their application. So they initially, when they came into the market, they gave for such low prices to just to penetrate into the market, and then they increased the price. Now why they gave such low prices? For people to install that application, for people to start using that application, so that when they go to the investor and show, they can show, see here, even though I'm not making profits right now, so many people are accustomed to my app. So definitely if I increase my price also, they will definitely use that app. They will be able to say that to the investor. For the investor, they need to make something called as prospective financial statements. That means in the future, this is my game plan. Next 5 years, I am going to capture the market by increasing the prices also. Like that, they will be having something that is prospective or projected financial statements. What is this agreed upon service? Here they are going to take only a specific item from the financial statements, that is only segment reporting. They will take that and they will give a report on this, that is agreed upon service. There is no kind of assurance which is given here. So auditor need not be independent, not auditor. In our case it is practitioner. Engagement as a whole, the terminology that we will be using is practitioner. Only for audit engagement we will be using auditor. Example for each we saw. Agreed upon service, it is standards on related services, SRS 4400, SRS 4410. Prospective or projected financial statement, standards on assurance engagement, SAE 3400, 3402 and 3420. Audit, SA 200, SA 210, all of these things are examples for audit. Absolute assurance, 100% assurance investigation. Limited or moderate level we have SRE, that is standards on review engagements 2400 and 2410. Is that clear, guys? With this, now when they ask what are the types of assurance engagement, you will be saying it is prospective or projected financial statement, limited or moderate level, and reasonable assurance. Here for convenience I have put here investigation also under absolute assurance engagement. When they ask types of assurance engagement, you will be giving only 3 types of assurance engagement: reasonable assurance engagement, limited assurance engagement, and moderate level of assurance. What are these 3? Reasonable assurance means it is nothing but audit. Limited assurance engagement means nothing but review engagement. Audit is high level of assurance. When compared to reasonable assurance engagement, review engagement is lower level of assurance. Here lots of audit procedures will be there. Here fewer procedures when compared to reasonable assurance engagement. Here audit evidences lots will be there, so I will be able to draw reasonable conclusion. Here limited conclusion. They are talking about audit procedures, they are talking about conclusion, they are talking about level of assurance, and finally one example for each. The third type of assurance is assurance engagement dealing with matters other than historical financial statements. What is that? Prospective or projected financial information. It provides only a moderate level of assurance. Examination of prospective financial information like forecast or assurance regarding operation of controls, that is in the future what is going to happen, I am going to tell now itself. If you all are going to tell me I will definitely get 60 plus in my auditing exam, will that definitely happen? Will that 100% can I say that I will get 60 plus in my auditing exam? I am aiming for 60 plus, all that is fine, but the mother ICI can twist and turn the questions like anything, so it might become extremely difficult to get 60 plus. So the future is always unpredictable. Examples of assurance engagement: audit, review, prospective financial information, and reporting on controls. What is this prospective financial information? Now, till now we have completed these 5 in the mind mapping. What is engagement? What is assurance engagement? Elements of assurance engagement, types of assurance engagement, examples of assurance engagement. These 5 are completed. Now going to what is prospective financial information and difference between historical and prospective financial information. Prospective means, I told you, it is for something which is going to happen in the future. Prospective financial information means financial information based on assumptions about events that may occur in the future and possible action by the entity. Can be in form of a forecast or projection or combination of both. Practitioner may obtain sufficient appropriate audit evidence to effect that management's assumption. Here the terminology they are using is practitioner will obtain sufficient appropriate audit evidence to effect that management will make a lot of assumptions to do this budget or projection. How are the assumptions? Whether they are reasonable? What is the basis for this assumption? Is it based on past trend? If you remember, I told you this example. The revenue for the first year is 1 lakh, second year is 2 lakhs, third year is 3 lakhs. What is the revenue for fourth, fifth and sixth year? 4 lakh, 5 lakh and 6 lakhs. Based on the past trend, you are able to extrapolate it for the future. That is your assumption, saying in the same growth rate only it is going to go. You have made an assumption. But after making an assumption, is there a possibility that it is just stuck in 3 lakhs? It is not able to grow. Yes, there is a possibility. So, as the practitioner, we have to see whatever assumption that the management has taken, whether it is proper or not. Whatever it is properly presented and all material aspects are properly disclosed or not. It relates to future event while evidence may be available to support the assumptions on which prospective financial information is based. Such evidence itself generally future oriented only. Based on some evidence only you are going to extrapolate it for the future, but still this evidence is future oriented only. Auditor is not in a position to express an opinion as to whether results shown in prospective financial information will be achieved. Whether they really do that or not, auditor will not be able to say that. Therefore, practitioner provides a report assuring that nothing has come to the practitioner's attention to suggest that these assumptions don't provide a reasonable basis for projection. So what is the auditor going to say? Anything can happen in the future. Whatever evidences that they have, this is also for the future only. So as per my knowledge, nothing has come to my attention that there is something which is given here and which is not happening. Hence such types only gives a moderate level of assurance. What is difference between historical and prospective financial information? Historical means something which happens in the past. Prospective means something which is happening in the future. Following standards are collectively known as engagement standards. In this chart we saw, correct? All of this together they have given us all the standards. Standards on auditing, standards on review engagement, standards on assurance engagement, standards on related services. Now so many standards are there. Why are the standards needed? For this only we had a beautiful example. You all told me how biryani should be made. You must add what are the ingredients which should be added in biryani. You gave me a list of ingredients for this. For that you all told me compulsorily chicken has to be there, or it can be replaced with, what happened? Or it can be replaced with mutton. Either of this can be there, or it can be replaced with egg. But you don't replace this with carrot and beans. If you replace this with carrot and beans, the only rule is don't call it as biryani. You call it as however you want. You call as pulav. You call as mixed veg rice. You call however you want. Like that, we all set the rules in class. Yes or no? So the rules to call a biryani, you all were able to say. Same way for standards also. You have to do the audit procedures this way only. If this audit procedure is not there, chicken is not there, what you will be adding? Mutton. You add some other audit procedure, but you don't do these audit procedure. You don't put mushroom and all, and you call this biryani. In case you do these audit procedures, you don't call this audit itself. Like that, they are able to show you how the rules has to be done when you are going and conducting the audit. From when you are conducting the audit, when you are doing the audit procedures, getting the audit evidence, you are coming to conclusion, writing the report, everything it is given in standards on auditing. Standards ensure carrying out of audit against established benchmarks at par with global practices in overall world itself. Biryani means these are the rules that you have to follow. Standards improve quality of financial reporting, thereby helping users to make diligent decisions. Quality of the accounts, it is improving. Standards promote uniformity as audit of financial statements. Standards equip the professional accountants with professional knowledge and professional skill. Standards ensure the audit quality. Why are standards needed? For quality, there are 2 points. One is it improves the quality of accounting, that is financial reporting, which helps for users to make the diligent decision. Standards ensure audit quality also. Apart from this, there are 3 points. globally accepted rules are there, uniformity has to be there, it equips the professional knowledge and skill. Duties in relation to engagement and quality control. It is the duty of the professional accountant to see that standards are followed in engagements. Situation may arise when specific procedure, that a standard is ineffective. In that case, what will you be doing? You will be going for alternative procedures. However, if you go for alternative procedures, what is the reason that you've gone for alternative procedure? You please document this reason clearly as part of your audit documentation. And finally, it is to be noted that a mere disclosure in the report does not absolve a professional accountant from complying with the accounting standards. Just because you have done a disclosure does not mean your entire duty is over. You have to do your duty properly. Now, duties in relation to engagement and quality control standards, what did we see? It is the duty of the professional accountant to follow the standards properly. If the standard is saying a specific procedure, you do that procedure only. If that is not possible, you go for alternate procedures. Now, if you go for alternate procedures, as an auditor, it is our duty to document that with reasons. Now, just because you've documented everything does not mean your duties are completed. As per the standards on auditing, whatever you have to do, you compulsorily have to follow that only. Finally, as an auditor, how should we be? What are the qualities of the auditor? An auditor should be with tact, caution, firmness, good temper, integrity, discretion. He should know the industry, judgment, patience, clear-headedness. He should be reliable. He should have good culture. He should be of highest degree of integrity. Integrity means honesty. He should hold the confidentiality. That means trust should be there. And an exhaustive knowledge of accounting in all branches is the sine qua non. That means what? It is absolutely essential of the practice of auditing. He must know thoroughly all the accounting principles and techniques. Qualities of auditor na, all your ethics you please write here. He should know the integrity, he should have the temper, he should be of good firmness, he should have the good culture, everything you write here for qualities of auditor. Is that clear? Yes? Quickly let's go through the mind mapping for you to get a better idea. First we saw what is engagement, what is assurance engagement, elements of assurance engagement. Elements of assurance engagement, what did we see? The dabba we saw here. Yes, three-party relationship, what is subject matter, what is suitable criteria, all of those things. Types of assurance engagement, how many are there? 3 types are there. Examples of assurance engagement. Each type we saw examples. Prospective financial information means past. Sorry, prospective means future. Historical financial information means past. Why are standards needed? Quality 2 points and remaining points, you know, global practice and all of those things. Duties in relation to engagement and quality control standards. And finally we went to qualities of auditor. This is basics before SA 210. I have given this here because in your ICA chapter number 1, this basics is given, and the first part, that is SA 200, what is audit we saw, that is also given. That's why together we are seeing these two. Is that clear, guys? SA 210, agreeing the terms of audit engagement. Under this, let's quickly see the mind mapping. What is the objective of the auditor? What is the meaning of engagement letter? There are 4 cases which is given here, and finally you will be seeing what is the meaning of recurring audit. What is the objective of the auditor? One thing which you have to keep note here is the terminology which is used is not accept or reject, but it is accept or continue. For what is accept, for what it is continue. For a new audit it is accept. For an existing audit where an auditor will be appointed for a period of 5 years, maybe in the 3rd year he will be continuing for the 4th year. So accept or continue an audit engagement only when they have established something called as preconditions. Those preconditions has to be present, confirming that there is a common understanding between the auditor and the management, and where appropriate TCWG of the terms of audit engagement. Now what are these preconditions you will have to see. For example, when you are coming to class, there is a precondition you definitely have to take bath and only come to class. Yes or no? There is a precondition that you will brush your teeth and then only you will come to class. When you go to office, there is a precondition that you will be wearing formal clothes and then only you will be going to office. That is only precondition for audit has to be there. What are the preconditions for audit? There should be a common understanding for the preparation in the financial statements in accordance with AFRF. Who is going to do the preparation of the financial statements? Management is going to do the preparation and presentation of financial statements. There is a precondition that it will be prepared only as per AFRF. For such internal control as manager considers necessary to enable the preparation of financial statements that is free from material misstatement, whether due to fraud or error. What they are trying to say, that the internal control is what? Internal control is a process which is designed, implemented and maintained by the management at TCWG to provide reasonable assurance for achievement of 4 objectives. Yes or no? Internal control, for general understanding, we understand it at rules which is framed by the organization for the organization. For such internal controls which enables the preparation of financial statements that is free from material misstatement. That means a person who has to enter into the accounts, only he should have access to that accounts. Nobody else should have access. If somebody else has access, that means the financial statements will not free from material misstatement. Yes or no? So the next precondition is to provide the auditor with access to all information, access to any additional information and unrestricted access to persons. That means when you go for audit, you get access to all the information which is there, and apart from that information which they are providing, you can ask for any additional information, and lastly you can have access to all the people who are working in the organization. So everybody together, what is the objective of the auditor? Accept or continue an audit engagement only when we are establishing whether preconditions are present or not. What are the preconditions? There should be a common understanding between auditor and management for what? For the preparation of financial statements as per AFRF, for the internal control which basically helps the financial statements to be free from material misstatement, and they need to provide the auditor with 3 things: access to all information, access to additional information and unrestricted access to persons. What is engagement letter? Why do you require engagement letter? Who is preparing the engagement letter? For what is the engagement letter? For whom, guys? For what is the engagement letter? For both auditor and client, the engagement letter is required, because the engagement letter is a place where they are going to discuss, this is your responsibility, this is my responsibility. And who is preparing the engagement letter? Auditor is preparing the engagement letter. You all, when you go for articleship, especially in Big 4, this will be one of the first job that you all will be doing, preparation of engagement letter. So remember that you are doing means you for the audit team you are doing. So auditor will prepare the EL and he will be giving it to the client. Client will sign, auditor will also sign. Now the engagement letter includes the objective and scope of audit, responsibilities of the auditor, responsibilities of the management, identification of AFRF and reference to expected form and content of any report which is to be issued by the auditor. So these 5 things are covering what and all is expected from the management side, what and all is expected from the auditor's side. What is the 5 things? Objective and scope of audit, responsibility of auditor, from management side, responsibility of management. What is his responsibility? Preparation and presentation of financial statements, whether it is as per AFRF. That is the next point. Then after doing my audit procedures, I get all my audit evidences, I give my conclusion, and finally I will be giving my audit report. That is the last one, reference to expected form and content of any report which is to be issued by the auditor. Now only in one case engagement letter is not required. What is that case? If law or regulation requires. If the law is appointing the auditor and saying you be appointed as the auditor for this company, this is your scope of work, this is your work, everything if the law is saying, then they don't require an engagement letter, provided the auditor is satisfied that the management has understood his duties. Read the text here. If law or regulation prescribes in sufficient detail the terms of audit engagement, the auditor need not record them in written agreement except for the fact that such law or regulation applies and that management acknowledges and understands the responsibilities. In this case only EL is not required. In all the cases engagement letter is required. Don't say just if law or regulation says EL is not required. It's not like that. If law or regulation says and if the auditor is satisfied that the management has understood all his responsibilities, in that case engagement letter is not required. Is that clear? Now again going back to the mind mapping, objective is done, EL is done. Now coming to cases. What happens if preconditions for an audit is not present? If precondition is there, you will definitely accept the engagement. If precondition is not there, you will have to see whether it is required by law or regulation. Now see here, preconditions are there means you will be accepting. If precondition are not there, directly don't go for rejecting the engagement. You will see if law or regulation requires you to accept. If law says yes sir, then you will be accepting. If law or regulation is not there, then you will be rejecting. This is the case number 1. Read the theory. Auditor shall discuss the matter with the management unless required by law or regulation to do so. The auditor shall not accept the proposed audit engagement. If the auditor has determined that the financial reporting framework to be applied in the financial statement is unacceptable, that means it is not as per AFRF. What is AFRF in India? Accounting Standards Schedule 3. Say they are not following our accounting standards, they are following US GAAP. In that case, precondition is not there. So, you will see whether law or regulation is asking you to accept. If not, you will not accept the engagement. If the agreement of management is not obtained in matters relating to understanding responsibility for preparation of financial statement, internal control, providing access to all information and unrestricted access to persons. Basically here they are again talking about preconditions. Basically if precondition is not there, then you will see whether law or regulation is asking you to accept. If it is asking you to accept, you will accept. If it is not asking you to accept, you will not accept. Is that clear? Going to the second case. Limitation on scope of auditor's work prior to acceptance of audit engagement. Before I accept the engagement itself, I know that they are not going to give me any evidence. The previous auditor told me, sir, he will not give any kind of information, don't waste your time with him. He told like that. If he doesn't give any information, what opinion will I be giving? Disclaimer of opinion. So if I know beforehand itself that I am going to disclaim the opinion, then I will not accept a limited engagement. Read the text. Limitation on scope of auditor's work prior to acceptance of audit engagement. If the auditor believes the limitation will result in the auditor disclaiming an opinion on the financial statements, the auditor shall not accept a limited engagement. Is that clear? Moving forward, acceptance of a change in terms of audit engagement. If they ask for change in terms, what will you do? Say for example, before marriage, you told your husband that you are in cooking team. Your husband told he is in vessel washing team. Now what he wants to do? He doesn't want to do anything. He is not doing the vessel washing. In that case, what should you do? Should you also do the vessel washing by yourself? No. You will be asking for reasonable justification. Directly don't go for divorce also. You ask for reasonable justification. If he is going to give the reasonable justification, if reasonable justification is there, then you will accept. He is saying, I am not able to do the vessel washing because I am getting the allergy in my hand. Don't take me wrongly. Is it reasonable justification? Yes. So you will be accepting in that case. If there is no reasonable justification, all that I told before marriage, now you don't come and ask me the same questions like that. If there is no reasonable justification, what should you do? You will reject. Now, whenever there is a question about change in terms, the terminology that you will use is reasonable justification. Whenever there is change in terms, you will see whether there is reasonable justification. If there is reasonable justification, you will accept. If there is no reasonable justification, you will reject. See the theory part. The auditor shall not accept where there is no reasonable justification in doing so. If there is change in circumstances that is affecting the entity's requirement or a misunderstanding concerning the nature, if there is a change in circumstances, now him coming and telling that his hands are becoming allergic because of that vessel washing powder and all. Now there is a reasonable justification because of a change in circumstances. The other part is, he thought vessel washing means only once a week he should do it. So there is a misunderstanding in his work concerning the nature of service. In these cases you will call that as reasonable justification. Is that clear? Going to the next one. Recourse for the auditor in a situation of non-agreement. For example, he is saying, I will not be in vessel washing team, I will come to cooking team. You go to vessel washing team. You accepted for it. Okay, I will go to vessel washing team. Now again he is coming and saying, no, I cannot do the entire cooking by myself. Somebody has to cut the vegetables. I will just do like this. That is the cooking that I know. He is telling like that. Now you are saying, okay, fine, I will help you cut the vegetables. Now he is saying, you cut the vegetables, you just put it inside. Why you are keeping it there? I will just on the stove and I will do like this. He is telling. Now okay, anyway it is here, I am cutting and I will just throw it there. You accept it. Now he is saying, you anyway put it there, just on the stove for me. I will take care of everything. Like that, he is not agreeing for anything. It is a situation of non-agreement. He is not allowing for changing in terms also. He is not allowing for continuing the original audit engagement also. In that case, what option you have? Will you do both the work? No. That option is only withdrawing from the audit engagement. You don't have any other option. But whenever you withdraw, when you go for divorce, is it just you? A marriage is not just between two people, it is between two families. So you have to tell the other people who are related. So here also, when you withdraw from the audit engagement, you see whether you have to report to the owners. You see whether you have to report to those charged with governance. In the case if you are appointed by the regulator, you see whether you have to report to the regulator also. Is that clear? There are 4 cases we saw here. What happens if preconditions for an audit is not present? If precondition is there, you will accept. If precondition is not there, will you reject? What will you see? Law or regulation. If law or regulation asks you to accept, then you will accept. If law or regulation is silent, then you will be rejecting. Case number 2. Limitation on scope of auditor's work prior to acceptance of audit engagement. Before itself, you know that there is going to be a limitation which is given. You know that you are going to disclaim your opinion. In that case, you will not accept the limited engagement. Case number 3 is acceptance of a change in the terms of audit engagement. Change in terms. Whenever you see that, what is the key word that you will look for? Reasonable justification. What is the meaning of reasonable justification? Reasonable justification means either change in circumstances or misunderstanding. In both these cases, you will call that as reasonable justification. If it is there, you will accept. If reasonable justification is not there, you will be rejecting. Case number 4 is what? Recourse for auditor in situation of non-agreement. He is not accepting for changing in terms of agreement properly, or if you say old agreement we will continue, for that also he is not accepting. Then what will you do? The only option is to withdraw from the engagement. But when you withdraw, you have to see if there is any obligation, either contractual obligation or otherwise, whether you have to report to the owners, TCWG or regulators. You will have to see all of those things. Is that clear? The next part is talking about recurring audit. What is the meaning of recurring audit? The audit which happens again and again and again over the years it happens. So for example, an auditor is appointed for 1 year. He can get appointed for 5 years and again for 5 years. Then only he gets a cooling period of 5 years. Yes or no? So in this time he will get very comfortable as to what is happening in the organization. In that case, recurring audit case, he will have to see in what cases the engagement letter has to be revised. Because engagement letter is done here, now we are here, we have to see is the same things are there or if anything has changed. What is the anything which has changed is these points. What are the points? The first one is indication that entity misunderstands the objective and misunderstands the scope of audit. They thought that preparation presentation has to be done by the auditor. You all are studying account subject. That means you all know how to prepare the financial statements. So that is your job only. They thought like that. They have misunderstood their duties. In that case, you will revise the terms of audit engagement or you will remind the entity of the existing terms which is there in the engagement letter. The first case is they have misunderstood the objective and scope. Revised or special terms of audit engagement. You want to change the engagement. For example, when you started off here, they were a small company. Now they are a funded company. 250 crores they have raised. Operations have increased. You will not be willing to do for the same fees, yes or no? In that case, you will be changing the audit engagement. So revised or special terms of audit engagement. A change in senior management. Why is this required? Change in senior management. Change in ownership. Why is that required? One person would have signed your engagement letter. He would have left the organization. Now we are in the 6th year. Another person is there. He is saying, whoever signed, you go and ask him. Nothing is related to me. I did not sign the engagement letter. In that case, you will either remind the entity or you will revise the engagement letter. So change in senior management. Change in ownership. The next one is change in nature or change in size of the entity's business. If the size is increasing, revenue is increasing, asset is increasing, obviously your fees also should increase. So you will go for revising your engagement letter. Change in legal or regulatory requirements. Previously it was indirect tax, service tax. Now suddenly it is GST. GST means more fees. No one knows about it properly till date. So I will charge more fees. If there is a change in regulatory requirements, then I will go for reminding them about the existing engagement letter or I will revise the engagement letter. Change in AFRF. Suddenly there is a law which says Ind AS came just now. There is no Ind AS. All over the world we are following only IFRS. If they say like that, then what should we do? We should also follow IFRS only. In that case, the engagement letter has to change. So a change in financial reporting framework. Change in other reporting requirements. If it is there, then you will go for change in engagement letter. So what are these 8 points which is there for reminding the entity of existing term or revising the terms of audit engagement? What are the 8 points? Indication that entity misunderstands the objective and scope. Second, revise or special terms of audit engagement. Third, change of senior management. Fourth, change in ownership. Change in nature or size of the business. Change in legal or regulatory requirements. Change in applicable financial reporting framework and change in other reporting requirements. Is that clear, guys? With this essay 210 revision comes to an end. Essay 700. In the mind mapping, quickly we'll finish off what is there in essay 700. The first one is the objective of the standard. What is the meaning of unmodified opinion? To form an opinion, auditor is to obtain reasonable assurance for that what and all he has to do. And finally, we have elements or contents of the audit report. Now, the objective of the standard essay 700 is forming an opinion and reporting on the financial statements. If you remember, I told you the objective itself is the name of the standard, forming an opinion and reporting on the financial statements. The first objective is to form an opinion on the financial statements based on the conclusions based on audit evidence. Second is the reporting requirement, to express clearly that opinion through a written report. These two are the objectives of SA 700. What are these two? To form an opinion on the financial statements based on evaluation of conclusions drawn from the audit evidence which is obtained, and second, to report, to express clearly that opinion through a written audit report. The first one is objective. The objective itself is name of the standard. The second is unmodified opinion. What is the meaning of unmodified opinion? Unmodified opinion is when the auditor feels that there are no mistakes in the financial statements. That means the financial statements are prepared as it is supposed to be prepared. What is that supposed to be prepared? As per the accounting standards, that is AFRF. The auditor shall express an unmodified opinion when the auditor concludes that the financial statements are prepared in all material respects in accordance with AFRF. That means the financial statements are as per the accounting standards only. The third is to form an opinion. The auditor is to obtain the reasonable assurance. The auditor shall form an opinion on whether the financial statements are prepared in all material respects in accordance with AFRF. In order to form that opinion, the auditor will conclude as to whether the auditor has obtained reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. Now, for you to make this conclusion that there is a reasonable assurance that the financial statements as a whole are free from material misstatement, for you to make this conclusion, you have to look at these points. Whether SAI has been obtained, whether if there are any misstatement, and if that misstatement is uncorrected, is it still material? Whether uncorrected misstatements, whether they are material. And finally, few evaluations of the qualitative aspects and specific evaluation. What is this evaluation of qualitative aspects? What is this specific evaluation? The specific evaluation is talking about selected and applied significant accounting policies, whether they are adequately disclosed and whether they are consistent with the AFRF. That means you have to disclose the accounting policy and it has to be consistent. If there is any change, then you have to give in notes to accounts about the description as to the change and also the reasons as to why your accounting policy has changed. Accounting estimates which is used by the management, whether they are reasonable or not. Information in financial statements, whether it is relevant, reliable, comparable and understandable. All the disclosures which is there in the financial statements, whether it is adequate and whatever terminology that you have used is appropriate. All of these are the specific evaluations which you will be doing. Evaluations of qualitative aspects of the accounting practices. What is that qualitative aspects? Now this is only for the accounting practices. So for accounting, there will be lots of bias by the management. There can be judgments. There can be bias. If there is no neutrality, that means as the management, when they are preparing and presenting the financial statements, they should not be biased. So they have to be neutral. Indicators of lack of neutrality. That means when they are making the estimate itself, I told you an example for this, that say the director is there, director's ex-girlfriend has purchased the materials. Now how the director will think? That she is definitely not going to return that money. She is not going to pay for whatever she has purchased. Like that he is going to think and he is going to create provision for bad and doubtful debts for that entire amount that she has purchased. Now is there neutrality here? No, he is allowing his bias to come here for this provision for bad and doubtful debts. So possible management bias in the making of accounting estimates, or selective correction of misstatement which is brought to the management's attention. What is this selective correction of misstatement? Anything which is going to increase my revenue, I am not going to correct it. Anything which is going to reduce my revenue, okay, fine, I will correct. They're doing like that because they want the investment, they want to show high revenue. The opposite is also possible. Anything which is reducing the revenue, they are saying okay to correct. Anything which is increasing the revenue, they are not okay to correct. When is this scenario? When they have to pay the tax. When they don't want to pay the tax, they want to keep the revenue down. When they're looking for investments, they want to keep the revenues up. So if there is any selective correction, that is also a lack of neutrality. If you are able to see something like that, then there is a qualitative aspect evaluation which you will be doing. After doing all of this is when you will be able to see that the financial statements are free from material misstatement, whether due to fraud or error. Is that clear? Yes. Further, when financial statements are prepared in accordance with fair presentation framework, the evaluation mentioned above shall also include an evaluation by the auditor as to whether the financial statements achieve that fair presentation framework, which shall include the overall presentation structure and content, and whether financial statements, whatever is happening in the financial statements, is actually whatever happened in real life also. What is this fair presentation framework? What is that fair presentation framework? Actually, whatever has happened, that only he has to report in the financial statements. That is only fairly presenting the financial statements. Example? Example? Now, the standard might tell you that you have to do something. This is the form. But in reality, the substance, it is something different. So, give importance to substance over the form. Somewhere in your disclosures, you can mention that for this reason I have deviated from the standard. That is that fair presentation framework. Is that clear? Yes. Going to the next part, which is elements or contents of audit report. Again, going to mind mapping, we saw the objective. Objective is nothing but the name, forming an opinion and expressing clearly with the written report. Unmodified opinion means that the financial statements are prepared as per AFRF. And third, to form an opinion, auditor to obtain reasonable assurance. Here we saw that the auditor will want to obtain reasonable assurance that the financial statements are free from material misstatement due to fraud or error. This conclusion is based on all of these things, whether that sufficient appropriate audit evidence is there, whether any misstatements are there, whether that misstatements are uncorrected, and whether it is material in nature, and few evaluations that they have to do. Specific evaluations are there, qualitative evaluations for the accounting practices are there, and finally about fair presentation framework also we saw. Now going to elements or contents of the audit report. The first one is the title of audit report. Whose audit report did we take? Now, Reliance Industries audit report. What are they talking about? The title. The audit report shall have a title clearly indicates that it is the report of the independent auditor. For example, here if you see independent auditor's report is written there. That is the title of the audit report. The next one, addressee. To whom are you going to address? The audit report shall be addressed as appropriate based on the circumstances. Law, regulation, or the terms of engagement will tell them whom you have to address. Normally, to whomever you are preparing the report for, you are going to address for that person. For a company, it is going to be shareholders. For firm, it is going to be partners. For a government company, it is going to be C and AG. You are clear with that, correct? So this is a company. So here they have written to the members of Reliance Industries Limited. So it is addressed to the members, that is the shareholders of the company. The third title is the opinion paragraph. Auditor's opinion. The first section of the auditor's report shall include the opinion paragraph. So if you see in the audit report, it starts with the title to the members of. This is the report on standalone financial statements. What is the first section? It is the opinion paragraph. Now what are they saying? And it shall have the heading opinion. Was it there? Yes, the opinion section of the auditor's report shall also identify the entity whose financial statements have been audited, state that the financial statements have been audited, identify the title of each statement comprising the financial statements, refer to the notes including the summary of significant accounting policies, specify the date and the period which is covered. What and all are they saying? Identify the entity. Is Reliance Industries written here? We have audited for Reliance Industries Limited. Yes, identifying the entity is done. State that the financial statements have been audited. That is the first sentence. We have audited the accompanying standalone financial statements, which includes its joint operations, which comprise like that. They are starting the sentence where they are stating that the financial statements have been audited. Identify the title of each statement comprising the financial statement. What is comprising the financial statement? Your P&L, balance sheet, cash flow statement. So the title has to be mentioned, which includes its joint operations, which comprises balance sheet as on 31st March, statement of profit and loss, statement of cash flow, statement of changes in equity. So all of these are the title which is comprising in the financial statements. Refer to the notes including the summary of significant accounting policies. Have they referred to the notes? And notes to the standalone financial statements including a summary of material accounting policy and other explanatory information. Specify the date or period covered by each financial statement comprising the financial statement. Here is it written 31st March 2024. The period also is written here. When expressing an unmodified opinion, unmodified means you are saying that everything is perfect, everything is as per AFRF. The financial statements are as per AFRF. When expressing an unmodified opinion on financial statement, unless otherwise required by law, you have to use one of these phrases only. First one is, you will be saying it presents fairly in all material respects. The second one is, it gives a true and fair view of the state of affairs. Now what should not be there is, once you write it presents fairly and it gives a true and fair view, after this you should not continue subject to. With regard to these explanations like that, you cannot continue. So the phrases present fairly are and true gives a true and fair view are regarded as being equivalent. It is not appropriate to use the phrase what? Subject to with the foregoing explanation in relation to the opinion. So here what opinion are they giving for our Reliance Industries? In our opinion, with the best of the information according to the explanation, the aforesaid standalone statement in the manner so required give a true and fair view in conformity with the accounting standards like that they have given. So next is basis for opinion. The audit report shall include a section directly following the opinion section with the heading basis for opinion. Here there are 4 points that you have to remember. The first one is state that audit was conducted in accordance with standards on auditing. Second one, it refers to the section which describes the auditor's responsibilities. Third, it includes a statement that the auditor is independent of the entity. And last, I am doing all of this is only based on the sufficient and appropriate audit evidence, and based on this only I am giving the basis for audit opinion. Is that clear? These 4 points compulsorily has to be there in basis for opinion paragraph. What is the first one? Conducted as per standards on auditing. We conducted our audit on standalone financial statement in accordance with the standards on auditing. Is it there? What is the second point? Auditor's responsibilities. Our responsibility under those standards are further described in auditor's responsibilities. There. Third one, they have to mention that they are independent. We are independent of the company in accordance with Code of Ethics issued by ICA. What is the fourth one? Based on the sufficient appropriate audit evidence only, we are giving. See the last point. We believe that audit evidence obtained by us is both sufficient and appropriate to provide a basis for our audit opinion on the standalone financial statements. Is that clear? All 4 points compulsorily must be there in basis for opinion. They can ask guys in exam, even this part they can ask. If you are giving an unmodified opinion, how should the words be, how it should not be. And this basis for opinion, these 4 points, they can ask in exam as a direct question also. Now the first one is with regard to title, second is addressee, third is opinion, fourth is basis for opinion, and now the fifth one is material uncertainty relating to the going concern. What is the meaning of going concern? Going concern means that the company is going to go on forever. That means in the foreseeable future, I don't have any doubts that this company is going to fall. Like how all of us are also there, we keep wanting to go forward. 60 years also, if I ask you the question, you will say 5 more years I will see son's marriage, daughter's marriage. 70 years if I ask you, you will say granddaughter's marriage. 80 years if I ask you, you will say granddaughter now only has girlfriend. Like that you will keep on going. You will never accept for finishing off. The same way a company also going concern. The financial statements are prepared on the assumption that the entity is a going concern and it will continue its operations for foreseeable future. When use of going concern basis of accounting is appropriate, they are assets and liability are recorded on accrual basis of accounting. The auditor shall evaluate sufficient appropriate audit evidence has been obtained regarding and shall include on appropriateness of management's use of going concern basis. If you remember in essay 570, implications, first implication, what is it given? In essay 570, implications are there. Under that first implication, what is given? The financial statements are prepared as per going concern basis and the auditor feels that it is inappropriate. And that case, what opinion did he give? Adverse opinion he gave. Now here, what are they talking about? The auditor will conclude on the appropriateness of the management's use of going concern. Is that clear? Please connect and study. Whether any material uncertainty exists. Material uncertainty means there is a 50-50 probability that going concern might be affected, might not be affected. For this only example was Audi. For Audi, what they did a bad ad where they showed that each of the ring of the keychain represents each of the feature of a car. They said Mercedes-Benz, safety, BMW, sportiness, Jaguar, classiness. Like that they put 4 keychains and the rings of the keychain, and finally they showed only the logo and said all 4 are here. Now all the 4 people are irritated, they are mad at them, and then they went and filed a case asking for 1,000 crores per person. Now what happens? In case if Audi loses the case, Audi has to pay 4,000 crores outside the company when the revenue of Audi itself was only 4,000 crores. Now we saw that example, yes or no? The likelihood of occurrence of material uncertainty. What is the probability of it happening or not? For this only, what is the, if it is material uncertainty, it is 50-50. The next part is talking about probability of this material uncertainty happening or not. How will you know the probability? For example, a similar case is there with Horlicks and Complan. Now, if you want to become tall, you have to drink the Complan. Everyone knows that they have advertised it so much. So Horlicks gave a public service message saying, are you all fools? Are you, when someone is asking to become tall, what you have to drink means you all are telling Complan. Like that Horlicks made a public service message and said, please open your eyes. You know it is not true, but still it is coming from your mouth. That means they have conditioned your brain through this marketing tactic. Like that Horlicks has spoken, and Complan went and filed a case on Horlicks. Now this case, Complan has won the case. If Complan has won the case, now what will this judge say? What will this judge say? The probability of having the material uncertainty increases, because in this case there is a lot of possibility that Audi will also lose the case. And here, if they say, no, you cannot talk like this and all, you cannot use, sorry, you can talk however you want. If they are talking like that, you also talk like that. You say Horlicks, nothing, no Shakti is there. Like that you put the ad, like that judge has given the command. If it is like that, then in this Audi case, then the probability will become low. Is that clear? So the next point is basically talking about likelihood of occurrence of the material uncertainty. How will we know? Based on other cases is how we will know what is the probability of this material uncertainty happening or non-happening. Appropriate disclosure of the nature and implications of uncertainty is necessary for both fair presentation and the compliance framework. The first one was title, second addressee, third opinion, fourth basis for opinion, fifth material uncertainty relating to going concern, and sixth is key audit matters. What is this key audit matters? Basically, for all the listed companies, key audit matters paragraph is compulsory. SA 701 is telling. In case if the auditor feels that CAM paragraph is required for public interest, then in that case also CAM paragraph will be there. Law or regulation may require communication of key audit matters for audit of entities other than listed entities. Now quickly jumping into SA 701, which is key audit matters. What is the mind mapping in SA 701? What is key audit matters? What are the definition? What is the objective? Applicability, how to determine the key audit matters, communicating key audit matters. Key audit matters is not a substitute for four things are there. Key audit matters will not be communicated if three things are there. Communication with TCWG. Now quickly let's finish this. What is this key audit matters? The auditor may decide to communicate key audit matters for other entities, including those that may be of significant public interest. For example, because they have a large number and wide range of stakeholders and considering the nature and size of the business. Usually it is compulsory for listed entities, but if the auditor feels that this paragraph must be there for public interest, then they can include the CAM paragraph. What is the definition? Key audit matters are those matters that in the auditor's professional judgment were of most significance in the audit of financial statements of the current period. Key audit matters are selected from matters communicated with those charged with governance. There are 2 points to remember here. First one is it will always pertain only to the current period, and the second one is you should always communicate whatever you are going to show in the key audit matters with those charged with governance, and then only you will show it in the key audit matters. What is the objective of this standard? It is to determine the key audit matters, and after forming the opinion, it is to communicate the matters, describing them in the auditor's report. Who has the applicability? First one, listed entities. Otherwise, if the auditor decides to communicate based on public interest or if it is required by law or regulation. However, SA 705 prohibits the auditor from communicating CAM when the auditor disclaims an opinion on the financial statements unless such reporting is required by law or regulation. Basically, if there is a disclaimer of opinion, in that case, CAM paragraph should not be there. However, law is the mother. If law says CAM paragraph should be there, then even during disclaimer of opinion, CAM paragraph will be there, because here applicability, it is written, it is required by law or regulation to communicate the key audit matters. Is that clear, guys? So for unmodified opinion, can CAM be there? Yes. For modified qualified opinion, can CAM be there? For adverse opinion, can CAM be there? For disclaimer of opinion, yes, CAM can be there if law or regulation requires a CAM. Like that, you have to put it in your head. Is that clear? Going forward, how to determine the CAM? You are saying it is key audit matters. What is making it key? What is making it important? For that, 3 points are there. First one is high risk of material misstatement as per SA 315. Risk of material misstatement means there is a risk that the possibility of mistakes can happen, and that mistakes will be important mistakes. So if the risk is high, then you will be communicating that with the key audit matters paragraph. If any kind of accounting estimate is having high uncertainty, then you can show it under key audit matter paragraph. Or any other significant event or transaction, if it happens, then you can show that event or transaction also in the key audit matter paragraph. How to determine the CAM? 3 points are there. What are the 3 points? Quickly tell me. If high risk of mental misstatement as per SA 315. Second, significant event or transaction happens. And last one, accounting estimate if there is a high uncertainty. These 3 points, if it is there, you will be determining the CAM with the help of 3 points. Communicating the CAM. The auditor shall describe each key audit matter using an appropriate heading in a separate section of auditor's report under the heading Key Audit Matters. The introductory language will have key audit matters are those that in the auditor's professional judgment are most significant. These matters were addressed in the context of the audit of financial statements as a whole and in forming the auditor's opinion thereon. The auditor does not provide a separate opinion on these matters. For example, if there is a high risk of mental misstatement in a specific area, because of that I am giving an adverse opinion. Can there be a possibility? There is an important event which happened, because of that I am giving a modified opinion. Is that possible? No. So these three, if it comes, you will be giving only a key audit matter. This is not a replacement for a separate opinion by itself. Communicating CAM, not a substitute for. Here 4 points you have to remember. The first one is, if there has to be a disclosure in the financial statements, that has to be shown in the disclosure only. You can't say instead of disclosure I showed in key audit matters and all. So it is not a substitute for disclosure. It is not a substitute for SA 705, modified opinion. It is not a substitute for SA 570, going concern paragraph has to be separate. You can't say in key audit matters I spoke about going concern, so in the going concern paragraph I'm not talking about it. You cannot say that. It is not a substitute. And finally, it is not a substitute for separate opinion. What are the 4 points where CAM is not a substitute for disclosure in the financial statement? First one, disclosures in the financial statement. Second, it is not a substitute for any modifications as per SA 705. Third, it is not a substitute for going concern paragraph as per SA 570. And last, it is not a substitute for separate opinion. CAM will not be communicated if a law or regulation prohibits possible adverse consequence or highly confidential. Basically, if something is highly confidential matter, you will not be showing that in your CAM paragraph. If there is an adverse consequence, or if the law or regulation prohibit, anyway you will not show. These two are basically going to weaken the whole standard. So, because highly confidential information will not be there in CAM, will you go and read that CAM? No. What are they given in CAM here? Key audit matters, some litigation matters, matters relating to oil and gas, disallowance of some certain costs, claim against the company have migrated to neighboring block. Nothing we are understanding what is that block and all. Matters relating to trading in shares of Reliance Petroleum Limited. Some judgment has come dismissing company's appeal. Fair valuation of investment. Company has investment of 78,000 crores in Geo Digital Fiber, which are measured at fair value as per Ind AS. Our procedures were not limited to the following. What they are trying to say? IT systems and control over financial reporting. Here they are tested the design. Some key audit matters. Anything confidential here? They are only saying what is there. Nothing is confidential here. And if it is having an adverse consequence, if I see that and if I not invest, if I see that I will not give the loans. If there is an adverse consequence, you will not even show that in CAM paragraph. That is why this weakens the section itself. This weakens the whole standard itself. And whatever you have to show in CAM, you will be communicating with those charged with governance. Those matters the auditor has determined to be the CAM, or if applicable depending on the facts and circumstances of the entity and the audit, the auditor's determination that there is no CAM to communicate in the auditor's report. Even if no CAM is there, you please mention that there is no CAM to mention in the auditor's report. In CAM, what and all did we see? What is key audit matters? Now I'll tell you one small example. Let me see if you're able to answer it. Okay. Now I found out that the previous year figure is there, correct, in the financial statements. I'm going to sign on that also. So in the previous year, in the opening stock of the previous year or some purchase of the previous year, some stock valuation, I am a little doubtful. So I feel that the risk of material misstatement is high in that case. So I spoke to the TCWG. There is no adverse consequence. It is not a confidential information and all of those things. I spoke to TCWG. They said, okay, you proceed. You can put it in CAM. So I have shown it in the CAM. Is it correct? Who and all are saying it is correct? Why is it not correct? It is not confidential. It should pertain only to the current year. I told you previous year some purchases, some problem was there. I don't know how many of you all noticed that. CAM should always pertain only to the current year. Key audit matters, the auditor may also decide to communicate CAM for entire entity. We saw definition. What is it? It should pertain only to current period, and key audit matters are selected from whatever is communicated with those charged with governance. What is the objective of the standard? To determine and to communicate in the audit report. Who it is applicable for all listed entities. For if the auditor decides that it is applicable in terms of public interest or if it is required by law or regulation. When CAM paragraph will not come, when there is a disclaimer of opinion and law or regulation is not saying anything, then CAM paragraph should not come. How to determine the CAM? When there is high risk of material misstatement as per SA 315, when the accounting estimate, the high uncertainty is there and there is a significant event or transaction. You will be communicating to the CAM. To whom? To those charged with governance before you show it in the audit report. When you will not show in the CAM, that is, it is not a substitute for 4 things. Disclosures, 570, 705 and separate opinion. CAM will not be communicated if law or regulation prohibit. Possible adverse consequences are there and highly confidential information. CAM will not be communicated, and CAM should always be communicated to those charged with governance. Even if CAM is not there, you will be mentioning in the audit report that there is no CAM. Next is other information where applicable. For this only SA number you have to remember, that is SA 720. Responsibilities for the financial statements. There is auditor's responsibility and there is management's responsibility. Now, responsibility of management for the financial statements. What is management's responsibility? For the preparation and presentation of financial statements. And I also told you the internal controls, which is by whom, for whom? By the management, for the management. That is also the responsibility of the management only. Preparation of the financial statement in accordance with AFRF, and for such internal control as management determines it necessary. Assessing the entity's ability to continue as going concern. Who is going to see whether entity is continuing as going concern? Management will be seeing whether entity is continuing as going concern. As an auditor, we will be seeing whether it is appropriate or not. Oversight of the financial reporting process. This section of the auditor's report shall also identify those responsible for oversight of the financial reporting process when those responsible for such oversight are different from management. In this case, the heading shall also refer to those charged with governance or such term that is appropriate in the context of legal framework applicable to the entity. So the financial reporting process is nothing but the accounting process. There will be somebody to see the oversight of this accounting process. If it is different from management, you have to mention that in this paragraph, responsibility of the financial statements. Usually it will be those charged with governance. Auditor's responsibility. There are 3 responsibilities. What is it? Objectives of the auditor. Reasonable level of assurance is high level of assurance, but it is not a guarantee that misstatements can be due to fraud or error or both. Apart from this, the auditor's responsibility section to further talk about auditor will exercise the professional judgment and maintain the skepticism. Describe an audit by stating the auditor's responsibility. If SA 600 applies, describe auditor's responsibility in group audit. That means SA 600 is what? Using the work of an other auditor. If I am going to use the work of another auditor, in the responsibility of the auditor section, please mention Describe auditor's responsibility in group audit. Now, are you the principal auditor? Are you the other auditor? Like that, you have to describe your responsibilities. Now, when you're describing the auditor's responsibility, what is it? What and all are you talking about? This is SA 315, identifying and assessing the risk of material misstatement. This is also SA 315, understanding the entity and its environment. That is to obtain an understanding of the internal control system. To evaluate the appropriateness of accounting policy, to conclude appropriateness of going concern. That is 570, to evaluate overall presentation structure and content of financial statement. That is fair presentation framework. Is that clear? This is auditor's responsibility. 10th is location of the description of auditor's responsibility for the audit of the financial statements. The description of auditor's responsibility, where and all will be there. They are asking for the location of the description of auditor's responsibility. Where and all will this auditor's responsibility will be there. It will be there within the body of the audit report. It will be there within an appendix to the audit report, and any specific reference within the audit report to the location if there is any on the website. Just see here, after key audit matters, responsibility of management is there. Auditor's responsibility is also there. If you see, identifying and assessing the risk of material misstatement, obtaining an understanding of internal financial control, evaluate appropriateness of accounting policy, all of these points, did we see that? Conclude on the use of going concern, evaluate overall presentation structure and content, all of this we saw. Now it is there in the body of the audit report, and it will also be there in the appendix. Is nothing but the annexures. So annexure A, auditor's responsibility, is it there again? So the location is there in 2+1 places. One is the body of the audit report, second is the annexure, that is the appendix to the audit report, and third is a specific reference within the audit report to the location of such a description on the website if it is appropriate. So 2+1 you remember like that. What is this other reporting responsibilities? This is nothing but your CARO. That means apart from what and all I have to do from standards on auditing, is there something else that I have to report on? Yes, CARO is giving 21 clauses. You have to report on those 21 clauses compulsorily. That is your other reporting responsibilities. The next one is signature of the auditor. Now here, along with the signature, there must also be membership number, firm registration number. The partner or proprietor signing also needs to mention the membership number assigned by ICI. Here, is it there? Yes. For Chaturvedi and Shah, for Deloitte Haskins, oh, there are two partners. Joint auditor. Joint auditor for Reliance Industry. Now, they are talking about firm registration number. Is it there? Yes, for both of them it is there. Name of the partner, it is there. What other things they asked? Membership number, is it there? Yes, for both the partners it is there. This is what? Signature of the auditor. The next is place of signature. The auditor's report shall name specific location, which is ordinarily the city where the audit report is signed. Place of signature is where both are in Mumbai. That means both are signing the audit report in Mumbai. They can ask questions like, I am signing in Mumbai, but I did the audit procedures in Bangalore and I gave the report in Chennai. So what should be the location? Whenever they sign, here sign is only given, correct? Like that you remember. This is the signing place. So where they are signing, that place has to be given here. Like that you can remember, guys. That is place of signature. Next is date of auditor's report. The audit report shall be dated no earlier than the date on which the auditor has obtained sufficient appropriate audit evidence. Because the flow is like this. The engagement letter is being prepared. Then the auditor will be doing all the audit procedures. He will be getting all the audit evidence. Then he will reach the conclusion. Based on the conclusion, he will be giving an opinion. This opinion will be communicated in the audit report. This audit report will be given to the management. Management, along with all the other things, they will be preparing something called as annual report, and that annual report, which is inclusive of the audit report, will be given to the members, that is the shareholders. This is the flow. So the date of the audit report is here. They are saying it should always be after the evidence date. Isn't that correct? If you know the flow, this is just common sense. The audit report shall be dated no earlier than the date on which the auditor has obtained the sufficient appropriate audit evidence. All the statements that comprise financial statements, including related notes, have been prepared, and those with the recognized authority have asserted that they have taken responsibility for those financial statements. The last important one is called as UDIN. UDIN is a 18-digit alphanumeric number. For this, I had an example called Prem Rajan and Associates, where Prem is a dropout CA, but he knows in and out. His father's signature he is using, but when he is introducing, he will say, "Hi, I am Prem from Prem Rajan and Associates." That means what? People will think that he is the partner. People will think that he is a chartered accountant. So, to curb the malpractices of non-CAs impersonating themselves as a CA, they got something called as unique document identification number. So, on any document, say Prem's father is also signing, no problem. At least you know that your signature is being used here. So, for any document, you go to the portal, you give details of the document, and then there will be a OTP which is sent to the phone of the member. Then that OTP will be given there, and then this UDIN will be generated. This UDIN has to be shown in the audit report. Is it given here? Yes. For him, separate UDIN. For him, separate UDIN. So for each signature that they are putting, there is going to be a unique document identification number. Is that clear, guys? Yes. With this, essay 700 and 701 comes to an end. 705, 706 shall we do tomorrow? Starting off with essay 600. Quickly, let's go through the mind map. There are three definitions here. Who is a principal auditor? Who is an other auditor? And what is a component? What is the procedure by principal auditor that he has to follow? And lastly, three important section numbers are given: 128 subsection 1, 128 subsection 2, and 143 subsection 8. First, quickly, let's finish off the section numbers. 128 subsection 1 of the Companies Act. What they are trying to tell? Basically, all the companies, including the branch offices of that company, should maintain the books of accounts and the financial statements. Where should they maintain? With the registered office. They have to maintain. Now, can they maintain this in electronic mode also? Yes, they can maintain this in electronic mode also. Now, sometimes it might not be possible to keep the books of accounts and the financial statements in the registered office. In that case, they can keep it in any other place, but that other place should be in India. Any other place in India. Now, if they decide to keep it in any other place in India, a person who is going to the registered office must know where that other place is. So, a notice in writing giving full address of that any other place has to be filed with the registrar. Notice in writing has to be filed with the registrar. Is that clear? Now read through the text. Every company shall prepare and keep at its registered office books of accounts and other relevant books and papers and the financial statements for every financial year, which gives a true and fair view, and including that of branch office or offices. Such books shall be kept on accrual basis and accordance to double entry. All or any of the books of accounts can be kept in such other place in India as the board of directors may decide. The company shall then file with the registrar a notice in writing giving a full address of that other place. Company may also keep such books of accounts or relevant papers in electronic mode in such manner as may be prescribed. Section 128 subsection 2. This is with regard to branch offices. This branch office, whether it is in India or outside India, has to comply with section 128 subsection 2. Sorry? 128 subsection 2. Deemed to have complied with 120. Yeah, I am coming there. Very fast. Branch office in India or outside India is deemed to have complied with 128 subsection 1 if they maintain the books of accounts. Where should they keep it? In registered office? No, they can keep it with themselves. At the branch itself, they can keep it, but they have to file the summarized returns with the registered office. They can also file the summarized return in any other place. However, a notice in writing has to be given to the registered office with the full address of that any other place. Is that clear? Yes. Now this 128 subsection 2 is for branch office. 128 subsection 1 is for all companies including the branches. If it was me, I will ask questions something about branch and I will say in India, outside India. I will confuse like that. You need to be extremely clear. Yes, is that clear? Here any other place means it is only in India. For branch office, it can be either in India or outside India, because that branch office, even if it is outside India, the holding is still here only. The corporate office is still here only, in India only. So we still have control over that. So they still have to follow the Companies Act. Is that clear, guys? Before 143 subsection 8, let's finish off the definition of who is that principal auditor, who is that other auditor, and who is a component. So basically a principal auditor is a person who has the ultimate responsibility for that financial state, for that audit report which is being prepared. Now for some cases he might not be able to go to the site and he might not be able to do the audit procedures. In that case, he will send another auditor to go and conduct the audit procedures. That is only that other auditor. Now when he is doing the audit procedures, that can be for a division, that can be for a specific branch, that can be for a specific subsidiary, that can be for a specific joint venture or associate or any other entity, whosever the financial statements are included in the financial statements as a whole. Is that clear? Now principal auditor means the auditor who has the responsibility for reporting on the financial information of any entity, when that financial information includes the financial information of one or more components which is audited by the other auditor. Now some other auditor is going to audit one or more components. In that case, the ultimate responsibility is with one auditor only. That one auditor is called as principal auditor. What is a component? It means a division or a branch or subsidiary, joint venture, associated enterprise or any other entity whose financial information is included in the financial information which is audited by principal auditor. If you notice here, from here they are giving connection to component, and again from component they are giving connection to the principal auditor. Now from principal auditor they also use the terminology other auditor. So from here again there is a connection here, and from other auditor to principal auditor. Who is an other auditor? It means the auditor other than principal auditor who has the responsibility for reporting on the financial information only of the component which is included in the financial information which is audited by the principal auditor. So see where and all the connection is going. From principal auditor it is going to other auditor and also component. From component it is going to principal auditor. From other auditor it is going to principal auditor. Isn't that simple? Yes, please remember the references which is given in the definition. The next is procedures by principal auditor. What should the principal auditor do? He should basically see whether the work of the other auditor is proper or improper. He should see whether the sufficient appropriate audit evidence the principal auditor has to get with regard to the other auditor's work, whether it is adequate or not. For this, how is he going to do? The first one, he will advise the other auditor before itself. Listen here, this is the reason why I have asked you to go and finish off these branches. I am going to use this report in this area. So please make the report accordingly. Like that, I am going to talk about his work, how he has to use the work, how I am going to use his work. All of those things I will be communicating to him. The second one, if there are any inter-component transactions, he will not know because he is inside the branch. Say for example, I told you Sri Krishna Sweets is a company which has 47 branches in Chennai. Now say out of the 47 branches, the 7 branches is done by other auditor. Now in another branch, if Mysurpa is not there, what they will say? Will they say Mysurpa is not there, you can go today, come tomorrow? Will they say like that? Please wait for 2 minutes, sir. Pakkathile vera branch irukka. I will go there and I will get the Mysurpa and I will give it to you. Like that they will say. And there will be intercomponent transactions which is happening. Mysurpa is moving from one branch to another branch. In my branch, I should not show this as a purchase, and in that branch, they should not show it as a sale. But for the other auditor who is right there, he will think that this Mysurpa has been sold to somebody else, whereas it is actually only a intercomponent transaction. Always when you are inside, you will not know this, but when you have the bird's eye view, you can easily find out from where this is going, and the principal auditor will educate the other auditor with regard to how to identify this intercomponent transactions. Is that clear? The last one is, if I don't give a timetable to the other auditor, he will take his own sweet time. So I will also be giving a timetable. There are 3 things here which I will be saying. First one is use of the other auditor's work. I will tell before itself in the planning stage. Second, how to identify the intercomponent transactions, I will be educating to the other auditor. And third one, I will also be giving a timetable. And apart from that, how are the reporting requirements, accounting reporting requirements, auditing reporting requirements, or any other reporting requirements if it is there, I will be communicating that also with the other auditor. Is that clear, guys? Everybody, is that clear? You all had breakfast. Then you can shout. Is it clear? Very good. So we saw definition, these 3 definition. Then we went to procedure by the principal auditor. These 3 in one point and a single one in the other point. Next we went to the sections 128 subsection 1, 128 subsection 2, and we are yet to do section 143 subsection 8. This is basically talking about the duties and powers of the company auditor with respect to the branch auditor. So if there is a branch office, if it is there, who and all can be appointed as the auditor for branch office, you have to understand. The company auditor itself can be appointed to the branch auditor, and any other person as per section 139, that is appointment of auditors, as per section 139, any person can be appointed as the auditor for branch auditor. Or if this branch office is located outside India, then a CPA or any other person who is outside India, according to their laws and regulations, can be appointed as the branch auditor of this specific branch office. Now whoever you are, I don't care whether you are coming through this route, 139 route, or whether you are a company auditor, or whether you are a CPA, or whether you are any other person, this branch auditor has to prepare a report, and this report has to be given to the company auditor. One thing which you have to note here is, they are not using the terminologies principal auditor and other auditor here. They are using branch auditor and company auditor because this is Companies Act, section 143 subsection 8 of the Companies Act, where they are giving a reference to the Companies Act. In Companies Act, they will not talk about principal auditor, other auditor. That is only in SA 600. So Companies Act, how will they say? They will say company auditor and branch auditor. Duties and powers of the company's auditor with respect to the audit of the branch or branch auditor. Where a company has a branch office and the accounts of that office shall be audited either by auditor appointed for the company or by any other person as per section 139. If branch office is situated outside India, accounts of branch auditor will be audited by company's auditor or by any other person duly qualified to act as an auditor in accordance with the laws of that country. The branch auditor will prepare a report on the accounts of the branch which is examined by him, and he has to send to the auditor of the company, who then will have to deal with that report by himself. Is that clear? Section SA 600, very small, just 3 section numbers, procedure by principal auditor, and 3 definition. If they ask question from SA 600, you should be thankful. Easy to score, yes or no? Very easy to score. So quickly I will give you 10 minutes. Read here itself, discuss with your friends. Happy morning, guys. I hope all of you had breakfast And I hope the breakfast was not pongal and vadai. Are you all ready for today's class? Yes. Yes, SA 500. Let's quickly see the mind mapping which is there. What is the meaning? Information contained in accounting records, information used as audit evidence, audit procedures, nature and timing of audit procedures, types of audit evidences, relevance and reliability. What is the meaning of relevance? What is the meaning of reliability? Sufficiency and appropriateness. What is the meaning of sufficiency? What is the meaning of appropriateness? Factors affecting sufficiency. Sufficiency basically means what? The quantity. So what are the factors which is going to affect your quantity of audit evidence? Audit procedure for obtaining audit evidence, audit trail, selecting items for testing. If there is inconsistency or doubts about the reliability as an auditor, what we have to do? Who is this person called management expert? How are you going to evaluate the audit evidence? And lastly, we will be seeing what are assertions and types of assertions. Is that clear? Now I'm going to start off. What is the meaning of audit evidence? Now what is the flow of going and doing the audit? As an auditor, after signing the engagement letter and all, he will be doing the audit procedures to get the audit evidence. Now based on this audit evidence is what is he doing? He is giving his conclusion. Now based on that conclusion, he is expressing an opinion. Now the meaning of audit evidence is the information used by the auditor in arriving at the conclusion on which auditor's opinion is based on. For this only I told you the flow, audit procedures he will be doing to get something called as audit evidences. Based on this he will draw the conclusion and finally he will be giving the opinion. So for this he is saying the information used by the auditor in arriving at the conclusion on which his opinion is based on. Audit evidence includes two things, accounting records and also other information. What is that information which is contained in the accounting records? Accounting records can be all your accounting entries and all the supporting records. It can be the invoices, it can be the contract, it can be the agreement, it can also be your Excel sheet, because sometimes the books of accounts will be in the software and separately in Excel sheet they'll have the books of accounts too. That means what? There is some fraud which is happening. If two parallel books of accounts are there, that means some fraud is happening. Now, how are you saying? How did you arrive at that conclusion that fraud is happening? Because of that Excel sheet, which was an audit evidence for you. So, information contained in accounting records also includes worksheet and spreadsheets, and finally, general and subsidiary ledger adjustments. What is the general and subsidiary ledger adjustment? What is the general and subsidiary ledger adjustment? I gave an example for that. Let me see. Okay, furniture and fittings. So I said, it's written here. So you saw, correct? So furniture and fittings, I told you, I gave you an example. That is a main ledger. That is a general ledger. Now under furniture and fittings, so many items are there. This table is a furniture. Projector is what? Furniture. Chair is what? Furniture. Writing pad is what? Furniture. So all of these sub-ledger adjustments will happen. So if there is any adjustments which is happening, that also will be as audit evidence in accounting records. Now apart from this, there is a lag. Let's come back. Till where did we see? Accounting information which is contained in accounting records, that can also be audit evidence, and other information can also be audit evidence. What is that other information which is going to be audit evidence? The minutes of the meeting, written information from trade receivable and trade payable, also called as external confirmation, manuals, internal control manuals, or any other information, whatever you want. If you see something, then that becomes an evidence. Evidence means proof, adharon, that is your evidence. Now in the first Roman number we saw what is the meaning, information contained in accounting records and other information. Now going further, information to be used as audit evidence. Now if information is given by the entity, what and all will you see? If information is given by a management expert, then what and all will you see? If information is given by entity, what is the keyword? CAS, CAS. What is that CAS? C stands for completeness, A stands for accuracy, and S stands for whether it is sufficient. Now see, completeness means what? Completeness means whatever that the management is saying, it is fully complete in nature. Like how you all are saying that you are coming to class. Correct? To your parents, you are saying you are coming to class. But after class, you will be going, roaming around, and then if you are going home, if mother asks where you went, what you will say? Class. That means the information that you are giving is not complete. It is not false. It is true, but it is not complete. Like that, whatever information the management is giving, it has to be complete, it has to be accurate, and it also has to be sufficient. If information is given by the expert, now we have to see who is that expert, whether he is employed by the entity. Is somebody able to influence that expert? Why do we need an expert? We ourselves are expert. Why do we need an expert? What physical verification of asset? Expert means what? Other than accounting and auditing, somebody else will come and do their job. Example, engineers. In limitation of audit, there was one thing called, we will not be saying whether the civil structure is this much age. We don't know the complexity of the machine. We don't know whether it will work or not. So all those things we don't know. For that, somebody else will come and say. How do we know that a machine is 10 years? We are doing depreciation of 10 years on machine. How do we know that this machine is really going to be there for 10 years? We will never know. We cannot identify. Somebody else will come and say that this will be there for 10 years. We will believe his valuation report and we will proceed forward for depreciation. Like that, if any information is given by management expert, then you will be seeing the complexity of the matter, the risk of material misstatement, availability of alternative sources. Okay, one expert is saying like this. Now I have one engineer in my team itself. Now I can ask him to go and do alternative sources. I can ask whether management expert is employed by the entity, extent to which management exercise control or influence over the work of management expert, whether management expert subject to technical performance standard, auditor's knowledge and experience of management experts field of expertise, and previously if I have worked with him, obviously I will be more comfortable. So auditor's previous experience of the work of that expert. There are 10 points which is given here for if information is coming from the management expert. If information is by the entity, then just 3 points, that is CAS. Is that clear? What are the audit procedures? AROR is the audit procedures: external confirmation, inspection, inquiry, reperformance, observation, analytical procedures, and recalculation. The terminologies are there which is very, very important, which you have to remember for each of the audit procedures. The first one is what? Inspection. Inspection means you are going and examining that record, examining that document. That is your inspection. Examination of records or documents, whether it is internal or external, whether you are examining in paper form or on electronic form or any other media, or physical examination of an asset. You are going there and seeing whether that asset is really existing or not. So that is also inspection only. What is inquiry? Seeking the information from knowledgeable persons. Don't seek information from the clerk. Say you go to bank outside, clerk is there. You can't ask that clerk, asking him what is the amount balance which is there. He will not know the information. So even if he says some information, it is definitely false. So inquiry means you have to seek the information of knowledgeable persons. Now if you go and ask him, you are just taking the mic and saying unga toothpaste la uppu irukka. He is saying uppu irukku. Now can you take that as audit evidence? Because it is oral evidence. Can you take that as audit evidence? Yes, sir. You can take that as audit evidence. Just that reliability on that audit evidence will be low, but that is also audit evidence only. Now you all tell me, auditor will consider whistleblower complaints. Yes or no? Whistleblower complaints will be coming orally only. Employee will be telling you orally only, but still you are considering that as an auditor. So this inquiry can be formal written inquiry, or it can also be informal oral inquiry. Both ways it is possible, because as an auditor we can't always be like, oh nee pesriya eldi kudu. How can we say that? It is not practically possible. So whatever he says, we will be accepting that, we will be taking that as an evidence only. What is the meaning of observation? They are doing some process. You are looking into the process, that is called as observation. Looking at a process or procedure which is performed by somebody else. What is external confirmation? Direct written response to the auditor from a third party in paper form or in electronic or any other medium. Now, in external confirmation, they did not say oral evidence. Did you note that? Only for inquiry, you're going with mic and you're asking toothpaste uppirika, they will be telling orally to you. But for external confirmation, third party, whatever he's saying, it has to be a direct written response only. Is that clear? What is the meaning of re-performance? Now they are doing some job. We are again doing that job to see whether it is correct or wrong. Say for example, somebody is putting the journal entry. Now from the journal entry, automatically it will go to ledger. From that ledger, automatically it will go to trial balance. From the trial balance, automatically it will go to trading P&L and balance sheet. Yes or no? Now the management has framed this internal control saying this person, once he enter, automatically the software is going to do all the other process and give you the balance sheet. Now as an auditor, we will see whether the software is working properly or not. So I will do a re-performance activity. I will put a dummy journal entry. As if I'm paying salary, dummy entry I will put. Rate I will just put as 10,000. Later I can cancel that journal entry. No issues. Or I'll delete that entry. No problem. So why am I putting that dummy entry? To see whether the system is doing it properly. Yes or no? That is re-performing an activity. What is the meaning of recalculation? Checking the mathematical accuracy of documents or records. That is the recalculation. That means computer will say depreciation 10% means this is the depreciation for all the PPE. Now we as auditor, we will see the PPE figure and we will be putting the calculator what is the amount of depreciation, and so that we can verify it with the computer. That is recalculation. What is the meaning of analytical procedures? Plausible relationship between financial and non-financial data. Example, you are having a room. Now this room is 1000 square feet. Now with 1000 square feet room, you are able to make a sale of 1 crore. Now I move to a huge place, 10,000 square feet room. Now with this 10,000 square feet room, how much sale I should make? At least 10 crores I should make, but they made 90 lakhs. Is there a problem here? Yes. Why? Because you compared a non-financial data, that is the square feet, with your sale, that is a financial data. You are finding some kind of a relationship between non-financial data and financial data. To find relationship between two financial data, that is also analytical procedures. Say for example, the marketing expenses is 0. With that I made sale of 1 crore. Marketing expenses became 10 crores. Now how much should my sale be? It should be minimum of 10 crores at least to take my marketing expenses back. Yes or no? So if your marketing expense increase, automatically your sales should also increase. This is a relationship between two financial data. So plausible relationship. Plausible means what? Possible. Possible relationship between financial and non-financial data is called as analytical procedures. Now you all tell me, what are the audit procedures? Error. What is E? External confirmation I. Inspection I. Inquiry R. Reperformance O. Observation A. Analytical procedures, and last R is recalculation. I hope you remember the keywords for each of the audit procedures. Yes? Procedures is done. I'm proceeding forward to nature and timing of audit procedures. The nature and timing of audit procedures may be affected by the fact that some of the accounting data and other information may be available only in electronic form or only at certain points or periods in time. So all of these things are going to affect your audit evidence, how your audit evidence is going to be there, and whether it will be there throughout the period or whether it is going to be there only at a particular point in time. Certain electronic information may not be retrievable after a specified period of time. Say for example, they have a system for confidentiality purpose. I will be entering the data, but you can't see the data. So how is that information going to be as audit evidence? In Mind and Company itself, if you see, if auditor comes and asks, who are your clientele? Can I give the clientele? No, I have to maintain utmost confidentiality. I cannot give the clients outside. So certain information will not be retrievable at all. Here they are saying it will not be retrievable after a specified period of time. In some cases they will take the backup file, somebody will destroy it. In that case, after a specified period of time, you will not have the data. What are the types of audit evidences? Data assassin will not give. You check how you want. Your auditor will not give the client data. There is no debtors. You pay, then you take the consultation. How debtors will come here? There is no debtors for you to verify that. Now, types of audit evidences, but auditor will want to see whether there is real sales or fake sales. For that, they'll want to do the external confirmation. We will not allow for that. You do any alternative audit procedures. No chance. What is the alternate audit procedures? You can inspect the bank account, whether really sales has happened or not. That is the alternative audit procedure. So, if something is not there, auditor always has to go for the next one. Now the next one is types of audit evidences depending upon nature, depending upon source. Depending upon nature, how many are there? 3 are there: visual, oral and documentary. Visual means you are seeing something, oral means you are hearing something, documentary means like external confirmation, they are writing and giving it to you. Depending on source, it can be either internal or it can be external. Which is more reliable? The external is obviously more reliable, you all know. Now depending upon nature, which one is more reliable? Documentary is more reliable because you will tell something now and later you will change it. So oral is not reliable. Next is relevance and reliability. Before we go to relevance, let's finish off quickly the reliability. Reliability means what? The trust. If they are giving some information, you as an auditor want to know whether you can trust on that information or not. So information which is used as audit evidence should be reliable in nature. When will it become reliable? You all tell me. It will become reliable when if I take the information from that management itself, or if I take the information from third party. From third party, that means if it is obtained from independent sources, you will say that it is reliable. Now you tell me one more thing. The internal controls are there. The internal controls are operating very effectively and efficiently. You saw that, you tested that, and you are convinced with the internal control. Now if you get the information, will you rely more on that? Yes or no? So whether the internal controls are operating effectively, you will be seeing. If the internal control is operating effectively, you will rely more on the data. For example, let me tell you, the financial statements is prepared and presented by the management. Now they have an internal control system that only, what's your name? That Almara, she can only enter that journal entry in the system. Now if she is entering the journal entry, the system should take, because she is going with that user ID, login, password and all of those things. Say for example, I am going, should it allow? It should not allow, because only one person should have access to the journal entry. Now the auditor is going and testing in somebody else's login. It is allowing for everyone. Will the auditor believe whatever information is produced by the system? No, the reliability instantly drops once he notices that the internal control is weak. That is the reason why the reliability is increased when the related controls are effective. The next is, say for example, the auditor, I am going and getting the information from you, or I am sending my assistant and getting the information from you. Now which is more reliable? If I myself go and get the information, that only is more reliable. Audit evidence in documentary form, you already told me that it is the most reliable. Audit evidence in original document is more reliable than photocopy, that is Xerox and all. Now 5 points are there. These 5 points are basically telling you when your trust is going to increase. What are those 5 points? The first one is, if it is obtained from independent sources, if the relative controls are effective, if it is obtained directly by the auditor, if it is in documentary form, and lastly, if it is original document. In these 5 cases, your reliability automatically increases. What is the meaning of relevance? The relevance means there should be some kind of logical connection between the data. Like how I told you, marketing spend was 0, sale was 1 crore. Marketing spend itself is 1 crore. Now how much should sale be? It should be minimum of 1 crore at least this year, so that next year we will know 2 crores, 3 crores, like that it will keep going. So this is basically telling you that there is some kind of a logic in the data which is there in the financial statement. Once you start finding that logic, you will say that it is relevant. Relevance means logical connection. If the purpose of an audit procedure is to test for overstatement in the existence or valuation of accounts payable, testing the recorded accounts payable may be a relevant audit procedure. What they are saying here, if you are testing for overstatement, overstatement means, why these lines today, full tech disturbances. You can see it, correct? You can understand it. Overstatement means what? You are having a doubt that that client is giving extra information for you. Basically, in reality, it is only 1 lakh, but in the balance sheet, debtors figure is 10 lakhs. Now, if you have doubts of overstatement in existence or valuation, testing the recorded accounts payable may be a relevant audit procedure. That means, if you know that, if you think that this is overstated, if you do your audit procedures on this 10 lakhs, you will know exactly as to what is real and what is false. Yes or no? So, you can find out that real is 1 lakh and false is the remaining 9 lakhs. Yes or no? Now see the other scenario. You have doubts of understatement. Understatement means what? The balance sheet figure is 10 lakhs, but in reality it is actually 1 crore. You have doubts of understatement. In this case, can you do the audit procedures on this 10 lakhs? How will you tell which is real and which is fake? All of this is real only, but apart from this, something else is there. So there is no use of doing the audit procedures here. You have to do audit procedures on something else. So as an auditor, if you look for understatement in the existence, testing the recorded accounts payable will not be relevant. But testing such information as subsequent disbursement, unpaid invoices, supplier statement, unmatched receiving report may be relevant. All of these are something else. So you will be doing the audit procedures on something else. Did you understand this understatement and overstatement? If the auditor feels it is overstated, now what figure he has is something is real and something is fake. Then he can do audit procedures on that figure to dissect what is real and what is fake. Now if he is thinking this figure is understated, that means apart from this something else is to be added. Now there is no point doing audit procedures here, because you have to do audit procedures on that something else and not this itself. Did you understand now? That is relevance for you. Relevance deals with logical connection with purpose of audit procedures and where appropriate the assertion. Now read the example, you will fully understand. If the purpose of an audit procedure is to test for overstatement in the existence or valuation of accounts payable, testing the recorded accounts payable may be relevant for audit procedures. Now on the other hand, testing for understatement of accounts payable, testing the recorded accounts payable will not be relevant, but testing some other information will be relevant in that case. Is that clear, guys? A given set of audit procedures may provide audit evidence that is relevant to certain assertions but not to others. Now you have to know what is the meaning of assertion. What is assertion? What is the meaning of assertion? Assertions are basically representations which are made by the management. Assertions can be explicit or assertions can also be implicit in nature. Now there will be one flow chart which is given here. Assertions are two types, positive assertion and negative assertion. Positive assertion means again split into two, implicit and explicit. Negative assertions again split into two, implicit and explicit. Now what is positive implicit assertion? For positive implicit assertion, just see this example which is given here. When we find in the balance sheet an item under current assets reading as cash in hand rupees 10,000, the obvious assertion that would strike the mind is the following. Positive means I am saying something is there. Negative means I am saying something is not there. Now when you see this cash in hand rupees 10,000, is it a positive assertion? Yes. But when you look at this figure, they are implying that the firm had rupees 10,000 in hand in notes and coins on the balance sheet day. That the cash was free and available for expenditure to the firm. All these are implications for that one figure. That the books of accounts show a cash balance of identical amount at the end of the day on which balance sheet figure is drawn up. So all of these 3 points is what this cash in hand rupees 10,000 is basically implying to say. Are they saying that it is there or is it not there? It is there. So it is positive implicit assertion. That is the cash in hand. Is that clear? Explicitly, if I am going to give you all the information and I am saying it is there, that is positive explicit assertion. For example, 12% secured loan of 4 lakhs. This says that I have taken a loan of the amount 4 lakhs and the percentage for that loan is 12%. All the information explicitly I am giving you here itself. This is positive explicit assertion. For negative assertion, if I say something is not there, I have to say explicitly. For contingent liability, if it is not there also in the disclosures, notes to accounts, you have to mention that there is no contingent liability. You are saying something is not there and you are saying that explicitly, that is negative explicit assertion. Now you see this balance sheet, land, furniture, fixture and all the items are there. But about building, nothing is given in the balance sheet. That means what? Building is not there. So when you look at this balance sheet, they are implying that building is not there. That is not there means it becomes a negative assertion. This is an implicit assertion. So it is a negative implicit assertion. Are you clear with assertions? Assertions means they are representations which are made by the management. It can be positive or negative. It can be implicit or explicit. Positive means they are saying it is there. Negative means they are saying it is not there. Explicit means வாய் விட்டு சொல்றான். Implicit means சொல்லாம சொல்றான். Is that clear? Now, for P&L and balance sheet items, there are a few assertions which you have to remember. What are those assertions? Occurrence, completeness, accuracy, cut-off procedure and classification. Here, existence, rights and obligation, completeness, valuation and allocation. This is for balance sheet items. This is for P&L items. Is that clear, guys? This is for disclosures, notes to accounts. Occurrence and rights and obligation, completeness, classification and understandability, accuracy and valuation. Full clarity of assertion you will get when we are doing items of FS. Because there for each item as an auditor, how will you put the tick mark for each of the assertions? You will be doing that activity. Is that clear, guys? Can I move forward? Now we are done with relevance and reliability. Now we have to see what is sufficient and appropriate audit evidence. Sufficiency, as you all know, is the quantity of audit evidence that is required. Now you please tell me, risk of material misstatement means what? Risk of material misstatement means what? Misstatement means mistake. Material means important. Risk of material misstatement means a risk that an important mistake can happen here. Yes or no? Then I changed misstatement. For that separate definition is there. Difference between amount classification presentation disclosure as per AFRF and the difference between amount presentation classification disclosure which is as per the books of accounts, that is as an item in the books of accounts. Now risk of material misstatement meaning you know. Yes or no? With that meaning you tell me, if risk of material misstatement is high, how many audit evidences will you get? Lots of audit evidence or minimal will do? You will get lots of audit evidence. If risk of material misstatement is low, then you will go for lower audit evidence. If something is material, materiality is high, then you will go for more audit evidence. If something is not material, then just one audit evidence is enough. Now, for all homogeneous transactions, homogeneous means everything is similar to each other, everything is same. In the population, 1000 is there, but all are similar to each other. In that case, as an auditor, should you test each and every item, or are you satisfied with a small sample? So audit evidence low, if it is there also, it is okay. Heterogeneous transaction, each and every transaction is different from each other. So how will you make sure that sample is representative of the population? You will select a bigger sample in that case. So heterogeneous means audit evidence will increase. That only is given here under sufficiency and appropriateness. Sufficiency has three factors which is going to determine your audit evidence levels. Those three factors are only risk of material misstatement, materiality, size and characteristics of population. If you see materiality, less evidence will be required in case assertions are less material to the users of financial statements. On the other hand, if it is material, then more evidence is required. Risk of material misstatement, less evidence will be required in case assertions that have a lower risk of material misstatement. Size and characteristics of population, less evidence will be required in case smaller homogeneous population. Larger heterogeneous population means audit evidence will increase. Is that clear? Going to the next part, audit procedures. We saw sufficiency. Did we see appropriateness? What did we see appropriateness? No. What is relevance and reliability? That is appropriateness. Under sufficiency, those factors are only these three factors, nothing else. Is that clear? For reliability, again you saw factors which is going to affect your reliability. 5 factors. Obtained from independent sources, original document, documentary format, directly by the auditor itself. Internal controls are effective. Did you get the flow? Yes. What is sufficiency? What is appropriate? Under appropriate, we have relevance and reliability. Under sufficiency, we have 3 factors. Now, audit procedures for obtaining the audit evidence. There is risk assessment procedure and there are further audit procedures. Further audit procedures again split into 2. Test of controls and substantive procedures. Substantive procedures again split into 2. Test of details and analytical procedures. Test of details again split into 2. Test of transactions and test of balances. Test of transactions is nothing but vouching. Test of balances is nothing but verification. For now, this much is enough. Essay 330 mind mapping is there, correct? That mind mapping itself is this only. There we will be seeing what is each of the following. Now, what is this risk assessment procedure? Risk assessment procedures are audit procedures. For what are you doing? You will be studying this in essay 315. You will be studying in essay 315. What are the risk assessment procedures? What is risk assessment procedures? They are the audit procedures which is performed to obtain an understanding of the entity and the environment. What is the name of essay 315? Identifying and assessing the risk of material misstatement through understanding the entity and its environment. So this is the audit procedures which is performed to obtain an understanding of the entity and the environment. Finally, for what? To identify the risk of material misstatement. To identify and assess the ROM at financial statement and assertion level. What is this test of controls? These are audit procedures designed to see whether the internal controls are operating effectively and efficiently. To evaluate the operative effectiveness of the controls in preventing, detecting and correcting the material misstatement. Is that clear? What are the substantive procedures? These are the audit procedures which is designed by the auditor to detect the material misstatement. That is the substantive procedures. Now this test of control is by whom? Test of control is by whom? This also is by the auditor only, because internal control is framed by the management for the management. Now as an auditor, we want to see whether internal controls are operating effectively so that we know whether we can trust that audit evidence. So that testing of the internal control is only the test of control. So we will be doing audit procedures to see whether internal controls are operating effectively and efficiently. That means whether it is able to prevent, detect and correct a material misstatement. Then we went to substantive audit procedures. What is audit trail? It is a documented flow of transaction. The financial statements will be prepared and presented by the management and it will be given to the auditor. Now when the auditor sees one information from the financial statements, debtors 1 crore. From where did this debtors come, sir? It came from sale. Can you show me the sale, sir? Yes, I will show the sale. Now, where did the sale happen, sir? Here only, In this building only the sale happened. Can you please show me the invoice? Yes, I will give you the invoice. Like that, you are going back in a document format, that is documented flow of transaction. So here you will be seeing how that source document, that is the invoice, is getting translated into an accounting entry, and from there it is getting inserted into the financial statement of an entity. Now audit trail does not only mean in terms of accounts but also the log on log off activity, that also is audit trail. Now people will show their access card and they will go inside, they will again show the access card and come out. Now salary, how is it done? Based on the number of hours they worked. How will I get the number of hours they worked? Now I'll take that log as to how many hours he is inside the office, how many days he has actually come to office. I will take that log. That log is also called as audit trail only. This is basically like record keeping evidences, events, procedures or operation, because their purpose is to reduce the fraud or error. Is that clear? Selecting the items for testing to obtain the audit evidence. Selecting all the items, selecting specific items. Can you select all the items? No, usually it is not possible for you to select all the items. But there are few circumstances where you have to select 100% of the items. What are the circumstances? Population is small number of large value item. Irukkarade only 3 items. 3 sales bill only are there. 3 crores, 5 crores and another 5 crores. Only 3 are there. How will you select the sample here? You will be testing all the 3 invoices for this company. Small number, only 1, 2, 3 of large value items. There is a significant risk and other means do not provide sufficient appropriate audit evidence. You tried alternate audit procedures, additional audit procedures, you are not able to get sufficient appropriate audit evidence. The repetitive nature of a calculation or other process performed automatically by an information systems make 100% examination cost effective. Or if there is some high value or key items, or what I will say, if there are so many invoices, 10,000 invoices are there. Now I will take an amount which is immaterial for me. What is that amount which is immaterial for a 4,000 crore company? 10,000 rupees, less than 10,000 or less than 1 lakh, I will not test any invoice. After 1 lakh, whatever is there, you show me all the invoices. Like that I will be testing 100% only in this area. So here, all items over a certain amount or items to obtain the information, all of these are points for 100% examination is appropriate. Inconsistency in or doubts over the reliability of audit evidence. Now what are they saying? You have the audit evidence, source 1 is inconsistent to source 2. That means what? You are seeing that balance sheet figure is debtor 5 lakh is there. You are doing an audit procedure, you are seeing the audit trail, it came from sales, everything is pakka, you saw the invoice also, you inspected the documents, everything you did. Now you are confirming that 5 lakhs is the correct figure. Now you are going for external confirmation. He is saying that I will give only 1 lakh. I cannot give 5 lakhs. I have already paid the 5 lakhs. I don't care. I don't know. You take care. Now this is talking about inconsistency in the audit evidence. That means from one source of audit procedure, I got the evidence as 5 lakhs. In another source, I am getting the evidence as 1 lakh. In that case, as an auditor, what should I do? What should I do? Do another audit procedure, as simple as that. Do an additional audit procedure. If audit evidence obtained from one source is inconsistent with that obtained from another, or if the auditor has doubts over the reliability of information to be used as audit evidence, auditor will determine that modification or addition to audit procedures are necessary to resolve the matter. Who is management expert? An individual or organization who is possessing expertise in field other than accounting or auditing, whose work in that field is used by the entity to assist the entity in preparation of the financial statements. Now when you are relying on the work of management expert, you have to see all of these things. Already we saw 10 points. Now these are additional: competence, capability, objectivity, understand the work of expert, appropriateness of that expert's work. Now you have to evaluate the audit evidence. How you will evaluate the audit evidence? Now, the management has to enable them, enable the people in the organization to give the audit evidence. Now, as an auditor, we will be seeing whether we can draw any kind of reasonable conclusion from that audit evidence. Now, based on that conclusion, what are we going to do? We are going to give our opinion. The same thing will be given here. SA 500 audit evidence is applicable to all audit evidences obtained during the course of audit to enable the auditor to obtain sufficient appropriate audit evidence to draw reasonable conclusions on which to base the auditor's opinion. The first point is talking about from audit evidence. You have to get sufficient appropriate audit evidence to get conclusion, and based on that you will be giving your opinion. The auditor has to conclude whether SAI has been obtained to reduce the audit risk to an acceptably low level. What is the meaning of audit risk? Audit risk means what? The risk that an auditor gives an inappropriate audit opinion when the financial statements are materially misstated. When the financial statements, there is a mistake which is there, that means financial statements are wrong and the auditor says that it is correct. This is called as audit risk. That means an auditor making a mistake. Can we say like that? An auditor making a mistake when the financial statements are actually wrong. Is this an audit risk? Financial statements are right and auditor says that it is wrong. This is not an audit risk, because audit risk is only when financial statements are materially misstated. Why is this not an audit risk? Because nobody is going to rely on this and going to invest or give the loan, but people are definitely going to rely on your clean report, unmodified report, and people will give the loan, people will invest their money in shares, and all of those things will happen. That is why it is audit risk. The auditor has to conclude whether SAI has been obtained to reduce the audit risk to an acceptably low level, and thereby it enables the auditor to draw reasonable conclusion on which to base the auditor's opinion. Is that clear? So as an auditor, he has to conclude that SAI is able to reduce my audit risk. That means I will not be giving an inappropriate audit opinion. That means what? The audit evidence that I have is strong. I know that this is real. That is the reason why I am very confident with my opinion that I am giving. Is that clear, guys? Have we completed? Now quickly from the top, just 5 minutes I will show you how to study the entire standard. We started off with what is the meaning of SA 500. What is the meaning? Information which is used by the auditor in arriving at the conclusion on which the opinion of the auditor is based on. This includes information contained in accounting records and also the other information. What is that information contained in accounting records? What is information contained in accounting record? Worksheets and spreadsheets, invoices, contracts, agreements, general ledger and subsidiary ledger adjustments. What is this other information? Minutes of the meeting, written confirmation from third parties, and internal control manual, and any other information which is used. What is audit procedures? Error, external confirmation, inspection, inquiry, reperformance, observation, analytical procedure, and recalculation. What is this nature and timing of audit procedure? What did we see there? Nature and timing of audit procedures. We saw that audit evidence might be available only at a particular point in time or only for a particular period of time. That means backup record can be deleted. Like how I told you previously, Orkut used to be there. Orkut means forever it will be there. Anybody can view that information. Nowadays, Snapchat is there. In Snapchat, you have to hold to see the information. If you leave it, that's it, gone. Again, if you replay once, that's it, gone. Correct? Second time you can replay 10 times. For Snapchat, subscription is there. Really? Anybody has the subscription? Nobody has the subscription, correct? Very good. Don't go and waste your money on all these things. Why you have to see that person snap twice? First of all, waste app. Delete that app if you can. Now, next is what? Nature and timing of audit procedure. Basically, they are saying that it might be available only for a particular point in time and not for a particular. No, it might be available only for a particular point in time or for a particular period of time, and it will not be available forever. Next is relevance and reliability, sufficiency and appropriateness. What is sufficiency and appropriateness? They're talking about sufficiency is talking about quantity, appropriateness is talking about quality. When will you increase your quantity? When risk of material misstatement is high, when materiality is high, and for population, when will you increase? For homo or hetero? For heterogeneous transactions, you will be increasing your audit evidence. This is sufficiency. What is an appropriateness? Relevance and reliability. What is the meaning of relevance? You are looking for logical connection between the data. What is the meaning of reliability? Trust increases for the auditor. When will reliability increase? When it is obtained from independent sources, when it is obtained directly by the auditor, when it is an original document, when it is in documentary format, and if the internal controls are effective. In these 5 cases, your reliability will increase. Now we are done with relevance and reliability, sufficiency and appropriateness, factors affecting sufficiency, audit procedures, types of audit procedures. All of these is done. What is the meaning of audit trail? It is a documented flow of transactions. This is basically a record keeping activity, or log on log off items will also be part of your audit trail. This will basically translate the financial the source document to an accounting entry. So source document is your invoice, accounting entry is your journal entry that you are putting. It is translating this from here to there. That is only the audit trail. How will you select the items for testing? Will you test 100% or will you not test 100%? You will not be testing 100% usually. Only in some cases you will go for 100% testing. What are those some cases? When it is small number of large value transactions, key items over a certain amount, significant. What similar items? When there is a significant risk, you will go for 100% of. Next is, what is management expert? Who is that management expert? He is an expert in his field other than accounting and auditing. Inconsistency or doubts over the reliability. In that case, what should I do? I just have to go for additional audit procedures. Now I am evaluating the audit procedures. Now, how will I evaluate the audit evidences? How will I evaluate the audit evidence? There are 2 points which is given here. The first one is talking about it enables the auditor to obtain sufficient appropriate audit evidence which enables him to draw the reasonable conclusion based on which he will be giving his opinion. The second point is talking about audit risk. Next we went to assertions. There are 2 types of assertions, positive and negative assertion. Again, under positive assertion, implicit and explicit. Under negative, implicit and explicit. Explicit means outrightly they will tell you whatever they want to tell. Implicit means sollama he is going to tell you. Positive means he is saying something is there. Negative means he is saying something is not there. Assertions are basically representations which are made by the management. Is that clear? Then assertions specifically are there for P&L item, balance sheet items, and also for notes to accounts. Is that clear, guys? Just 7 minutes we finished that entire revision from top to bottom. Essay 501 is basically split into 3. What are those 3? Segment reporting is the third part. Litigation and claims is the second part. Inventory is the first part. Now quickly I will tell you all the points which is there in inventory. Now in inventory, as an auditor, we are bothered only about 2 things, that is whether inventory is really there or not, and inventory means what? It should be ready for sale. So what is the condition of the inventory? We are only bothered about 2 things, existence and condition of inventory. For this, the auditor will be doing audit procedures. Now audit procedures ideally has to be done when? For inventory, because inventory in sonnale the first thing which comes to your mind is physical verification of inventory. When should this physical verification of inventory be done? What reasonable interval? It should be done by the management at reasonable interval. As an auditor, when should we see whether the management is doing the physical verification of inventory? As on 31st of March, they are showing that stock is 10 lakhs. Really, whether stock is 10 lakh or not, auditor will want to know. So, as on 31st March, he has to go there and he has to see whether physical verification of inventory is done properly by the management. So, as on 31st March, he ideally has to go. But if that date physical count is not possible, then he will be selecting an alternate date and he will do the audit procedures on the intervening transaction. Now, what is this alternate day and what are the audit procedures and what is that intervening transaction? Say, for example, 5th of April, he is going and doing the physical verification of inventory. Now, whatever amount is there in 5th of April will obviously not match with the amount which is there as on 31st of March, yes or no? Obviously, it will not match. So, as an auditor, we get the physical verification of inventory as on 5th of April. We have to add something, subtract something and get the stock as on 31st March. What will you add? What will you subtract? Purchase. Now, simply if you add the sales and subtract the purchases from the books of accounts, is that correct? You have to verify whether this sale really happened or not. So, you will be doing audit procedures on this purchase and sales for you to verify that this figure that you are arriving is correct or incorrect. Is that clear, guys? So, physical verification of inventory is ideally is to be done on 31st of March. But in case at that date it is not possible, then the auditor will be selecting an alternate date and he will do the audit procedures on the intervening transactions. Say, for example, physical count is impracticable. Physical count is impracticable. That means the stock is in Pakistan. Can the auditor go there? Will you go there? No. So what should the auditor do? He will be doing alternate audit procedures, and finally if alternate audit procedures also he is not getting any information, then he has to use his weapon, that is modification SA 705. See, understand here, first he'll try to do the physical verification as on 31st of March. If he does it, well and good. If he's not able to do it, he'll select an alternate day. If he selects an alternate day, he has to do audit procedures on the intervening transactions. Now, if that physical count itself becomes impracticable, then he will go for alternate audit procedures. If in that alternate audit procedures also he is not able to get any information, then he will go for modification, that is SA 705. Next is impracticability because of nature and location. Some nowadays warehousing services is becoming extremely popular, yes or no? Say, for example, if you want to order my books also, the warehouse is in Pune, because here in Chennai, color book 10 rupees per printout. Is it possible to do it? No. Pune means only 1 rupee. So there they have a huge warehouse. In that warehouse they will keep the book. Now if you want to do physical verification of my inventory, that is the books, what I will tell? You have to go to Pune and do. Now if it is in Pune, you will definitely go. But if it is in Pakistan, you cannot go. In that case, it becomes impracticable because of nature or location. Now I told you example only for location. How can the nature of that inventory itself become impracticable? Say, for example, for the government military, they want to know how many guns are there, how many AK-47 is there, like that they want to know. Now how will you go there and see everything? It is not possible for you to not touch, not even go close by. Yes or no? So it is impracticable for you to do the physical verification. In that time, what will you do? You will ask for confirmation with that person who is at the warehouse. He will be confirming the quantity and he will also be confirming the condition. The confirmation from that warehouse person should come for the quantity and the condition. If possible, you will be doing the inspection, but if you are not able to go there and do the inspection, you will be going for other audit procedures. What is this other audit procedures? You have to remember acid. What is that acid? You will ask another auditor to go. If you have friend in Pune, then you can ask him to go to Pune. He is in Pune only, means he will ask him to go to that address and do the physical verification. You will ask another auditor to go. What is C? Collateral What is collateral? Pledged as collateral. Say inventory is pledged as collateral with somebody else. In that case, we have to ask him for the documents of that collateral. Internal controls. If the internal controls of that warehouse is operating effectively and efficiently, you will be satisfied that whatever information he is giving as part of the condition and the quantity, whether it is correct or incorrect. What is the D? The documents, any other related documents for this inventory, if it is there, you will be seeing that that is the other audit procedures that you will be doing. So it is impracticable because of nature and location. You will ask the person who is holding the inventory for the confirmation of the quantity and also the condition of the inventory, and after that you will be doing inspection or other audit procedures. Is that clear? Now what are the matters which are relevant in planning the attendance at physical inventory counting? You have decided, okay, Pakistan also I will go and I will do the inventory counting. Physical verification is very, very important. I will go. You have decided to go. Now, what are the matters which are relevant in planning the attendance? What are the matters? What is the nature of the inventory? You will have to see that. Stages of completion, that means whether it is at raw material stage, whether it is at work in progress stage, whether it is at finished goods stage. Stages of completion. Risk of material misstatement. If I know that ROM is high, definitely I will go there even to Pakistan and I will do the inventory verification. Anything else? Location. For me to do the physical verification, I need to know where I have to go and I have to do the physical verification of the inventory. What is the timing? How is the perpetual inventory records? What is the meaning of perpetual inventory? Inventory which is in live. That means whatever is happening there, everything is entered into the system. So if I see that system itself, I know exactly what is there in work in progress, what is there in raw material, and what is there in finished goods. In most of the cases, in food items, the work in progress, finding that is very, very difficult. I told you an example. Sri Krishna Sweets, Mysore Pa. They will be adding all the ingredients. As an auditor, can you say, stop, I want to weigh how much is here, I want to check the inventory. You can't do all those things. So if you are satisfied that they are having that perpetual inventory system, then you will just see the system and you will be like, okay, everything is as on track only. Anything else which is relevant in planning the attendance? Whether any expert opinion, whether it is required or not? Anything else? Internal controllers point is here. Internal controls, how are they? Are they operating effectively and efficiently? The auditor's experience, that will also tell him. Previously, I know all of these problems were there. So, I know exactly where to go and see the problem. So, the experience of the auditor. And finally, last point is adequate procedures. What are the procedures that I should do? Now quickly let's finish off the inventory. Inventory, you are going to see two things, that is existence and the condition. When inventory is material, the auditor will obtain SAE regarding the existence and condition by doing a physical count of inventory, attendance at physical count of inventory. The auditor will not be doing the physical verification of inventory. The auditor will be present there when the management is doing the physical verification of inventory. That is why they are saying attendance at physical count of inventory. Unless impracticable to evaluate management's instruction, observe the performance, inspect the inventory and perform the test count. If you are not able to do all of those things, then no one can save you. Otherwise, you definitely have to go and do the attendance at the physical count of inventory. Performing audit procedures over the entities final inventory records to determine whether they accurately reflect the actual inventory count. Now, attendance involves inspecting the inventory for its existence and the condition and performing the test count, observing the management instruction and obtaining as to reliability of count procedures. Case number 1. As on 31st March, auditor is unable to do it. Anything which is given as case is very, 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 very important. Case number 1. If auditor is unable to attend, then the auditor will observe physical count at an alternate day and he will perform audit procedures on intervening transaction. Whether changes in inventory amounts between the count date or date and the final inventory records are properly recorded, included perpetual inventory records are properly adjusted, reliability, reasons for significant influence. What are they saying here in this point? Whether changes between count date and final inventory records are properly recorded. What are they saying? Don't know when you are going to record. Final inventory records is on 31st March. You might record on 5th of April. At that time, you see whether perpetually inventory records are properly adjusted. If it is in live, it will be as per 5th of April. So you have to adjust for this 31st March. Add the sale, subtract the purchases. Reliability of that perpetual record and reason for the significant difference. If the attendance becomes impracticable, then he will be doing alternate audit procedures, and if that is also not possible, then he will go for modification. Case number 3, impracticability is because of nature or location of the inventory. When inventory is in custody of third party, then he will request for quantity and condition. He will ask them itself, you please let me know the condition, whether it is available for sale. You please let me know what is there with you, that is the quantity. Perform inspection or other audit procedures as appropriate in the circumstances. What are those other audit procedures? It is ACID. What is ACID? A stands for arranging for another auditor to attend. C stands for pledged as collateral. I stands for internal control, and D is inspecting the documents. Matters relevant in planning attendance at physical inventory counting. May 25 this was tested. All these points you told me: nature of inventory, stages of completion, risk of material misstatement, internal control related to adequate procedures, timing, perpetual inventory, location, and whether assistance of auditors expert is required. Now coming to litigation and claim. In litigation and claim, there we saw existence and condition. For litigation and claim, what is the assertion that we are seeing? Completeness is the assertion that we are seeing for litigation and claim. What are these lines here and there? Litigation and claim, the assertion that you will be seeing is completeness. That means whatever is there in the books of accounts, that only actually is there, nothing else is missed out. Now you all tell me how the auditor will be doing the audit procedures to see what are the litigation and claim. First, he has to go and inquire. He will be inquiring with two people. He will inquire with management. He will also inquire with in-house legal counsel. Who are these people? In-house legal counsel. For litigation and claims, you have to remember two people, that is in-house legal team and the external legal counsel. For this example we took was Sun TV. Sun TV, huge company. Every day they will be getting the cases against them. So internally there will be people who are working, who are lawyers, who are part of the team of Sun TV itself. External legal counsel means they are the legal team who are going to go to the court and talk for Sun TV. Now the audit procedures involve inquiring with the management and also with the in-house legal team. What's the problem? Why it's coming like this? Anywhere else you saw like this in someone else's class? No? Which line? This one? Now there is no problem. Then I'll increase the thickness here. Now it's okay? Yes? Now inquiry with the management and inquiry with in-house legal team has to be done. Anything apart from that, can I do any other audit procedure? I will go and read the minutes of the meeting. In the minutes, if they are talking anything about legal expenses, or if they are talking about, oh, what happened to this case, then you can have that solid audit evidence. The third one is, if they say there is no cases pending in my organization, and you saw in the legal expense account that they have paid 10 lakh rupees, then isn't this an evidence that some legal expense is there that shows that completeness is not there? Yes or no? So that audit procedures you will be doing. And the last one is confirmation with external legal counsel. First you inquired with the internal legal counsel. You need to know whether this is right or not. So you will get the confirmation with the external legal counsel. There are 4 audit procedures that you will be doing here. Say for example, the litigation and claim is given as 5 crores is in stake. Now this 5 crores in stake means if I lose the case, I have to pay the 5 crores. If I don't lose the case, then I save the 5 crores. Now this 5 crores is stake, and they have shown this in the books of accounts. They have written that in the notes to accounts also. Now when you did all these audit procedures, you understood that it is not 5 crores, it is 50 crores. Your audit procedures is telling you that other litigation exists. If your audit procedure tells you that other litigation exists, then you will seek for direct communication with the entity's legal counsel. First with the entity's legal counsel, and then you will go for the external legal counsel. When you go to the external legal counsel, you have to give something called as letter of inquiry. With that letter of inquiry, you will be going to the external legal counsel. Now that external legal counsel is also not responding properly. In that case, you will be doing alternative audit procedures, and finally you will go for 705 modification using of weapon. Is that clear? Now just see the flow. Your audit procedures is leading to other litigations which is possible. What is the assertions that you are seeing here? Completeness. So completeness is at stake. Now if this is the case, then you have to seek direct communication with the entity's legal counsel. Entity legal counsel. Next, in this also, if you are not able to find any information, then you will go for external legal counsel, and this has to be done with letter of inquiry. Then if external legal counsel also is not giving any information, then you will do alternate audit procedures. In that also, if you are not able to get any information, you will go for modifications, that is SA 705. Is that clear, guys? Now when will you go for external legal counsel? When you will go for external legal counsel? So bad this is. When you feel that risk is very, very high, or if you are not able to understand anything, it is highly complex as to what is happening in the organization, and you found out that there is a fight between the management and the external legal counsel, disagreement between management and external legal counsel. In this case, you will directly give the letter of inquiry to the external legal counsel. Now you all tell me, external legal counsel means he's a lawyer. Lawyer's profession, noble profession or not? Can you go and disturb them like that? You have to first ask the management for the permission, for the contact details. If the management is not giving any kind of permission, then what you'll do? Then you'll do the alternative audit procedures. In alternate audit procedures, you're not able to get any information, then what you'll do? You will use the weapon, you will go for modification. Now say for example, the permission from management is given. You are going to external legal counsel with your letter of inquiry, you are asking the questions, but there is no reply from the other side. In that case, what should you do? Alternate audit procedures. In that alternate audit procedure, if nothing is there, you will use your weapon, you will go for modifications, that is SA 705. So basically the flow of this second part is like this. You will be doing the audit procedures by way of 4 things: inquiry with management and in-house legal team, minutes of the meeting, legal expenses account, and lastly any confirmation with external legal counsel. Now with these 3, it is showing that there are more litigations which is there, or if there is high risk of material misstatement, then you will seek to communicate with entities legal counsel. Then you will go for letter of inquiry to the external legal counsel. For this, you need the permission from the management. If the management is not giving the permission, then you will do the alternate audit procedures and SA 705. If you communicated to the external legal counsel and information from external legal counsel you did not get, then in that case you will be going for alternate audit procedures, and in alternate audit procedures also you will not get any information, you go for SA 705 modification. Is that clear, guys? Now we will read the theory. Auditor shall design and perform audit procedures to identify litigation and claim involving entity which may give rise to risk of material misstatement. What are those audit procedures? Inquiry with management, including in-house legal counsel, reviewing the minutes of the meetings, reviewing legal expense account. If the auditor assesses a risk of material misstatement regarding litigation or claim that have been identified, or when audit procedure performed indicate that other litigation or claims may exist, that means completeness have been compromised here, then in that case the auditor shall seek direct communication with entity's legal counsel. The auditor shall do through a letter of inquiry requesting entity's external legal counsel to communicate directly with the auditor. If law or regulation prohibits, or then the auditor will perform alternate audit procedures. The auditor may seek direct communication through letter of specific inquiry. He will be asking the list of litigation, where available management's assessment of that outcome, a request that entity's external legal counsel confirm the reasonableness of management's assessment. When he is asking the external legal counsel, he can ask in these three areas. When will the auditor judge it necessary to meet with external legal counsel? When there is significant risk, when the matter is complex, when there is disagreement between management and entity's external legal counsel. In these three cases, he can go for external legal counsel. If management refuses to give the permission, or if the entity's external legal counsel refuses to respond, then the auditor is unable to obtain sufficient appropriate audit evidence, so he will go for alternate audit procedures. Then alternate audit procedures also not possible, then you will go for SA 705 modification. Is that clear, guys? The next part is segment information. Segment information, the auditor has to obtain sufficient appropriate audit evidence and understand the methods which is used by the management, whether it is as per AFRF. Here they are going to see the financial statement as a whole and not only on segment basis. For example, Tata is there, it has so many segments, so we will not be seeing segment basis, we will see Tata as a whole. Segment can be based on different products or services, different geographical location also, north, south, east, west also can be different segments which is there. Examples of matter that may be relevant when obtaining an understanding of the methods used by management in determining the segment information. Now, what are the matters that is relevant for understanding the segment information which is used by the management? Now, segment information in accounting standard you studied AS 17. Accounting is done by whom? Management and ECWG. So it is their duty to do it as per the AFRF. It is our duty as auditor to see whether they have done it as per AFRF. Now, examples of matters that may be relevant when obtaining an understanding of the methods which is used by management in determining the segment information. What are the areas that as an auditor you will be seeing for understanding the segment information? First one is sales, transfers, charges between segments and elimination of inter-segment amounts. Comparison with budget, allocation of assets and costs, and consistency with the prior period. These 4 points you will be seeing to get an understanding of the segment reporting, whether it is as per AFRF. Is that clear, guys? Yes, we saw this fully in detail. Now we did a quick revision in just 20 minutes of time. Is that clear? 5 minutes for you to revise now. Please take that time. Let's do Caro, guys. The marathon of Caro starts now. Caro basically has 21 clauses: fixed assets, inventory, leaks provided, deposits, cost records, statutory dues. Now, how are you going to remember all of these clauses? First of all, Caro stands for Companies Auditors Report Order 2020. Don't write Caro in the exam. Please write Companies Auditors Report Order 2020 and only then you are going to get the marks. Now coming to how you are going to remember each of the clauses. Please be with me right now. There was a very worst person. The worst person you can ever think of is there. It is a kutty story. Laptop not cooperating, sorry. Now, what this worst person did, he bought a land. On top of that land, he put the building. Now, you all tell me, inside that building, is he going to keep it empty? He is going to put all the saraku, that is the stock, that is the inventory. And how did he get the inventory? Did he get it by his own money? He got loan for the inventory. Now, like I already told you, he's a very, 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 very worst person you can think of. So, what he did, he got the loan for this inventory, but he did not give it to the supplier. He put it as fixed deposit to enjoy the money. Fixed deposit will give the interest. So, he did like this. Now, from the beginning, let me tell you, there was a very, 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 very worst person you can think of. This worst person got the land and he constructed the building, and then inside the building, he kept the stock. Now, how he got the stock? By way of loan. But did he use it for the stock? No, he put it as his deposit so that he can enjoy that money. Now, he maintained proper records to not get caught with the government. So he maintained records. Usually you see people who are doing all the frauds, they will not file the nil return. They will not say zero return. They will say some money. If they have to pay 10 lakhs, they will just pay 10,000 rupees. So when he was paying the tax dues, that is the statutory dues, he got caught. Now once he got caught, the government is asking him the questions. What question did they ask? From where did you get all your income? There is so much of income, but I don't know from where you got. Proper accounting is not there for the income. Unrecorded income is there. From where did you get all of those things? Now the government told him, I know what and all things you are doing. You got the loan and you put it as deposits and all. I know all the things that you are doing. You better repay all the loans immediately. What they told? You have to repay the loan. Now he said, okay, fine, sir, I will repay the loan immediately. But I told you he is a very, 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 very worst person. Is he going to repay from his own money? He is going to go for public issue. That is issue proceeds. He went for that just to repay all the loan. ஆக மொத்தம் அவன் பண்ணது எல்லாமே fraud வேலை தான். ஆக மொத்தம் அவன் பண்ணது எல்லாம் fraud வேலை. Now there is a short commercial break. He went to jail. Interval. Till the interval, let's see whatever has happened. There was a very, 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 very worst person. He got a land. On top of that land, he constructed the building. Now, inside the building, he kept the inventory. Now, with the inventory, how did he pay for inventory? He got the loan, but did he actually pay for inventory? He put it for deposits. Now, but he maintained proper records and he also paid taxes to the government. That is the statutory dues. Now, the government is asking him the question, from where you got all the income? So much of unrecorded, undisclosed income is there. And the government said, I know all that you are doing. You better repay the loan immediately. But I already told you he's a very, 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 very worst person. So he repaid the loan by way of issue proceeds. He got money from the public. He got that money. ஆக மொத்தம் பண்ணது எல்லாமே fraud வேலை தான். Now he went to jail. Now in the jail, you all tell me, when he comes back from jail, will he become a changed person? No chance. He was thinking what kind of fraud I can do inside the jail. So as soon as he came, he started a company called as Nidhi Company. Nidhi Company means these are companies which is made by the members for themselves. That is the meaning of Nidhi Company. Usually if you see Tamil Nadu, lots of Nidhi companies are there. Now he formed this Nidhi company, and I told you he's a very, 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 very worst person. And this Nidhi company is by related parties. He put his mother, brother, father, father-in-law, sister's husband, everybody he put. All the related parties are forming the Nidhi company. Now, when people came for internal audit, they found out three important areas where mistakes are happening. They said there is lots of non-cash transactions which is happening. This company is supposed to go for RBI registration, but they did not do that. So there is a mistake, they said. And they said there is a lot of losses which is happening in the company. So seeing all these things, the statutory auditor of the company got very scared. So that statutory auditor immediately went for his resignation of statutory auditor. Now, the resignation of statutory auditor happens and there is so much of losses which is happening. Now, definitely they understood, okay, my going concern is getting affected. Now, till here, let us see what has happened in the story. There was a very worst person who was there. He got a land in a building, and inside that he put his stock. Now, how he got the stock? By way of loans. Now, he got the loan, and did he actually pay to the supplier? No, he gave for deposit to enjoy that money. But to show to the outside world, he acted like anything. All the records were properly maintained by him, but he got caught when he paid taxes to the government. Government said, I know what you are doing, you better repay the loans. They said, you better repay the loan. Now this guy decided, okay, fine, I will repay the loan and all of those things. But how did he repay the loan? That is the question. By way of public issue proceeds. He got the money and he repaid the loan. Agamatto, whatever he did is complete fraud only. Now he has gone to jail. When he came back from jail, will he be a changed person? No chance. He will be that very worst person only. He started a Nidhi company with related parties. When they came for internal audit, they found out 3 important areas where problems are happening. Non-cash transaction, RBI registration, and lots of losses are happening. Looking at this, the statutory auditor of the company went for resignation. Now looking at all of this, he understood that going concern is getting affected. Material uncertainty is there. Now is the turning point of the life. Now he decided, okay, whatever has happened has happened. I will do nalladu for the society, good for the society. So he took CSR activities, corporate social responsibilities. He suddenly became a changed man and he did the corporate social responsibility, and finally he did the consolidation of all his wealth, and he decided, okay, this is for society, this small portion is for myself. So now he is a better person. He did a consolidation. Now please be with me itself. The first clause is what? Fixed asset. What did this very worst person do? He got the land and the building. That is the first clause of fixed asset. Now he purchased the fixed asset and kept what inside? The saraku, that is nothing but the stock. Second clause is inventory. Third clause, how did he get the stock? By way of loans. Legs provided. There are 2 clauses for legs. Third clause is legs provided. Fourth clause is legs provided as per section 185 and section 186. Now he took the loan and he put it as deposits. That is deposits as per section 73 to 76. Is that clear, guys? Now he put the deposits, but he is maintaining proper records. The cost records is clause number 6, and for this we have a section number 148 subsection 1. Now he got caught when he paid the taxes to the government. That is a statutory dues, disputed statutory dues and the undisputed statutory dues. That is clause number 7 for you. Then what happened? He paid the statutory dues, then government caught him and said, this is the last warning. There is so much of unrecorded income which is there. That is clause number 8. And they asked him to repay the loan. That is clause number 9. That is repayment of loan. Then how did he repay the loan? By way of issue proceeds, that is clause number 10. Issue proceeds ஆக மொத்தம் பண்ணது எல்லாமே fraud வேலை தான், that is clause number 11. Now quickly going through everything. Clause number 1 is fixed assets, clause number 2 is inventory, clause number 3 is leagues provided, 4 is leagues provided as per section 185 and 186, clause number 5 is deposits as per section 73 to 76, clause number 6 is cost records, section 148 subsection 1, clause 7 is statutory dues split into disputed statutory dues, undisputed statutory dues, clause number 8 is unrecorded income, undisclosed income, clause number 9 is repayment of loan, clause number 10 is issue proceeds, and clause 11 fraud. Now comes intermission. After he comes back from jail, what did he form? He formed a Nidhi company. With whom did he form that Nidhi company? With his brother, father, mother, sister, sister-in-law, father-in-law. They are the related parties. That is clause number 13. Related parties, he formed the Nidhi company. Now when they came for internal audit, that is clause 14, they found out 3 different things, that is 15, 16 and clause 17. What are those 3 different things? There are lots of non-cash transactions. RBI registration is to be there, and there is lots of losses, that is clause 17. Now looking at all these things, statutory auditor got scared and he resigned. The resignation of statutory auditor is clause number 18. Then seeing all these losses and everything, finally you can conclude that going concern itself is getting affected. Now is the turning point, and finally he gives all his money for nalladhu for the society, that is clause 20, corporate social responsibility. 21 is he is seeing, okay, this much is there for me, that much is there for society. He is doing a consolidation of all his funds, that is consolidated financial statements. Is that clear, guys? Now is it easy to remember all the clauses? You all tell me. Now clause number 1 is what? Fixed assets. Clause number 2, inventory. 3, leaks provided. 4, leaks provided section 185, 186. Clause number 5, deposit section 73 to 76. Clause number 6, cost records section 148 subsection 1. Clause number 7, statutory dues, disputed statutory dues, undisputed statutory dues. Clause number 8, unrecorded income, undisclosed income. Clause number 9, repayment of loan. Yes, there is unrecorded income. The government gave him last warning and told him you better repay all your loan. That is clause number 9. 10 is how is he repaying? By way of issue proceeds. ஆக மொத்தம் பண்ணது எல்லாமே fraud வேலை தான். That is clause number 11. 12 starts with Nidhi company. He is forming the Nidhi company with related party. That is clause 13. 14 is internal audit. 15, 16, 17 is what the internal auditor is finding. What is it? Non-cash transaction, RBI registration, and lots of losses. That is 17. 18 is resignation of statutory auditor. 19 is going concern. 20 is corporate social responsibility, and 21 consolidated financial statements. Very, very good, guys. Now you are done with the clause names. Now only you have to study what is there inside each of the clauses. Can we go inside? Can we go inside, guys? Yes. Fixed assets. Now I'm going to make this very easy for you. There are 6 points which is given here. The first point is talking about records. The records of the tangible asset and the records for the intangible asset. Now for tangible asset, what kind of records are required? What are the details of that fixed asset, and where is that fixed asset located? You please tell me the situation of that fixed asset, the location of that fixed asset. For example, the fixed asset is this projector. How will I say what is the situation of the fixed asset? You come to 3rd floor and then you come straight, take that right, and then you can see there is a big projector, there is a big screen, and then there is a projector. So these two are fixed assets like that. The details and also the situation is to be given by the auditor. Now what is the second one? The intangible asset. For that, will there be situation? Intangible asset means there will not be situation. You will be giving only the full details of that intangible asset. So the first point is with regard to records of tangible and intangible asset. Asset na sonnale, you have to do the physical verification of asset. Physical verification, when you have to do? At reasonable intervals you have to do. Now, if there is any differences, that is in books of accounts, it is different. And when you went and did the physical verification, it is showing a different figure. If there is any differences, that is called as material discrepancy. If there is any discrepancies in the books of accounts and the what is there in real life, then you have to see whether it has been properly recorded with in the books of accounts. That is the next point. Third one is with regard to the title deeds. Whatever asset is shown in your books of accounts must be that of the companies only. The title should be with the company only. This is for immovable property. If it is not there in the if the title deed is not there, then there is a separate format that you have to follow, where you have to give the details as to who is the person who is holding that immovable property for the company, and you will be giving reasons for the same, and so many other details are also there. The fourth one is there any revaluation of that fixed asset? Revaluation means increase or decrease of the value of the fixed asset. If that change is more than or equal to 10%, then you have to please mention that here. The next one is with regard to Binami Transactions Prohibition Act. What is the meaning of Binami? Binami means I am holding for someone else. So that is Binami Transactions Prohibition Act. Sorry for this, guys. Binami Transactions Prohibition Act. If any cases are pending against the Binami Transaction Prohibition Act, as an auditor, we will have to comment on the same as per CARO reporting. Now there are only 5 points which is given here. See the text. Some disturbance is happening today. What is the issue? Fully they are writing. Close it. Okay. Now if you see the fixed assets, there are 6 points. The first 2 points are with records. Records of tangible asset and record of intangible asset. Whether a company is maintaining proper records showing particulars including quantitative details and situation of PPE, property, plant and equipment, that means tangible asset. Whether company is maintaining proper records showing full particulars of intangible asset. Whether these PPE has been physically verified by the management at reasonable intervals, whether any material discrepancy was noticed, whether it has been properly dealt with in the books of accounts. Then I told you about the title deeds of immovable property. If it is held by some other person, say for example, who is your favorite hero? It is held by Surya. No need that Dhanush. In every place if you see, they are spoiling his name like anything. We will take Surya. Description of the property. What is that property? It is a land and building. The carrying value is 3 crores. It is not held in the name of company. It is held in the name of Surya. Now, who is that Surya for that company? He is a relative of director. Like that you will have to give. What is the period held? 2 years. Reason for not being held in the name of company. What is the reason? You will have to mention that also. So, title deed of immovable property has to be in the name of the company. If it is not in the name of the company, then you have to give all of these details. Whether the company has revalued if it's PPE, whether it is done by registered valuer, and if change is 10% or more, then you have to mention the carrying value of each class of PPE or intangible asset. And last we saw Binami Transactions Prohibition Act, whether any proceedings have been initiated or pending against the company. That means any case is pending against the company under the Binami Transactions Prohibition Act, then whether the company has disclosed that detail in the financial statements, we will have to say that also. There are 6 points which is given here. For our understanding, I gave that as just 5 points. This is fixed assets, guys. Going to the next clause, that is inventory. Inventory sonale physical verification of inventory must happen. Whether physical verification of inventory have been conducted at reasonable intervals by the management and where in the opinion of the auditor coverage is done. Now here also discrepancy can happen. When you go and physically verify something and in the books of accounts it is something else, you will call that as discrepancies. If that discrepancy is 10% or more, then whether they have been properly dealt with in the books of accounts. Whether during any point in time, this point is important, they can test in your exam. Whether during any point in time, the company has been sanctioned working capital limit in excess of 5 crore rupees. For you to understand this clause, let me tell you, any business for their operations, they can get the loan. Now say they have gotten that loan for working capital loan is for operations. If that loan amount is exceeding the 5 crore rupees, then they have to file something called as quarterly returns or statement. This has to be filed with the banks or financial institution. As an auditor, whatever they are filing with the banks or financial institution, whether it is as per the books of accounts only, because we've done the physical verification, and if the physical verification books of accounts will be checking, now the quarterly returns which is sent to the bank, whether it is as per the books of accounts. If not, we'll have to give the details. Now inventory, there are 2 points are there. First point is talking about physical verification. If there is any material discrepancy more than 10% in CARO reporting specifically, you will have to mention. The second point is talking about working capital loan. If it is exceeding 5 crore rupees in the quarterly returns, has to be given to the banks or financial institutions. Now as an auditor, we have to see whether that return is as per the books of accounts. If not, we will have to give the details. Third is leaks provided. Loans, investment, guarantees and securities. Under this, the first point is talking about, like how I did for fixed asset, I will explain this. Leaks provided, guys. The first point is talking about, you can give the loan to either your subsidiary, joint venture, associate, or to any other person, correct? Joint venture, subsidiary and associate, or you can give the loan to others, whomever it may be. You please mention the amount in aggregate as to how much you have given. That means you have given and they have repaid. Again you have given and they have repaid. So you will not calculate the outstanding amount, you will calculate the aggregate amount. So first you have to mention the amount in aggregate and you will have to mention the outstanding amount. That means the balance which is at the end of the year. So loan given to subsidiary, joint venture, associate, leaks provided to other than subsidiary, joint venture, associate, you will have to mention the amount in aggregate and the outstanding balance. Going to the second point, the loan which is given should not affect the interest of the company. Say normally I am charging people 10% on the loan, but if I am giving to my related party, can I charge that? No, they will give that slipper beat only. So it should not be prejudicial to the interest of the company. That it means it should not be affecting the interest of the company. Third, any loan you give, there should be, when will you be returning the loan? Will you ask that question? That means there must be a repayment schedule. That is the third point. Any loan which you give must have a repayment schedule. So the auditor has to check that repayment schedule, whether it is there or not there. If there is any amount which is overdue for a period of more than 90 days, how are they dealing with the books of accounts, and whether any actions have been taken for recovery of that loan, the auditor has to check. Apart from this, whether any loan has been renewed or fresh loan has been taken or any loan has been extended, then the auditor has to give the aggregate amount and the percentage of the total loan. Renewal, fresh loan and extension, when will that take place? Say for example, there is a loan which is given that is falling due today. Then today what I will do, okay, you are not able to pay the money back, I will renew it to the next year, like that. Or you close this loan, I will give you a fresh loan. So basically they are carrying forward that loan. In that case, you will have to mention the aggregate amount and the percentage of the total loan. On demand loan. What is the meaning of on-demand loan? You have to first understand. For example, you are giving money to your friend. Will you ask him back that money? No. You will give it now and you will say, Macha, I will get it back from you. What you will say, whenever I want, I will take it back from you. So basically, on your demand, when you want, you will take it back from him. That is on-demand loan. For this also, you will have to mention the aggregate amount and the percentage of the total loan. Is it understandable, guys? Now just see the points which is given here. Whether during the year the company has provided any loan or advance in the nature of loan, then indicate aggregate amount during the year and the balance outstanding with respect to leaks provided to subsidiary, joint venture, associate. Is that clear? Now here, aggregate amount during the year, balance outstanding, same thing, the same thing, aggregate amount during the year, balance outstanding, you will have to mention if you have given loan other than subsidiary, joint venture, associate. Is that clear, guys? This was our first point. Whether you have given loan to subsidiary, joint venture, associate or other than subsidiary, joint venture, associate, you will have to mention the amount in aggregate and the outstanding loan value. This point is not applicable to company whose principal business is to give the loan. If your business, core nature of the business itself is to give the loan, then you can skip this point. What was the second one? Whether investment made, loans and advances given are not prejudicial to the interest of the company. In respect of loans and advances, the nature of loan, whether there is a schedule for repayment and whether it is regular. If there is any overdue amount more than 90 days, whether reasonable steps have been taken for the recovery of that overdue loan. Then the next point is regard to whether any loan has been renewed, extended or fresh loan. If you notice here in red what is given, this point also is not applicable for principal business being the giving of loan. So if any loan has been renewed or extended or fresh loan has been granted, then you have to mention the aggregate amount and the percentage of aggregate to the total. Whether the company has granted loans or advances which are repayable on demand or without specifying terms, without period of repayment, when you will give to all these people? Only if they are friends, only if they are family members. You cannot say repay tomorrow, like that you will not say. So it is repayable on demand. If so, specify aggregate amount and percentage of total loans granted, aggregate amount of loans granted to promoters and related parties. There are 6 points which is given here. First one is talking about loans given to subsidiary joint venture associate other than subsidiary joint venture associate. You will be mentioning the amount in aggregate and the outstanding balance. You will see that the loan is not prejudicial to the interest of the company. If it is overdue more than 90 days, whether steps have been taken, reasonable actions have been taken for the recovery of the loan. If there is any loan which is given, whether there is repayment schedule of the loan, the auditor has to check whether any loan has been renewed or fresh loan given or extended, or if there is any on-demand loan which is given, you will have to mention the aggregate amount and the percentage of the total loan. This is LIGS provided, guys. Clause number 4 is very, very easy. If you have to remember the section number, nothing else you have to remember. So, LIGS provided as per section 185, 186. Deposits I told you, section 73 to 76, not 36. 73 to 76. Cost records, section 148, subsection 1. Basically, what is written here? Whether maintenance of cost records are as per section 148, subsection 1 of the Companies Act and whether such accounts have been made and maintained. Statutory dues. Disputed statutory dues, undisputed statutory dues. Now you have to know what is the meaning of disputed statutory dues and undisputed statutory dues. What is the issue? Now say for example, you have to pay taxes to the government. Your GST has crossed 20 lakhs, so you have to pay the GST. You will be collecting from somebody else and you will be paying that GST. Say for example, you have paid 2 lakh rupees as GST value. You have collected from the customer and you have given to them 2 lakh rupees of GST. Now, you are getting a notice from the government saying the way you have calculated the GST is wrong. Instead of 2 lakhs, you have to pay 5 lakhs. Will you accept this? No. You will go and fight in the court of law. That means there is a dispute which is happening. Dispute means you are fighting with the government. So disputed statutory dues means, I hope you understood what is the meaning of disputed statutory dues. What is undisputed statutory dues? Undisputed statutory dues means the due is overdue. Say for example, TDS has to be paid by 7th of the next month. And GST also, there is a timeline for paying to the government. Now, the due date of the payment has crossed. Now, there is no dispute which is here. But still, I know that I have to pay to the government. I know I will be paying later, maybe with interest and penalty. That is called as undisputed statutory dues. Undisputed statutory dues means it is outstanding more than 6 months from the time it became payable. Disputed statutory dues, you already know that fight is going on between the numbers or whatever which is happening. Now here you have to mention the amount involved. Here how much is dispute? 5 lakhs? No, wrong. The disputed amount is 3 lakhs. You have to mention the amount involved and also the forum where the dispute is pending. Forum means where is the dispute pending? It is pending in tribunal, it is pending in high court, it is pending in Supreme Court, like that you will be able to say. So the forum where the dispute is pending also should be mentioned. There is clause number 7, statutory dues. Undisputed statutory dues, whether the company is regular in depositing undisputed statutory dues, including GST, PF, sales tax, employee state and customs, excise duty and other statutory dues. If not, extent of arrears of outstanding due on the last day of the financial year concerned for a period of more than 6 months from the date they became payable. From the due date, if it is outstanding for more than 6 months, then at that time you will have to mention here. Disputed statutory dues, where statutory dues have not been deposited on account of any dispute, then the amounts involved and the forum where dispute is pending shall be mentioned. Is that clear, guys? This is clause number 7, statutory dues, disputed and undisputed statutory dues. Clause number 8 is undisclosed income, unrecorded income. In the previous year, you have not recorded as income, and in the current year, you are suddenly showing this as income. You are showing this to tax, putting your income to tax. In that case, whether a transaction which is not recorded in the books of accounts has surrendered or disclosed during the year in the tax assessment, then previously unrecorded income, whether it has been properly recorded in the books of accounts during the year, you will have to see. This is clause number 8, undisclosed income. Coming to clause number 9, repayment of loan. It looks big, don't get scared. I am there for you, like how fixed assets look big initially. The remembering of Caro clauses looks big initially. Now you are able to tell like that. Please be with me. Please trust me. Caro is one of the easiest chapter where you can easily score 4 or 5 marks. Compulsory 4 or 5 marks. Attempt on attempt they are asking in Caro. Let's be ready, guys. Clause number 9. Repayment of loan. Whether company has defaulted in repayment of loan or borrowing or in the payment of interest. If yes, period and amount of default should be as per the format. What are they asking in the format? Nature of borrowing, including the debt securities. Name of the lender, from whom you got the money. Amount not paid on due date, 1 crore I have not paid. Whether it is principal or interest, it is both principal and interest amount. Number of days unpaid, it is not paid for more than 3 years. Remarks, if any. Like this, in the format you will have to mention if there is any default in the repayment of loan. Clause number 9 is talking about repayment of loan. Under that, the first point is talking about default in the repayment of loan. What is the second point? Whether this person is a willful defaulter. What is the meaning of willful defaulter? Willful defaulter basically means vechite illan solran. Who will do like that? He has lots of money, but he will not pay to the bank. For example, Vijay Mallya, Nirav Modi, do they have money? Definitely they have the money. Nirav Modi, Punjab National Bank, lots of case happened. Vijay Mallya, the whole country knows, especially now after the podcast. Yes or no? He had the money, but still he went and he partied for his 60th birthday like anything. But he did not pay to the bankers. But he has a different story. That is a different story. Now, willful defaulter means vechite illan solran. That is willful defaulter. Under repayment of loan, we saw if the company has been defaulted, whether in terms of loan or in terms of interest amount, then we had a format below. Second is whether he is a willful defaulter. If the company has gotten the term loan facility, now when you are getting the term loan, there will be the purpose of the loan. Say if you go for housing finance loan, whether you are building the house or not, they will be checking. So if they have gotten a term loan, whether it has been used for the purpose for which it has been bought. If it is not used, the auditor has to mention the amount which has been diverted and the purpose for which it is actually used. The auditor has to report on that. Whether short-term loan has been used for long-term purposes, this is a big problem. Let me tell you why. The ulta is not a problem. Only if you use short-term loan for long-term purposes, it is a problem. Short-term loan means what? It is a loan which has to be repaid within a period of 12 months. Now, long-term purpose, if you are going to use the loan, for example, short-term loan you bought for working capital requirement, but you are actually using that for building a building. You are using that for building a building. Now, in that case, When will that building actually give you the return? Maybe after 3 years, maybe after 4 years. So the benefit from that property is going to come only after 4 years, whereas you have to pay the money within a period of 12 months. So you cannot use short term loan for long term purposes, because there might be a possibility of default here, because the benefit from that long term purpose will be much more after 12 months. So the short term loans, if it is used for long term purpose, the auditor has to mention that. Now comes again subsidiary joint venture associate. Say for example, I am taking the money, but this is for the use of subsidiary joint venture associate. In that case, you please mention that is the taken funds to meet the obligation of subsidiary joint venture or associate. Or the other way is also possible. I am using the collateral of subsidiary joint venture associate. That means what? I am using the securities which I have in the subsidiary as the collateral, and I am getting the loan for myself. That is the next point. In case you are raising the loan with pledge of securities, this is terrible today. With the pledge of securities, you are getting the loan which is held in subsidiary joint venture or associate. Then in that case, whether there is a default, details of the default if there is any, because if there is a default, there is a serious scenario. What is your collateral? Securities in the subsidiary joint venture associate. Then if you are going to keep that as the collateral, and if you default in payment of loan, they are going to take the shares. You are no more the holding company. That is the reason why it is very, very important. Now, under clause number 9, repayment of loan, we saw how many points? 6 points. The first one is whether the company has defaulted in the payment of loan or interest. For this only we saw there was a format. Second, whether the company is declared as a willful defaulter. I hope you know what is the meaning of willful defaulter. He has the money, but he will say, no, I will not pay the money to you. Third is, what is the purpose of the term loan you have obtained, whether you have actually used for that purpose only. If you have diverted the money to some other purpose, then you please mention what is the amount diverted and what is the purpose for which it is used. Fourth is whether short term loan has been used for long term purposes. I told you why it should not be used that way. Fifth is whether you have taken the funds to meet the obligation in the subsidiary joint venture associate. And the last is whether you have raised the loan with pledge of securities in subsidiary joint venture associate. So if you see, the fifth and sixth point might be a little confusing. Fifth is the company, that is your client, your company has taken the loan from the bank, but for whom? It is actually for subsidiary joint venture associate. So basically the loan is coming here and ultimately it is going to subsidiary joint venture associate. This is the fifth point. Now if you see the sixth point, you are raising the loan with the pledge of securities which is held in the subsidiary joint venture associate. So here the loan is coming to the company, and the company is basically giving the collateral as what? As the securities which is there in subsidiary joint venture associate. That is the sixth point. I hope it is clear now for you. Read the text. Whether company has defaulted in repayment of loan or other borrowings and payment of interest. If yes, then you have to mention the format. Whether the company is declared as willful defaulter by a bank or financial institution or other lender. Whether term loans were applied for the purpose for which the loans were obtained, then what is the amount of loan diverted and what is the purpose it is used for. Whether funds raised on short-term basis have been used for long-term purposes, and mention the amount and the nature. Whether company has taken any funds from any entity to meet the obligation of subsidiary joint venture associate, then you will be giving the nature of transaction and amount. Whether company has raised loan on the pledge of securities held in subsidiary joint venture associate, then you will be giving the details, and whether any default has happened. Here, if you are going to pledge the securities in subsidiary joint venture associate, you are more bothered whether there is a default, because if there is a default, you are no more the holding of that subsidiary company. Going to clause number 10, guys. Clause number 10 is issue proceeds, that is IPO and FPO. Is it too much? Do you want a short commercial break? No? Okay, good. We are revising, right? We are seeing there and then we are coming to the text. We are again revising. I hope it is okay. Clause number 10. Issue proceeds, IPO and FPO. Whether money raised by way of IPO or FPO were applied for same purpose is important. And the second point is easy. Section 42, section 62. I told you whenever there is a section, you only have to remember the section number. So the first point is talking about if you are raising money from the public, you will be having a purpose for that. Now where will you give that purpose? In the prospectus, you will be giving the purpose as to why you are raising the money from the public. Now, as an auditor, you'll have to check whether if they have gone for any IPO or FPO. What is the difference between IPO and FPO? IPO is initial public offer. FPO is further public offer. I didn't ask the abbreviation. I asked the meaning. So, when a company gets listed on the stock exchange, the first time they're raising from the funds from the public, that is called as IPO. Now, multiple times when they start raising funds from the public, it is called as FPO. The second, third, fourth time that they are raising funds, that is called as further public offer. Initial means first time, initial public offer. What is clause number 11? There are 3 points which is given here. 11 is fraud. Whether they are covering fraud by the company or somebody else doing the fraud on the company. They are covering both as per CARO. If there is any fraud by the company or on the company, you please report it under CARO. They are also giving a section number here. 143 subsection 12 of the Companies Act. What is that 143 subsection 12 of the Companies Act? Very, very important. 143 subsection 12 says, if the amount of fraud involved is less than 1 crore, you please report to Board of Directors and the Audit Committee. If the amount of fraud is more than or equal to 1 crore, then you please take the form number ADT4 and you directly tell the central government. Now this you have to remember, 143 subsection 12. Whether any report under section 143 subsection 12 has been filed in form ADT4 as prescribed under Rule 13 of the Company Auditor Rules. Whether auditor has considered any whistleblower complaints. What is that whistleblower complaint? Now, sometime back, you know what happened? She was eating in the class. What that Sanjay Ram did? Ma'am, eating, ma'am. Like that, potu kuduthu fine. That is called as whistleblower. I did not see her eating. But because that Sanjay Ramasamy did that, ma'am, eating. Like that he did. Because of that I know, okay, she's not listening to this class. She is eating there. So suddenly I will raise my voice. Then okay, ma'am saw something. Everyone will become suddenly attentive. Yes or no? Whistleblower means if some fraud is happening, there will be one person or two people in the employees who will blow the whistle and tell the others that something else has happened here, that a fraud has happened here. That is called as whistleblower complaints. Under fraud, there were 3 points. Whether any fraud by the company or any fraud on the company has been noticed or reported. Whether any report under section 143 subsection 12 of the Companies Act has been filed. Whether auditor has considered any whistleblower complaints. This is clause number 11, fraud. Now after this, what happens in our story? He goes to jail and there is interval. Now again there is interval. We will go back to the first clause and we will quickly revise as to what we saw till here. Fixed assets, there are 5 points totally. First point is talking about records of tangible, records of intangible asset. Tangible means the situation and the details has to be given. Intangible means full particulars, that is only the details is required. The second point is physical verification of the asset, whether any material discrepancy is there, whether it has been properly dealt with in the books of accounts. Third is who is the title, who is the owner, real owner, title deeds of that immovable property. For this separate format is given in case the asset is not held in the name of the company. If there is any PP which has been revalued and that revaluation change is more than 10%, then you have to mention the net carrying value and also the net carrying value of each class of PP. And last is Benami Transaction Prohibition Act. If there is any case which is pending, proceedings pending against the Benami Transaction Prohibition Act, then you have to mention that separately. Clause number 2 is inventory. We have 2 points here. One is about physical verification of inventory, material change more than 10%. You'll have to see. Then next is working capital loan. This loan, if they have obtained the loan for more than 5 crores, then the quarterly returns has to be filed with the banks and financial institution. We as auditor have to see whether these returns have been filed and whether it is as per the books of accounts of the company. Clause number 3 is leaks provided. Point number 1. Whether legs provided to subsidiary joint venture associate or other than subsidiary joint venture associate, you have to mention the amount outstanding and the aggregate amount. Whether any legs are provided are prejudicial to the interest of the company. Whether the legs have a repayment schedule and whether the receipts are regular. Whether it is overdue more than 90 days. If it is overdue more than 90 days, what is the steps which is taken by the management for getting the amount? Whether any loan has been renewed or extended or fresh loan has been taken, then this point is not applicable for companies where the principal business is to give the loan itself. Then you have to mention the percentage of aggregate to total loans or advances. The last one also same thing you have to mention, that is aggregate amount and percentage of total loan to advances, that is repayable on demand loan. Now these 6 points are for legs provided. Fourth clause is legs provided as per section 185, 186. Fifth clause is deposits under section 73 to 76. Sixth is cost accounts as per section 148 subsection 1. Seventh is statutory dues, disputed and undisputed statutory dues. Dispute means there is some fight going on, so you have to mention the amount and the forum involved. Undisputed statutory dues means there is no fight and all, it is just overdue more than the 6-month period. Undisclosed income, previous year it is unrecorded, undisclosed, and current year suddenly you are recording it, whether it has been properly dealt with in the books of accounts, auditor has to see. Clause number 9 is repayment of loan. There are just 6 points here, whether the company has been defaulted in the repayment of loan, whether the principal amount is defaulted or interest amount is defaulted, all those things in the format given below. Whether the company has been declared as willful defaulter, the auditor has to check. Whether term loan is applied for the purpose for which it has been obtained. Otherwise, what is the amount which has been diverted and what is the purpose for which it has been diverted for. Whether short term loans has been obtained for long-term purposes, then auditor has to mention that if the company has taken the funds to meet the obligation of subsidiary joint venture associate, or if they have raised the loan with the pledge of the securities in the subsidiary joint venture associate, then in that case also you will have to mention that separately. Clause number 10, issue proceeds, IPO, FPO, what is the purpose for which you have obtained, whether you have used for the same purpose. This is by public issue. Section 42 and 62, whether it has been complied with. Clause number 11, whether any fraud by the company or on the company has happened, you will have to mention 143 subsection 12 says that if the amount of fraud is less than 1 crore, you have to tell the board of directors and audit committee. If the amount of fraud is more than or equal to 1 crore, then you have to mention in form ADT 4 to the central government. Very good. The last one is whether auditor has considered any whistleblower complaints, that also you will have to check. Is that clear, guys? Can we move forward to the 12th clause? Clause number 12 is Nidhi company. There are just 3 rules here, actually 2 rules, because the third one is whether any default in repayment. What are the first 2 rules? Net owned funds is to deposits has to be in the ratio of 1:20. That is the first rule. Now, do you all know what is the meaning of Nidhi company? Nidhi company means, do you all know? Okay. Nidhi company means this company is actually very This company is actually very prevalent in Tamil Nadu. What is this Nidhi company? This company is basically a few members will come together and they will give the deposits, and between them they will take the loan from the company. Say for example 10 people are coming together. In that 7 people are okay, they'll give the deposits, and all 10 can take the money back as borrowings, or like that. It is basically by the company for the company, like that you can remember. Now they also take deposits from outsiders, but loan is given to the members of that Nidhi company. Whether Nidhi company has complied with net owned funds is to deposits in the ratio 1:20, and they have to maintain a 10% of unencumbered term deposits. What is the meaning of unencumbered term deposit? Encumbrance means what? A charge. Good. A lien. A charge which is created on the asset. Same way in a deposit also you can create a charge. Based on a deposit you can take overdraft facility. You can take that, but maintain 10% of unencumbered term deposits. So these 3 are for Nidhi company. Clause number 13, related party transaction. You just have to remember the section number, section 177, section 188. Clause number 14 is internal audit. Whether the company has an internal audit system which is commensurate with the size and nature of the business. Say for example, Audi is a company, it has rupees 4,000 crores turnover. Now you all tell me, in that Okay, I'm not even writing. 4,000 crores of turnover. I have an internal auditor, only 2 people are there. Is it okay? No, at least 25 members has to be there in the internal audit team. That only the first point the auditor has to check whether company has an internal audit system which is commensurate with the size and nature of the business. Whether the report of internal auditor has been considered by the statutory auditor. That is the second point. Now, internal audit, there are 2 points. Whether the company has an internal audit system which is commensurate with the size and nature of the business. The second is whether the report of that internal auditor has been considered by the statutory auditor. Clause number 15 is non-cash transactions under section 192. If there is section, then there is always only the section. Only here there is something else which you have to remember. The non-cash transactions with directors or any person who is connected with the director. Section 192 is talking only about that. Any director or any person who is connected with the director. Clause number 16 is RBI registration. RBI registration, if it is required under section 45IA of the RBI Act, then that company has to get registered under that. That means what? They are doing the banking activities. Then they have to register under RBI. If they are undertaking any kind of activity, then that registration has to be obtained. So if the company you are going for audit, whether they have to be registered under section 45 of the RBI Act. What is the meaning of housing finance activities? For buying a house, I am giving the loan. Now, what am I called? So, the second point is with regard to whether the company has undertaken any non-banking financial or housing financial activities without a certificate from the RBI. The next 2 points is actually considered as 1 point only because it is talking about core investment company. Now, we all take this group called Tata Group. My favorite example. Who and all are there under Tata Group? TCS is there. Tata Steel is there. FMCG is there. Who else is there, guys? Tata Fashions. Yes, Tata Fashions. Westside Zudio is there. Starbucks is there. That is also franchisee of Tata. So, all these companies come under Tata Group. Now, core investment company means there is one company at the top which is holding in all the other companies. That company is called as Tata Sons. Now, this Tata Sons is holding in all the other companies. This Tata Sons is called as core investment company. As an auditor, we have to see that whether the company is a core investment company, that is the company that you are doing the audit for, whether that is a core investment company. The second point is also related to core investment company, where in the group are there core investment company. Usually there will be only one. Now you have to mention the number of core investment companies which is part of the group. Is that clear, guys? RBI registration 4 points illa 3 points. First one is talking about whether the company is required to be registered under section 45 of the RBI Act. Second one is talking about whether the company undertakes non-banking financial activities or housing financial activities. Then valid certificate from RBI, do they have or not? The third point is talking about whether the company is a core investment company. Fourth is, no, third only. Third is, if in the group there are core investment company, how many core investment companies are there? That is RBI registration. Clause number 17 is talking about cash losses. What is the meaning of cash loss? Say there is profit after tax. You will be adding all the non-cash expenses. What are the non-cash expense? Your depreciation is a non-cash expense. Anything else? Your provisions. They are also non-cash expense only. Your provisions for bad and doubtful debts and all the other provisions. Now, if you add the non-cash expenses, you will get the cash profit. Now, in case here there is cash loss, then you have to mention that. Even if there was a cash loss in the previous year, you have to mention that in the current year CARO reporting. Whether the company has incurred cash losses in the financial year and the immediately preceding financial year. If so, state the amount of cash loss. You will be seeing the cash loss in the current year and you will be seeing the cash loss in the previous year. Clause number 18 is resignation of statutory auditor. In case you are the statutory auditor. Before 2 months only you got appointed. Before that there was one more person. Why he resigned? Did they keep the knife on his throat and say put the signature here? You need to communicate with him and understand as to why he left the company. Now, if there was a resignation during the year, you will have to ask the issues, the objections and the concerns which is raised by the outgoing auditor. What is going concern? Now, in going concern, SA 570, அங்கேயே பிரிச்சு மேஞ்சிட்டோம். What we saw there? Financial indicators, operating indicators and other indicators on the basis of financial ratio, aging and expected date of realization of financial assets and payment of financial liability. Whether the auditor is of the opinion that no material uncertainty exists, there is no 50-50 probability, you will have to mention that. And any liability, if it is there, whether they are able to pay that liability off within a period of 12 months, only then you will say that the going concern is okay. So as an auditor in CARO reporting, you have to mention about going concern. Last two are there. Let us complete it, guys. CSR. CSR is split into two. What is this corporate social responsibility? First of all, for companies which is having net profit more than 5 crores. So net profit more than 5 crores means it's a big company. That means avan naattukku nalladhu pannatom. Average profit 2% you take. The average net profit for the last 3-year period, you take that, and 2% of that average net profit for the last 3 years, you will be putting that for nalladhu for the society. That is corporate social responsibility. Now say you are building a school for all the underprivileged children. Now, building a school will take how many years? 2 years? Yes, 1.5 to 2 years it will take. Now, say you are building a big school and it is taking 2 years. Okay, it is an ongoing project. Now, these funds has to be exhausted fast because this 2% will be like 1 crore or something. Now, this 1 crore you are building a school, it has to be exhausted fastly. Now, in case the project is still ongoing and continuing for more than 1 year, then you have to transfer that amount to a special account, and this is said in section 135 subsection 6. Whether in respect of other than ongoing project, the company has transferred the unspent amount to a fund. That means the school work is completed. For the school, you thought it will be 1 crore, but it actually got over in 70 lakhs. So 30 lakhs is what? It is a completed project. It is not an ongoing project. So other than ongoing project, you have to transfer the unspent amount to a specific fund within a period of 6 months from the expiry of financial year. This is given in section 135 subsection 5. Is that clear, guys? So CSR means you will split it into two. Ongoing project, other than ongoing project. Ongoing project means you have to transfer that to a special account. This is given in 135 subsection 6. Other than ongoing project means fund is over, but still you have, work is over, but still you have remaining funds. At that time you have to transfer that to a specific fund as per schedule 7 within a period of 6 months to the expiry of the financial year. That is CSR. Clause 21, the last clause, is consolidated financial statements. Under CARO, in the consolidated financial statement, there will be an independent auditor's report for the consolidated financial statement. Now, there also there will be CARO reporting. Under CARO, if there is a qualification or adverse remark when they are doing the consolidated financial statement, then in this client company, you please mention the details of that company and the para number. Enough. You don't have to mention in detail and all. You just tell which company and what is the para number for that consolidated financial statements. Is that clear, guys? Now, let me do a quick revision after interval. Nidhi company to a clause number 12 has 3 points. Net own funds is to deposit should be maintained in the ratio of 1:20. They should be maintaining at least 10% unencumbered term deposits with them. Any default and repayment of the payment, if it is there, you will have to mention that separately. Clause number 13 is related party transaction section 177, 188. Clause number 14 is internal auditor, whether the company has an internal audit which is commensurate with the size and nature of the business. The second point is whether the internal audit report has been considered by the statutory auditor. The next 3 points is actually what the internal auditor is finding in our story, in our very first person story. Clause number 15 is non-cash transactions as per section 192. I told you one more thing you have to remember, non-cash transaction which has been entered with directors or persons who is related to the directors. Clause number 16 is RBI registration. There are 3 points which is given here. First point is whether the company is required to be registered under section 45 IA of the RBI Act. Whether the company is involved in any non-banking or housing financial activities, then whether valid certification whether they have from RBI. third is with regard to core investment company, whether this company that you're auditing is a core investment company or whether the group has core investment company, how many you have to mention the number of CICs which is part of the group. Clause number 17 is cash losses. Cash loss means you'll take the profit after tax, you'll add all the non-cash expenses to get the cash profit or cash loss. You'll be mentioning for the current year and also for the immediately preceding year. Very, very good. Clause number 18, resignation of statutory auditor. If there is a statutory auditor who has been resigned in that current period, then you have to mention the if there is any issues or objection or concerns which is raised by the outgoing auditor, we have to consider that. Clause number 19 is going concern. Whether the company is able to pay off all the liabilities within a period of uncertainty, whether they have no material uncertainty as on the date of audit report. That is important. As on the date of audit report, that company is capable of meeting its liabilities at the date of balance sheet. Now, whatever liability is there in the 31st March in the balance sheet, they should be capable to pay it off within a period of 12 months. And there should not be any material uncertainty when I am signing the audit report. Otherwise, what will come into place? Subsequent event. Very good, guys. I'm very happy you have understood the concept actually. Then subsequent event will come into place. So, no material uncertainty should have existed when you are signing on the date of audit report. That company is capable of meeting the existing liability as on the date of balance sheet. That is 31st March, you have the liability. Whether they are capable of meeting that in a period of 1 year. CSR other than ongoing project, ongoing project. Other than ongoing project means the unspent amount they have to transfer to that special account within a period of 6 months to the expiry of financial year. Ongoing project means still it is ongoing, so you will be transferring that to a special account in compliance with 135 subsection 6. To a clause number 21 is consolidated financial statement. Under CARO reporting, in the consolidated financial statement, is there any adverse remark? If it is there, give me the details of the company and under what para number there was an adverse remark you will have to give. This is clause number 21 and we are done with CARO. No, எல்லாம் முடிச்சு கடைசியில மண்டை மேல இருக்கிற கொண்டைய மறக்க கூடாது. What is that கொண்டை? It is the applicability. Can we finish the applicability? Very easy, very easy. Just be with me, guys. It shall refer to every company, including a foreign company. Including whom? Foreign company. Basically, for remembering the applicability, you can remember it as any company which is big. Like public company, compulsory CARO has to be there. Big companies, compulsory has to be there. Like that you can remember, just be with me. It shall refer to every company, including a foreign company, except banking company as defined in section 5C of Banking Regulation Act, insurance company as defined under Insurance Act, company licensed to operate under section 188, one-person company and small company. What did I tell you? Small company ayirunda, it is exempt. Now we are reading the exceptions. It shall refer to every company including the foreign company except banking company, insurance company, section 8 company, one-person company, small company and private limited company if they have the following criteria. Now before I go to that private limited criteria, what is the definition of small company? Small company means what? Small company means the paid up share capital is less than or equal to 4 crores and turnover in the previous year is less than or equal to 40 crores. Please write down, I am not able to write here. The paid up share capital is less than or equal to 4 crores and turnover in the previous year is less than or equal to 40 crores. If you see, I use the word and. So both the conditions has to be satisfied to fall into small company. If it is a small company, then CARO is not applicable. Is that clear? Going to the private limited company. The private limited company not being a subsidiary or holding company of a public company. That means what? First I will explain this part. Now this is a private limited company. Your client is a private limited company. Now there is a holding company which is a public company. Public company means big company. Now in the holding company, if there is a big company, now automatically for your client also CARO becomes applicable. Is that clear? Now say for example your client is there and there is a subsidiary company and this is a public company. In this case also, Caro becomes applicable. Basically, public company ni engayavdu vandale Caro becomes applicable. Can you remember like that? It should not be this company. Your client company should not be a public company. Your holding company should not be a public company. Your subsidiary company also should not be a public company. So see here, a private limited company not being a subsidiary or holding of a public company which is having paid up capital and reserves and surplus not more than 1 crore rupees. Not more than means less than or equal to 1 crore rupees as on balance sheet date. What are they saying? Paid up plus reserves and surplus should be less than or equal to 1 crore. That is the first condition. And what is the second one? Which does not have total borrowing exceeding 1 crore rupees from bank or financial institution at any point in time during the financial year. What is the second point which is saying? Paid up capital and the second point is saying borrowings should be less than or equal to 1 crore rupees, and this borrowing can be from banks or financial institution, and they are saying at any point in time. That means you have to take the aggregate borrowing in hand, which does not have a total revenue. Your revenue is less than or equal to 10 crore rupees, and again here and. So both are and, all three conditions if they satisfy, then they are very small company. Paid up share capital and reserves less than or equal to 1 crore, borrowings less than 1 crore, and revenue also less than 10 crores. They are very, very small company. So usually I'll tell you where you'll get confused. Small company means paid up capital less than 4 crores and revenue less than or equal to 40 crores. Now there will purposely, they'll make you do all the calculation, and it will be paid up share capital will be more than 1 crore. Say for example, paid up share capital is 2 crores, borrowing is 3 crores, and revenue is 20 crores. Now you tell me whether Caro is applicable or not. You will see all of these limits and you will say yes, Caro is applicable. But I am telling you Caro is not applicable because this is a small company. The paid up capital is 2 crores. The limit is 4 crores. The revenue is 20 crores. The limit is 40 crores. So this comes as a small company. So Caro will not be applicable for 1% company, small company, and if it is a private limited company having paid up capital reserves and surplus less than or equal to 1 crore, borrowings less than or equal to 1 crore, and revenue less than or equal to 10 crores, that means it is a smaller company. So Caro will not be applicable. Is that clear? Did you understand this question that I told you? Purposely they will ask like this. They'll make you do these things and you will be like, yes, Caro is applicable. No. You also have to see small company limits. Is that clear, guys? Now, what did we see in applicability? It shall include all companies Caro is applicable, including a foreign company Caro is applicable, except for banking company, insurance company, Section 8 company, or a private limited company, 1% company and small company, or if it is a private limited company under the limits. What are these limits? Paid up share capital plus reserves and surplus less than or equal to 1 crore. Borrowing from banks and financial institution at any point in time less than or equal to 1 crore. And revenue, including revenue from discontinuing operation. Just because it's discontinuing does not mean it's not the revenue. So revenue including discontinuing operation less than or equal to 10 crores. If all these three conditions are satisfied, then Caro is not applicable. If it is more than these three, then only Caro becomes applicable after seeing small company limits. Are you all with me? Purida, Velangida, Sollu, please tell me, do you understand? Yes. Now we are done with Caro. Now one small thing I want to show you. Let me show you the Wipro audit report. I'll show you how it comes in Caro. See here, Caro is basically in SA 700. You would have seen report on other legal and regulatory requirements. Under this only Caro comes. Now if you see here, they would have mentioned as per company's audit report order. It is mentioned in Annexure B. You please go to Annexure B, they have told. Now I am going to Annexure B. In Annexure B, clause number 1, what did we see? PPE. In respect of PPE, company has maintained proper record showing full particulars and also situation of PPE. Company has maintained proper record showing full particulars of intangible asset. They have that physical verification. That is the second point. What is the third one? title deed of the immovable property. It is in the name of the company except for freehold land. See the last sentence. Except for freehold land. Carrying amount is how much? 404 million, for which the title deed is not executed in the name of company. They have not revalued anything, so no problem. And under Benami Transaction Prohibition Act, no proceedings have been initiated. Is that clear? Clause number 1. What was clause number 2? Inventories, physical verification, no discrepancy of 10%. Clause number 2, point number B. Working capital loan of excess of 5 crores. Do they have? Company has not been sanctioned. Clause number 3, loans, investment guarantee securities. Company has not provided any loan or advance in nature of loan. Investments made during the year are not prejudicial to company's interest. In respect of loan, the schedule of repayment of principal and payment of interest has been stipulated, and repayment has been as per the stipulations only. Based on audit procedures performed, there is no overdue amount as on balance sheet date. What is the next point? Loan which is given to subsidiary joint venture associate. Is it there? Yes, they have given to Wipro. Have they shown the aggregate amount and the percentage of the aggregate to total loan? See here guys, whether or not point is there. Caro reporting is compulsory if it is applicable to you. That is, if you are a big company, private limited means it has to be big company. Or if it's a public company, Caro automatically becomes applicable. You have to mention the aggregate amount and the percentage to the aggregate amount. Wipro LLC, they have given some 12,326 million. See here, million. Percentage is 99% of the total loan they have given to Wipro LLC. Now, according to information and explanation given to us and based on the company has not granted any loans repayable on demand. All clauses covered. Then going to all points covered in clause number 3. 4 is they have complied with section 185, 186. Clause number 5 is deposits as per section 73 to 76. Clause number 6, cost records as per section 148 subsection 1. Clause number 7, in respect of statutory dues, what is there? Undisputed statutory dues? No undisputed statutory dues is there. What is the statutory due which is there? So many. So many are there, and see the amount. Actually, they have to give only the forum where it is pending and the amount involved, but they have also given amount not deposited, period to which it relates, nature of dues. Yes, you see here 343 million. Is it in million? Yes. 343 million is pending with the Commissioner Appeals, the Customs Act. In which year? 97, 98. For so many years dispute is happening. This is the disputed statutory dues. Anything recent is there? Recent? Oh, I have taken 23. So maximum itself is 21, 22. So Goods and Service Tax Commissioner Appeals 930 million is under dispute. So all of these things have they told. Clause number 8 is what? No unrecorded income which is surrendered during the year. Clause number 9, repayment of loan. Company has not defaulted in the repayment of loan. Company has not been declared as willful defaulter. Company has not taken any loan where it is not applicable. Okay, leave that. Fourth point is overall examination funds raised on short-term basis not been used for long-term purpose. Company has not taken any funds for obligation of subsidiary joint venture, and the other one also it is not there. Clause number 10 is what? IPFPO section 62, 42. Whether they have mentioned that and for the purpose for which is that obtained only, they have said that if they have not raised the funds, so point itself is not there. Clause number 11 is what? No fraud by the company and no material fraud on the company also. 143 subsection 12, no report is there. Whether any whistleblower, yes, we have taken into consideration whistleblower complaints during the year. Company is not a Nidhi company, clause 12 is not there. Clause 13, related party, section 177, 188. Clause 14, in our opinion, company has adequate internal audit system. Now guys, when you become auditors, you have to prepare this CARO reporting. You will definitely become auditor of big company, yes or no? So definitely, you will be preparing this report like this. Clause number 13, related party, section 177, 188. Clause number 14, company has adequate internal audit system and they have considered the report. Clause 15 is what? Section 192. Clause 16 is what? RBI registration and all. All of those things is given. No resignation of statutory auditor. They have considered going concern. Nothing is there problematic. CSR also, they have no unspent amount. All of these points, they have given all the 21 clauses you have to mention. I hope after seeing a real audit report, you got the full clarity with respect to CARO, guys. Yes or no? Yes. Are you able to appreciate the subject? Are you able to appreciate what is CARO? Why you have to do this? Guys, 700 basically says What and all should be there in independent auditor's report? Caro is something, specifically these 21 points are important. So as an auditor, you give importance to these areas and you please tell me what is happening in these 21 areas. Like that, it is an additional reporting requirement. Is that clear? With this, the Caro comes to an end. Starting off with essay 570, going concern. Now, how many points are there for the mind mapping for going concern? 13 are there, starting off with meaning of going concern, significance of going concern, what this standard deals with, what is the objective of the standard, responsibility for assessment of entity's ability to continue as going concern, responsibility of the auditor, risk assessment procedures and related activities, examples of events or conditions that may cast a significant doubt on going concern, evaluating management's assessment, additional audit procedures, are there any examples of the audit procedures, auditor's conclusion, how he has to conclude and how he has to disclose, adequacy of the disclosure, if there is a material uncertainty, if there is no material uncertainty, and finally we'll be going to implications, that is 3 cases which is given here. Starting off with meaning of going concern. What is the meaning of going concern? Going concern means that the company is going to go on forever and ever and ever. Like how when boyfriend, girlfriend come together, you all would have done that to your boyfriend. What you will tell? Whatever happens, கடவுளே வந்து சொன்னாலும் I will definitely marry you only. You would have told that at least to one person in your life. Yes or no? Then what happened? Then what happened? What happened? Usually people will be making all these promises that they will be together. Love you forever. Like that you will put this symbol. That means what? Infinite. Forever and ever you are saying. But in reality, what will happen, only you know. I am not commenting on all those things. Like that, when you are preparing the books of accounts, when the management, Rudra is like, ma'am, you have taken the inner trauma out of my heart. Why, ma'am, you are reminding me all these things in audit class. How can we concentrate? Now, the same way the company also says that they are going on for ever and ever and ever. They don't have any intention to liquidate. They don't have intention to cease the operations. You would have studied GCA, Fundamental Accounting Assumption. What are they? Going concern, consistency and accrual. This is one of the most fundamental accounting assumption. The meaning of going concern is one of the fundamental accounting assumptions. Enterprise is normally viewed as a going concern, that is as continuing in operation for the foreseeable future. Whatever future I can see, I know that I am going to go on forever. Under going concern basis of accounting, financial statements are prepared on the assumption that entity is going concern and will continue its operations for foreseeable future. General purpose financial statements are prepared using going concern basis of accounting unless management intends to liquidate the entity or cease the operation or has no realistic alternative. Now, if they have an intention to liquidate, why not going concern? Then what basis of accounting will they follow? They will follow cash basis of accounting at that case. Now the second point is talking about significance or importance or the impact of the going concern. Now you all tell me, what is the significance or the impact of going concern? Who will see the going concern and why should they see the going concern? Who will see the going concern? That was my first question. The management is supposed to see the going concern because the management is the one who is preparing and presenting the financial statement. As an auditor, why is it important? What is the impact of seeing the going concern? Because it has a direct effect on the financial statements. Because if you prepare your financial statements as per going concern, you have to prepare a certain way. If you don't prepare as per going concern, then you have to prepare in cash basis of accounting. So all your values is going to change. So it has a direct effect on the financial statements. Now, if the going concern is used appropriately, if your going concern is used appropriately means it is properly used, then you will discharge your assets and you will realize your assets and you will discharge your liabilities accordingly. If going concern is not proper, then definitely you will have to go for cash basis, that is liquidation basis of accounting. Is that clear, guys? Significance of going concern is because of the effect on the preparation of financial statements. It has a direct effect on the FS. Ability or otherwise to be viewed as going concern affects its preparation of financial statements. When it is appropriate, assets and liabilities are recorded on the basis that entity will be able to realize its assets and discharge its liabilities. When enterprise is not viewed as going concern, then it is prepared as per liquidation basis. Liquidation basis means cash basis. Cash basis means, I'll tell you what, say there is a machinery. The machinery is valued at 10 lakhs. Then you'll put depreciation. It comes to 9 lakh 50,000. Again depreciation. It comes to 9 lakh 20,000. Like that it keeps on reducing. Is that the real value of the machinery? No, it is the book value of the machinery. If you actually have to go and sell that machinery, what will you get in return? Maybe 2 or 3 lakhs. So once you know that going concern is getting affected, automatically the value of that machinery comes down to 2 or 3 lakhs. Is that clear? Otherwise it will be at cost price minus depreciation, the carrying value of the machinery, or carrying that value for your books. That is the book value. Yes or no? So you will carry that, but once you know that it is going for liquidation basis, you will go for cash basis of accounting. That is the significance of going concern. This standard deals with auditor's responsibility as an auditor, what and all we have to see, and finally the implications. The implications is nothing but the cases I told you, the last part. So what is the auditor's responsibility? All of this is the auditor's responsibility. Going forward, what is the objective of the auditor? What is the objective of the auditor means what? Now there are two things that you have to see here. There is objective of the auditor and there is responsibility of the auditor. What is the meaning of objective? What is the meaning of responsibility? What is the meaning of objective? What is the meaning of responsibility? If I ask you what is your objective, it will be to finish CA Inter by whatever year. Now, if I ask you what is your responsibility, to finish off studying whatever happens in class every day. Whenever we see the workout, you have to write and practice and not just see. Like that, you have few responsibilities. You have to wake up in the morning and you have to come to class on time so that you won't even miss even a single word. That is your responsibility to achieve the objective. Yes or no? Same way here, two things are given, objectives and responsibility of the auditor. The objective of the auditor is that final conclusion where he wants to reach. The responsibility is to reach that. What is he going to do now? Is that clear? So objective of the auditor, there are three objectives here. First is, who is responsible for that going concern you told me? The management is responsible. As an auditor, we have to see whether this management has appropriately used the going concern basis of accounting. Appropriately used means what? If the company is really going concern, they have to use accrual basis of accounting. If the company is not going concern, they have to use liquidation basis of accounting. So whether the management has appropriately used the going concern basis, we have to see by obtaining sufficient appropriate audit evidence for that. That is the first objective of the auditor. Now, with whatever audit evidence that he has, he will have to conclude whether material uncertainty exists or not. What is the meaning of material uncertainty? It is a 50-50 probability that it can happen or might not happen. Like how you will be like after writing the exam. Did you do well? What you'll say? You will not say you did well also. You will not say you will definitely not did well also. But you will be like, okay, okay. You ask everyone, anyone who has written the inter exam, and when they come out, you ask them how you did. Single person also will not tell. Yes, ma'am, I did very well. I will definitely clear. Very rarely I will see those people, and those are the people who will clear. They will definitely clear. You should have that feeling that you will clear even before you go for the exam. Even before you go for the exam. Is that feeling possible? Yes, in your board exam, did you have that feeling? Yes. If it was possible that time, if it is possible now also. Before you go for exam, however they want, let them ask in the question paper. I don't care. I am prepared to answer. Your preparation level should be in that extent. If you see, most of the times, they don't ask out of syllabus question and all. 95% in syllabus only. They don't ask out of syllabus question. In syllabus only. But they will twist and turn the concepts and ask. If you have utmost conceptual clarity, there is no way you will feel like paper is difficult. There is no way you will feel like there is a maybe. You should have that level of confidence before you go to the exam. After finishing the exam, if someone asks how you did, samaya panna, like that, if you tell what other சொல்றதுக்கே முடியல like that, if you tell how other person will react, they will get scared. Yes or no? Samaya panniya edu? They will ask like that, yes or no? But you should have that feeling. Trust me, it is a good feeling to have. And if you put in that effort now, definitely you will have that feeling. But that effort is required from now, from this second, from this moment, not even from tomorrow. From now, that effort is required. Now, material uncertainty means there is a 50-50 probability. Say, for example, there is a lawsuit which is pending on the company. If a lawsuit is pending on the company, we don't know how the judge is going to give his verdict. So, if he says for the company, then we will save the money. If he says against the company, my going concern itself might get affected. I have to pay crores and crores of penalty here. So there is a 50-50 probability that the judge will give for or against the company. That is called as material uncertainty. As an auditor, our objective is to see whether there is any material uncertainty or not. And finally, in essay 700, contents of audit report, you would have seen one of the points as going concern. Yes or no? Paragraph for going concern separately must be there. That reporting as per essay 570. This is also one of the objectives for the auditor. There are 3 objectives for auditor. What are the 3? Obtain sufficient appropriate audit evidence that the management has appropriately used the assumption of going concern. Second is whether material uncertainty exists or not. And third is reporting as per essay 570. Now see these. Obtain sufficient appropriate audit evidence regarding and conclude on the appropriateness of management's use of going concern basis. To conclude based on audit evidence obtained whether material uncertainty exists relating to events or conditions that may cast a significant doubt on entity's ability to continue as going concern. To report in accordance with this standard. Is that clear? That is the objectives of the auditor. What is the responsibility of the auditor? What is the responsibility of the auditor? The responsibility of the auditor is again to obtain sufficient appropriate audit evidence to see whether material uncertainty is there or not. Now, responsibility applies even if financial reporting framework doesn't require the auditor to do something, because character, an auditor must have that character that even if it is not responsible as per the AFRF, he has to do it. There are few things like that. You have the character. If you find money on the floor now, 5 lakh rupees, something you found on the floor, what you will do? You will put in your pocket and go? You will donate it. You will go to the police station and you will give it. That is the responsibility applies. Even if there is no rule for you to do so. So responsibility applies. Even if financial reporting framework does not require to do certain things. That only is for going concern also. The auditor's responsibility applies even if financial reporting framework doesn't require him to do anything. Going concern is for what? Is for the next 12-month period, correct? Next 12 months, what will happen? How we know now? So the future are always uncertain. Future events are always uncertain. And this going concern, say for example, the auditor has said that going concern, everything is fine. Now, does that mean that in the future everything will be fine? No. You go to the doctor. Doctor says you're completely fine. You don't need anything. You're going back home. Can you say that nothing will come to your body for the next 1 year? No. Maybe today you are saying all these things. Tomorrow itself I can catch an infection. So same way, the absence of going concern warning is not a guarantee. Now see the text. The responsibility of the auditor to obtain sufficient appropriate audit evidence regarding and conclude on the appropriateness of management's use of going concern basis of accounting and in preparation of financial statements. These responsibilities exist even if the financial reporting framework does not include an explicit requirement. This is a responsibility. Whether or not it is a rule, as an auditor, you have to do all of these things. However, as described in Essay 200, the potential effects of inherent limitation on auditors' ability to detect material misstatement are greater for future event and conditions. So, the auditor is not in a position to predict such future event or conditions. Accordingly, the absence or any reference to material uncertainty cannot be viewed as a guarantee as to entity's ability to continue as going concern. So if they ask the responsibility, only the first point is talking about the actual responsibility. The 2, 3, 4, 5 are the disclaimers for that responsibility if you see. What is the first point? They are saying that the responsibility of the auditor is to obtain the sufficient appropriate audit evidence that the management has used the going concern principle appropriately. That is the responsibility. 2, 3, 4, 5 is disclaimer for that responsibility. They are saying I will give the responsibility, but even if it is not as per the rule, I will definitely give the responsibility. Third point, what is it saying? There are inherent limitations. I am giving the responsibility for the future. So something might happen, might not happen. It is only in God's hands. Like that, they are giving a disclaimer. What is the fourth point saying? Based on all of this, it is difficult for the auditor to predict what will happen in the future. And in the end, it is not a guarantee that this company is going to go on forever. So all these 4 points are disclaimer to that first point. So if they ask the responsibility for the auditor, first point you have to write it as first point. Is that clear? There won't be any meaning if you are going to write absence of reference to material uncertainty is not a guarantee for entity's ability to continue as going concern. If you start the answer with that, it doesn't convey the same meaning. Yes or no? You have to start with auditor's responsibility is to see the appropriateness of the management's use of going concern. How did you understand? Yes, these are the 5 points for responsibility of the auditor. Examples of events or conditions that may cast a significant doubt on the going concern. There are 3 topics here: financial event or condition, operating event or condition, other event or condition. What is that financial event or condition? I've already told you these 3 are very, very important because it is example. They can ask a separate case study for each of these examples. I'll tell you how. They will say there were creditors for, what's your name? Malini, Hema Malini Limited. There are creditors. Now what happens suddenly? Those creditors are withdrawing their support. Now as an auditor, tell what is your responsibility. Now withdrawal of support from creditor, you need to know that they are talking about going concern because it is one of the financial event or condition. If you see here, indication of withdrawal or financial support by the creditor. With that case study, you need to first connect here. and then they're asking the responsibility of the auditor. Are you understanding? They will not directly give going concern. They will give a case study based question using these indicators. Are you able to understand, guys? Now, what are the financial events or conditions? Net liability or net current liability position. With this, can they make a question? This numerical question also possible. They will say the assets is 1 crore. The liabilities is 2 crores. What is the objective? Nowhere they have mentioned it is going concern. You have to see assets 1 crore, liability 2 crores. Now that means it is a net liability position. That means they are talking about going concern. Like that, you have to connect the dots and come to this standard. Is that clear, guys? Net liability or net current liability position. Fixed term borrowing approaching the maturity without realistic prospects of renewal or repayment. Withdrawal of support by creditors. Negative operating cash flow. Adverse financial ratios, substantial operating losses, arrears or discontinuance of dividends. They can even make a question like this. Last year, dividend was paid for 1 crore. This year, no dividend is paid. Then you have to know that they have not paid the dividend right now. Next year, again, they are saying that they will pay the dividend, but they do not pay. So arrears of dividend is keep on accumulating, or discontinuance of dividend. Inability to pay the creditor on due date. Inability to comply with loan agreement. Change from credit to cash on delivery transactions with suppliers. Inability to obtain financing for essential new product. When you are not able to obtain the money. Support from creditors is not there. I am not able to repay the loan. Financial ratios, if you see, it is very adverse. All of these are financial conditions for affecting the going concern. Is that clear? Ignore those lines. Operating events or conditions. Management intention to liquidate or to cease the operations. Loss of key management without the replacement. Loss of major market, loss of key customer, loss of franchisee, loss of license or loss of suppliers. Labor difficulty, shortage of supply, emergence of highly successful competitor. Now material is not there, labor is not there, customer is not there, market is not there. If you've lost any of this, then you will come to going concern. Other events or conditions. Non-compliance with statutory or regulatory requirements such as solvency or liquidity requirements. Pending legal or regulatory proceedings against the entity that may, if successful, result in claims that entity is unlikely to be able to satisfy. Changes in law, regulation or government policy expected to adversely affect the entity. Uninsured or underinsured catastrophes when they occur. All of these are other events or conditions. Evaluating management's assessment. The auditor's job is to evaluate the assessment of the management with relating to going concern. At that time, it is not the auditor's responsibility to rectify the lack of analysis. In some circumstances, however, lack of detailed analysis by management to support its assessment may not prevent the auditor from concluding whether it is appropriate in the circumstances. So, the management has to see, the auditor will be checking whether it is appropriate for the management to use the going concern assumption or not. What are these additional audit procedures? If there is an event or there is a condition which is going to tell you that there is a significant doubt in the entity's ability to continue as going concern, that means any of these scenarios have triggered the financial indicators or operating indicators or other events or conditions. They have triggered for going concern. Then we as auditor, we have to obtain sufficient appropriate audit evidence to see whether material uncertainty is there or not. For that, we will be doing the additional audit procedures. Is that clear? Yes. Under those additional audit procedures, what are the points which is there? We will request the management to first make the assessment of going concern. You yourself see, sir, whether this company will go on forever. You make the assessment whether this company is having that going concern. Now the company is going to say, yes, sir, even though there is operating losses right now, I understand you are thinking this is an indicator for me to continue as going concern, but for this loss to get covered, I have a loan. That loan is already sanctioned. Like that, they are showing a plan. So as an auditor, we have to see whether that plan is feasible or not. That is the second point. What was the first one? We will require the management to do the assessment for the entity's ability to continue as going concern. Second, if they tell you the plan, we will be seeing whether the plans are feasible or not. Now you are saying, okay, you will get the loan. Based on this loan, what are you going to do? How will you improve your sales? Now they will say, now with this loan, I will spend for marketing. If I spend for marketing 10 lakh rupees, my sales will increase 10 times. That is the assumption that the management has made. Now, on what basis the management has done the assessment, we have to see as an auditor. Reliability of underlying data which is going to support the assumption. That is the third point. Fourth is if there are any additional facts which has to be taken. And finally, if auditor is not convinced and management is saying, yes sir, going concern is there, you please give it to me in writing. That is called as written representation. That is the last point, written representation. Now read all the 5 points which is given here. First one is requesting the management to make the assessment. Second, management will be giving the plans and auditor will be seeing whether the plans are feasible in the circumstances. Third is what? What are the assumptions on which you made the plan? Whether entity has prepared a cash flow forecast, analysis of the forecast, reliability of underlying data to prepare the forecast, determine whether adequate support for assumptions underlying the forecast. Fourth is what? Any additional facts or information, is it available? And finally, you will ask for written representation. Examples of audit procedures. Now, to do all of these audit procedures, what are the audit procedures that you will be doing? Now, for this only you guys made that CM. Okay. Lokesh Kanagaraj will come, correct? MSD, LCU, MSD, LCU and BIRD. Yes. What is that M? Minutes of the meeting of shareholder TCWG. What is S? Subsequent events. D. Debentures and loan agreements. L. Legal requirements. C. Cash flow and cash flow, profit and other relevant forecasts. U. Unfilled customer orders. B. Borrowing facility. I. What is I? Interim financial statements. R. Regulatory actions. D. Disposal of assets. That is MSD, LCU, BIRD. Examples of audit procedures. All of you together. What is M? Minutes of the meeting. S. Subsequent events. D. Debentures. L. Legal requirements. C. Cash flow, profit and other relevant forecasts. U. Unfulfilled customer orders. B. I. Interim financial statements. R. Regulatory action. D. Disposal of asset. Everybody together, what is M? Minutes of the meeting. S. Subsequent events. D. Debentures. L. Legal requirements. C. Cash flow forecast profit. U. Unfulfilled customer orders. B. I. R. Regulatory action. And finally D. Disposal of asset. This is examples of audit procedures. As additional audit procedures, these are the examples. Again, if it is given in dabba, that means it is very, very important. What is the auditor's conclusions talking about? The conclusions is basically relating to the objectives. What was the objectives? There were how many objectives that we saw? What are the objectives? To obtain sufficient appropriate audit evidence with regard to management's use of going concern. What was the second objective? To see if there is any material uncertainty whether it exists or not. And third objective was to report as per this essay. Yes or no? That objective for you was what? to finish CA Inter by this attempt. Yes or no? Same way, the objective is the conclusion in itself. So, auditor's conclusion is also going to talk about the objectives. That is, the auditor will evaluate whether sufficient appropriate audit evidence has been obtained regarding and shall conclude on the appropriateness of management's use of going concern basis of accounting. Isn't it the same? Based on audit evidence obtained, auditor shall conclude whether there is material uncertainty exists. Isn't this the same? Material uncertainty exists when magnitude of its potential impact and likelihood of occurrence is that, in the auditor's judgment, appropriate disclosure of the nature and implication of uncertainty is necessary. They're talking about the first 2 points. Is that clear, guys? If you have not written previously, please write now auditor's conclusions connected with objectives of the auditor. Next is the adequacy of the disclosure. That means if there is a material uncertainty, then what should you do as the auditor? The going concern is there, but there is a material uncertainty. Then what will you do? Going concern is there, but material uncertainty is there. You are not able to think of the example. Yes, material uncertainty is there. Going concern is also there. This is very irritating. Going concern is there and material uncertainty is there. Car is perfectly fine, but some light is blinking over there. How you will feel? It is perfectly fine. Engine is fine. Everything is fine, but some light is blinking over there. Then how you will feel? You know you will definitely go because you've tested the engine, but still you're a little scared because of that light. Yes or no? That is that material uncertainty is there, even though going concern is there. The company will go on forever, but there is some kind of a material uncertainty. For example, loan is falling due. It is not even come due. Due date has not even come. Loan is falling due. Only if due date has come and if the company is unable to pay, you will say going concern is getting affected. Now only it is falling due. So going concern is there and refinancing the company wants to go and that is not confirmed. If refinancing is not confirmed, we don't know what will happen in the future. 50-50 probability, material uncertainty will get affected. Is that clear? But loan has not even fallen due. We are not a defaulter yet. Going to fall due. So going concern, no problem. But there is a material uncertainty. In this case, what should we do? The auditor has to disclose the uncertainty and whatever the management is planning, that also the auditor has to disclose. If the auditor concludes that management's use of going concern basis of accounting is appropriate in the circumstances, but material uncertainty exists, then the auditor will determine adequately disclose principal, event or condition that may cast a significant doubt and the ability to continue and the going of going concern, and management plans to deal with these events or conditions. Disclose clearly that there is material uncertainty relating to events or condition, therefore that it may be unable to realize its assets, discharge its liabilities in the normal course of business. Are you able to understand? The first point is talking about adequacy of disclosure. How should the auditor disclose? If going concern is not affected, it is all fine, but there is a material uncertainty. See the second one. No material uncertainty exists, but going concern, there is a doubt. Doubt regarding going concern, but material uncertainty is not there. An example for that is, year on year there is losses. Going concern is getting affected. Cash losses, operating losses, all kinds of losses. This company is there. Going concern is getting affected, but material uncertainty is not there because loan is already approved for them. So, material uncertainty is okay, not there. But going concern is getting affected. There is a serious financial indicator. Read here. If event or condition that have been identified that may cause significant doubt on entity's ability to continue as going concern, but based on audit evidence obtained, he is saying that no material uncertainty exists. Then in that case, in view of requirements of AFRF, the financial statements provide adequate disclosure about these events or conditions. You have to talk about why there is a doubt in the going concern. There are so many losses, so adequate disclosure has to be made in the financial statements itself. Is that clear, guys? This is auditor's adequacy of disclosures. Next is implications for the audit report. The last part, 3 case study based questions can come here. Implication of audit report. The financial statements are prepared as per going concern basis of accounting, but the auditor feels that it is inappropriate. That means what? The way they have used the going concern is wrong. That means going concern is actually getting affected. Now, should you go talk to people? Directly you will use the weapon because it is affecting all the items in the financial statements. Is there a material misstatement? Yes, definitely. The auditor says going concern is getting affected, but the financial statements is prepared as per going concern basis of accounting. So you will use your weapon and you will give what report? There is sufficient appropriate audit evidence that there is a material misstatement and it is also pervasive in nature. So you will be giving a adverse opinion. Coming to the second case, the financial statements are prepared as per going concern basis of assumption, but there is a material uncertainty. There is a 50-50 probability. Now say for example the management itself has disclosed the material uncertainty. Then in that case, what opinion will you give? Unmodified opinion. We don't have any problem because they have disclosed it as per AFRF. So we will be giving a unmodified opinion. If they have not disclosed it, then you will be giving a qualified or adverse opinion because we don't know the pervasiveness of the case. There is sufficient appropriate audit evidence that there is a material misstatement, but we don't know the pervasiveness. If it is pervasive, you'll be giving adverse opinion. If it is not pervasive, you'll be giving a qualified opinion. Going to the third case, the management is unwilling to extend the assessment. The management is not willing to support you to do the going concern. In that case, there is no sufficient appropriate audit evidence. If there is no sufficient appropriate audit evidence, what opinion will you give? Qualified or disclaimer of opinion based on pervasiveness of the case. If there is no sufficient appropriate audit evidence, but you know that there is a material misstatement and you know it is not pervasive, you will be giving a qualified opinion. If there is no sufficient appropriate audit evidence, but you know that there is a material misstatement and it's also pervasive, then you will be giving a disclaimer of opinion. So in this case, you will go for qualified or disclaimer of opinion. I keep telling you, this part is very, very important because they can ask questions as an auditor. How will you react in this case? At that time, link to 705 is there, correct? So they can ask you this question, 570 to 705 link. Now quickly in this essay 570, what and all did we see? Let us see here. We started off with meaning of SA 570. We said this is a fundamental accounting assumption with no intention to liquidate or cease the operations. Significance of SA 570. This has a direct effect on the financial statements. So if the going concern is appropriate, you will be realizing all the assets and you will be discharging all the liabilities. If it is not appropriate, then you will go for liquidation basis of accounting. It deals with what? It deals with auditor's responsibility and the implications. What are the objectives of the auditor? The objectives of the auditor is to obtain the sufficient appropriate audit evidence with regard to the management's use of going concern basis of accounting, whether it is appropriate or not. What is the second objective? Whether material uncertainty exists or not. What is the third objective? Reporting as per the standard. The objectives, again we saw somewhere else. In the conclusions. Objective is conclusion, yes or no? What is the responsibility of the auditor? Only the first point is actually the responsibility. The remaining 4 points are the disclaimer for that responsibility. What is the responsibility? To obtain sufficient appropriate audit evidence to see whether there is a material uncertainty which exists or not. That is the responsibility of auditor. Next we enter examples of events or conditions that may cast a significant doubt on entity's ability to going concern. What were the examples? 3 types. Financial indicators, operating indicators and other indicators. Evaluating the management's assessment. What did we see there? Evaluating the management's assessment. See and tell. The preparation and presentation of the financial statement is the duty of the management. So when they are preparing and presenting the financial statement, they have to see whether it is going concern basis of accounting or not. So the auditor will evaluate whether management's assessment of entity's ability to continue as going concern is proper. Yes. if it is not the auditor's responsibility to rectify the lack of analysis by the management. But in some circumstances, the lack of detailed analysis will prevent use. What are the additional issues? If a condition has a doubt on the ability to conduct, but that there is no material evidence exists, that will be the additional audit. What are the additional procedures that we will do? He will go management to assess the ability to when he has made the assessment and he is saying he will what the plan is built on. He makes you assumptions. So there will be assumptions for this. The additional factors come to his notice. He will be getting written representation. Clear. Next one example of procedure is MSc, LCU word. Auditors conclude the audit responsibility was going to. Then we do adequate disclosure. No uncertainty exists. If there exists and no uncertainty has disclosed uncertainty and the management plans come back. Second, no uncertainty exists in that case. Going concern doubtful and no uncertainty in that case. What should auditor do? He should see that adequate disclosure is management. It's 3 points we saw here. The first one is financial statements prepared as per going concern and the audit feels going concern. There will be adverse opinion. Second, as per going concern. There is material disclosure in the case modified opinion. If it is not disclosed, they will give a qualified opinion. Third case, the management will question the analysis of the auditor, so we will give a qualified opinion. Second case, with necessary end. You see, we took about 10 minutes for the solution. At the same time, we needed 10 minutes for the recording. Like that, after you go home, you cannot take more than half an hour to go home and write just half an hour to write. Immediately, you have 4 minutes. Just 5 minutes. Go through all the points again. It will end your head. Just like SFI 70. Now, write SFI 70. You should know all the questions which is there in SFI 70. Starting from so, objectives, conclusions, people auditor, all of those questions first. Then you give writing answers for each and every question. If it is 9 marks, you have to do. Overload. Overload. So, this is the video I don't have. For you, it is like, alright, we go now to lunch break for it. Let's start off with essay 560, subsequent events. Quickly, let's go through the mind mapping. The first one is, what is the subsequent event? What are the objectives, meaning of date of FS is issued? Then events occurring between the date of the financial statement and the date of auditor's reports. Facts which become known to the auditor after the date of auditor's report but before the date the financial statements are issued. Facts which become known to the auditor after the financial statements have been issued. These three, you pause it for some time. For now, we will just finish this. What are subsequent events? Subsequent events you would have already studied in Accounting Standard 4. Subsequent events are those events that occurred between the date of the financial statements, that is nothing but 31st March, and the date of auditor's report. In our example, let me keep it as 21st of June. And the facts which become known to the auditor after the date of auditor's report. The financial statements will be affected by certain events that occur after the date of the financial statement. So 31st March, the financial statements are prepared and that financial statements is given to the auditor. Yes or no? Now the auditor has to sign the financial statements at a later date. In our example, it is 21st of June, saying that all the transactions happened till 31st of March is correct. Now based on this, it has to tell about the future of that entity. Now say something extremely material has happened after 31st March, which is going to affect the going concern of the entity, and if the auditor is going to sign that, is that correct? Saying everything is correct, I am giving an unmodified opinion, it is wrong on the auditor. That is the reason why subsequent event is even there. The financial statements will be affected for the events which occur after the date of 31st March. Many financial reporting frameworks specifically refer to these two types of events. This is as per your AS4 only. There already you would have studied those that provide evidence of condition that existed at the date of financial statements. Those that provide evidence of condition that arose after the date of financial statements. Say for example, there is a debtor. Debtor is of 5 lakhs and he has become insolvent after 31st March. Now, will we say that evidence of condition was existing or was not existing? Debtor was there as on 31st March. So, there is always a possibility that he will become insolvent. So, evidence of condition was existing at the date of balance sheet. Now, say for example, stock is 2 lakhs. After 31st March, what happened? Stock became 0 because of a fire. Was there any evidence of condition as on the 31st March? No, there was no evidence of condition as on 31st March because stock was there and fire there was no evidence as on 31st March. So we will say adjusting event and non-adjusting event. Adjusting event means if there is evidence of condition as on 31st March, you will adjust your financial statements. If there is no evidence of condition in our second example where there was a fire which happened after 31st March, then you will say that is non-adjusting event. So remember I told you 31st March you are saying stock is 20 lakhs and fire is happening on 30th of April. This is definitely a non-adjusting event. Now you tell me 31st March financial statements are there. On 29th of March there was a fire. There was a fire on 20th of March you keep. So this insurance claim will come only on 10th of April. So does this become an adjusting or non-adjusting event? This becomes an adjusting event because evidence of condition was existing as on 31st March. This actually is not as per standards on auditing, it is as per accounting standard 4. They have given few examples of events providing evidence that existed at the date of financial statements. Examples which arose after the date of financial statements: issue of a new share capital, merger of the company, destruction of inventory due to fire between the date of FS and date of audit report. Fire happened after 31st March. Then in that case it becomes a non-adjusting event because evidence of condition arose after the date of financial statements, that is after 31st March. Now only I am entering into SA 560, that is subsequent events. Under this we have three parts: events occurring between the date of financial statements and the date of auditor's report, facts which become known to the auditor after the date of auditor's report but before the date the financial statements are issued, facts which become known to the auditor after the financial statements are issued. Now again let me give you a timeline. 31st March the financial statements are completed and this will be given to the auditor. Say for example the financial statements are given to auditor, prepared and presented to the auditor as on 30th April. It is given to the auditor. Now the auditor will be giving his audit report again back to the management, and along with the audit report they will add other things and make that as annual report, and then only it will be given in the general meeting, annual general meeting. So this audit report, what is the date? 21st June. Now this audit report is given to the management and the AGM, that is the financial statements, are issued as on 30th July. On this date the financial statements are issued. Now there are three parts here. The first part is talking about events between date of financial statement and date of audit report. Now this audit report date, when I am putting the signature, I also have to consider all the events which occurred at this date. Now after I put the signature between the facts which become known to the auditor after the date of audit report but before the date the financial statements are issued, now I have put the signature. Here we saw events occurring, but here a fact which comes known to me at this period, which has happened before itself, but not only I am knowing about this. That is why the terminology here used is facts which become known to the auditor after the date of audit report but before the financial statements are issued. Why is this period important? Because when the financial statements are issued, we don't have the power. The audit report is already given. So here what should I do? For the facts which become known to the auditor after the financial statements are issued. Is that clear? Now the most powerful is which period? The most powerful for the auditor is the first period, because the sign is still not done, audit report is still not prepared. So if something material happens, he can immediately take his weapon out and he can modify. So the first one is talking about 31st March to 21st of June. That is date of financial statement to date of auditor's report. report. Here, auditor is still doing his audit procedures, yes or no? So the auditor will do the audit procedures for what? To obtain sufficient and appropriate audit evidence. What are the audit procedures that he will be doing? He will understand of the procedures that the management has performed to identify the subsequent events. Why should management identify the subsequent events? Now, AS4 is talking about adjusting and non-adjusting event. So, AS4 is for the auditor or for the accountant? It is for the management who is basically preparing and presenting the accounts. So, he has to know what is the subsequent event, whether it has to be an adjusting event, whether it has to be a non-adjusting event. He has to identify the subsequent event. So, we as an auditor, we have to see what is the procedure that the management performed to identify that subsequent event. Now we have to go and ask the management, that is called as inquiry. You will take a mic with you and you will ask, unga toothpaste la uppu irukka? So inquiry will be done with the management and TCWG. Now if you ask any kind of information, are they going to respond to you? No, they will just say, get out of my office. In that case, you yourself will go and see the minutes of the meetings. That means, minutes means what? The meeting has happened and they will write whatever has happened in that meeting for a documentation purpose. You will go and read that minutes of the meeting. Now, every company will make the budget for the next year. They will prepare the interim financial statements. Say, for example, till 21st June, the first period is covering. 31st March to 21st June, how many months are there? 2.5 months are there till 21st June. So, monthly financial statements they would have prepared. That is the interim financial statements or budgets. That also we will be seeing. So, to identify whether subsequent event is identified by the management, whether they have given the proper effect of this subsequent events, we will have to see. Second, you will go and directly ask them, inquiry with management and TCWG. Third, if they don't give any information, we ourselves will go and see the minutes of the meetings with the management and TCWG. And finally, we will see the budgets or the interim financial statements. Now, I told you, you will simply go and ask the management and TCWG. Means there is a possibility that they will not give any information. Specifically, you have to make the inquiry. For that specific inquiry, we have a mnemonic called AAABCD. What is this AAABCD? A stands for how are all the accounting policies, whether you are following them consistently, if there is any change, whether you have done the adequate disclosure. Second, any kind of accounting adjustments. Have you done any adjustments in your accounts? Please show that to me. I want to see whether it is done appropriately. Another is acquisition of assets. Have you acquired a major asset after 31st March or have you sold a major asset after 31st March? Because here I am signing, saying that asset is with you. You have the title of that asset. So I need to know whether you have sold or acquired an asset. That is AAA. What is B? Borrowings or any new commitment, because here I am signing that your borrowings is only 10 lakhs. Have you taken 1 crore of borrowings after 31st of March? Then my sign will become wrong. So I will ask a specific inquiry as to what is the borrowing that you have, if any, after the 31st March period. What is C? Contingencies. Any contingent liability, is it there for you? Have you made the adequate disclosure? And finally, whether government has destroyed or appropriated an asset. Have you seen in movies, government will come with huge bulldozers and they will just destroy the property? So something like that, has it happened? If it has happened, I definitely have to mention in my audit report that it has happened after 31st March. So when you are doing the inquiry, don't simply go and ask unga toothpaste la irukka. Please ask the AAA BCD for you to understand what is the subsequent event and how it is having an effect on the financial statements. This is the first part. And finally, you will be getting SA 580. What is that? written representation from the management that they have identified a subsequent event, and if they have identified whether it is adjusting, whether it is non-adjusting, whether they have shown that in the financial statements appropriately. You will have to ask that to the management. Yes, let's quickly finish the first part. Events occurring between the date of financial statements and the date of audit report. The audit procedures relating to events occurring between the date of financial statement and the date of auditor's report. Auditor will perform the audit procedures designed to obtain sufficient appropriate audit evidence that all the events occurring between the date of financial statement and the date of audit report which require the adjustment or which require disclosure, first of all, whether they have been identified. Obtain an understanding of the procedure that management has established to identify the subsequent event. Inquiry with management and TCWG as to whether any subsequent events have occurred which is affecting the financial statements. Reading the minutes of the meetings, reading the entity's latest interim financial statements, and also read the budgets. These 4 points you have to remember. And finally, the auditor will also request the management to provide a written representation, SA 580, that all the events occurring subsequent to the date of financial statements and for which the applicable financial reporting framework requires adjustments or disclosures have been adjusted or disclosed. Now, what is that inquiry which you have to do with the management and TCWG? A, B, C, D. A is accounting adjustments. Any unusual accounting adjustments is there. Another A is accounting policies, whether it is appropriately used. Another A is acquisition of assets or sale of assets. D, any new commitment of borrowings or guarantees which has been given. C is any contingencies or contingent liability which arise later. Or D is asset whether it has been destroyed by the government. Is it easy, difficult, hard? Very easy. Now the second part is talking about facts which become known to the auditor after the date of auditor's report, but before the date the financial statements are issued. Now you have to know what is the meaning of date the financial statements are issued. It reflects the date that the audit report and audited FS are made available to the third parties. It is not only the shareholders but all the stakeholders of that company will receive this audit report. The date the financial statements are issued generally depends on the regulatory environment of the entity. In some circumstances, the date the financial statements are issued may be the date that they are filing with the regulatory authority also, because not necessary that they have to always issue the financial statements to the public. Sometimes they will just have to give it to the regulatory authority. Since audited financial statements cannot be issued without an audit report, the date that audited financial statements are issued must not only be at or later than the date of audit report. So that's why I started with the flow. What did we see as the flow? Date of audit report is 21st June. Financial statements are issued. I told you the audit report will be given to the management. They will add other things and they will make that as annual report, and that annual report will be issued to the stakeholders in the general meeting. Now, can I say that the date of this audit report is after the financial statements are issued? No, it is not possible like that. That is the reason why they have given that sentence. They are saying the date that audited financial statements will not only be at or later than the date of auditor's report, but must also be at or later than date of audit report which is provided to the entity. Yes, first audit report is prepared, then it is given to the entity, and then only it is issued to the shareholders. Facts which become known to the auditor after the date of audit report but before the financial statements are issued. Now you tell me, you have put your signature and you have given that audit report, the date of audit report is done. But after you put your signature, you are finding out some part where if you have seen that previously, your opinion would have been changed. But that fact of that is coming to you only now after you have put the signature. In that case, should you again do all the audit procedures? Should you again get all the audit evidences? The auditor actually does not have any kind of obligation to perform the audit procedures after the date the audit report is given. So first you will have to discuss with the management. Why, sir? Why did this get missed? Why did you not give me this information beforehand itself? Like that, you discuss with the management. See if the financial statements actually require the amendments. If something is really material, then you can educate them saying, no sir, what we have done is wrong. You please change the financial statements. Now, is he going to change? In 99.99% he will say, now you'll ask me to change, again you'll sign one audit report and give me, again you'll come and ask me to change, you think I'm your servant or what? Like that he will ask. So normally he will not change. But that 0.1%, if he is a good person, like this princess, if he says, okay sir, I accept, if he is like that, then he will say okay for changing. So first you have to discuss with him and see whether the financial statement requires any kind of amendment. If the management says, okay, I will amend, then in that case, you will be doing the audit procedures and you will get the audit evidence. Now, in the case where management does not amend, management says, get out of my office, I cannot amend. Now you see, date of audit report you have signed and you have kept it here only, in the table only it is there. It's still not sent. Audit report is still with you. It is not provided. In that case, the weapon is still with you. Then you will go for SA 705 modification. If the audit report is provided, but it is given only to the management, they still have not issued, they still have not given. So, audit report is provided, you will ask them not to issue. Will they listen to you? If they issue without any amendments, then the auditor has to prevent the reliability. The onus is on the auditor. You do something, but you prevent the reliability. What you will do? You call the press. You call Sun TV, Vijay TV, Jaya TV. You call all those people and you give a press conference. Or you put the status. Or you put the Instagram story, you put a LinkedIn post, you do something, it is up to you. Standard is not commenting on that. But the auditor has to prevent the reliability if the management has issued without amendments. Is that clear? This is if management does not amend. Now the second part is facts which become known to the auditor after the date of audit report but before the date the financial statements are issued. They have no obligation to perform any audit procedures, so you will be discussing with the management, determine whether financial statement need amendments and inquire how they are going to address. Before the date the financial statements are issued, the management amends, then what will you do? After the date the financial statements are issued, this is the third case. We'll go to that a little later. Before the date the financial statements are issued, if the management amends the financial statements, then you will be doing your audit procedures, you will obtain your sufficient appropriate audit evidence and you will be giving the conclusion. If the management does not amend, you see who has the audit report. Audit report is still with you, then that means weapon is still with you. Modify the opinion as per SA 705. Audit report is provided to the management. In that case, you ask them not to issue it to the third parties. Nevertheless, subsequently it is issued without the amendments, then the auditor will take the appropriate actions to prevent the reliability on that report. The onus is on the auditor only. What is the third case? Third case is facts which become known to the auditor after the financial statements are issued. In our case, what is the date which we saw? 30th of July. Is that correct? Oh, very good. On 30th of, after 30th of July, if they come to know of anything, provided if he knew this before, he would have given a different opinion. Then in that case, does the auditor have any obligation? No. After the financial statement, after the audit report is given itself, he has no obligation to do the audit procedures. This is after the financial statements are issued. Here also, he has no obligation to do any audit procedures, but again he has to discuss with the management and TCWG, see if they are going to amend the financial statements, and once the management amends the financial statement, that 0.1%, in case the management amends the financial statements, now they are going to have two audit reports, yes or no? In the amended financial statements, all the audit procedures will be done, all the audit evidences will be obtained, and a new audit report will be given. In this case, you have to inform to the already issued users that something like this is there. So how will you do that? In this new audit report, you will give a reference to that previous audit report. In that EMP or OMP as per SA 706, you will be giving a reference so that the person who is reading this report knows that this is not the only report, there is something else, and that should be mentioned in EMP or OMP. The remaining 99.99% of the people, after the financial statements are issued, if the auditor goes and says, sir, this needs amendment, what are they going to say? Get out. They will say, no, I cannot amend. So management does not amend. In this case, the auditor has to prevent the reliance. The standard is not saying how you are going to do this, but auditor has to either give a press conference, press meet, LinkedIn, a selfie, story, whatever you want you do. But you have to prevent the reliance of that previous audit report which is signed by you. Is that clear, guys? Now going to the text of the facts known to the auditor after the financial statements have been issued. After the financial statements are issued, auditor, does he have any obligation to perform the audit procedures? No, he has no obligation to perform any audit procedures. So he'll discuss the matter, determine whether financial statement need amendments, and inquire how the management intends to do this. If the management amends the financial statements, now in the new financial statements, you will be doing all your audit procedures. Inform to already existing users. Obtain the amended financial statement, give the new audit report. But in the new audit report, you have to mention in the EMP and OMP as per SA 706. If the management says, get out, I will not amend, then you will take appropriate action to prevent the reliance on the audit report. Is that clear, guys? This is SA 560 revision. Listen here, guys. SQC1 and SA 220, both these standards are talking about quality of the audit. What is the difference between SA 220 and SQC1? What is the difference? Standards on auditing. SA 220 is only for audit engagement, but if you see SQC1, it applies for all kinds of engagement, say review engagement, audit engagement, and any other assurance engagement. Even for related services, this SQC1 will apply. Now, for both SQC1 and SA 220, there are common points. The first one is leadership responsibility, ethical requirements, acceptance and continuance of client, assignment of engagement team, engagement performance, and monitoring activities. Once you are done with all these 6 standards itself is over. 2 standards are over. Let's quickly see leadership responsibility. Now, whenever there is a question with respect to SQC1, the terminology that you will be starting your answer is policies and procedures. Now, please see here. The leadership responsibility, SQC1, requires firms to establish policies and procedures for what? The leadership is for the internal culture, because the leader is going to determine what kind of internal culture is there in the team. The best leader we all know is MS Dhoni. So what kind of culture he is having in the organization, you will have to see. The policy will require CEO or partner to assume the ultimate responsibility. Here it will be CEO or partner. On SA 220, it will be the engagement partner. So this CEO or partner should have sufficient appropriate experience, ability, and necessary authority. On the other hand, the engagement partner is responsible for the quality of the each and every engagement that he is entering into. He will be responsible that the work is complying with 3 kinds of standards, that is professional standards, regulatory and legal requirements, quality control standards, and he will ensure that the audit report is appropriate, and whatever team members, if they want to raise any concerns, they will be raising the concerns without any fear. Now we are in audit firm. For audit firm, what is the quality that they have to maintain? So for this entire standard, I want you to think of any of the big 4, your favorite big 4. My favorite is KPMG. So your favorite big 4 you can think. The second one is relevant ethical requirements. Here again your SQC1, you're going to start off with policies and procedures is going to be there for the firm as a whole and the personnel. ICA has something called as code of ethics. So this firm should have the policies and procedures saying that all the firm and the personnel will comply with the code of ethics which is issued by ICAI. Such policy should allow them to enable the firm to communicate the independence requirements. Independence means whenever they are accepting the client, they should be not related to the client in any way. So that has to be taken care of by the ethical requirements of SQC1. Identify and evaluate circumstances and relationship that create a threats to independence. What is threat to independence? If they are having a share, if the father of the person who is going for article is having a share also, it is a threat to his independence in that case. The responsibility of engagement partner, again he is going to talk about independence only here. So whenever there is ethical requirement question, the terminology is independence. Whether it is SQC1 or SA220, you will think about independence. Is that clear? For acceptance and continuance of client, SQC1 and SA220 both are talking about the same issue. 3 points are there: integrity of the client, competence to perform the engagement, and compliance with ethical requirements. Now, a firm before accepting the engagement, he should gather data about the client. In Big Four, there is a software called Sentinel, where if you just put the client's name, not only that client but the whole group will come there, and if there is any case on that group, a criminal activity by that group, anything if it is there will be collated by that Sentinel itself. Now that is going to talk about whether the client is of good integrity, if they have the competence, and whether they have complied with the ethical requirement. What is the meaning of integrity? With regard to integrity of a client, matters that a firm considers include the identity and business reputation of the owner, KMP, related party and TCWG, nature of client's operations, information concerning attitude of client's principal owner, KMP and those charged with governance, whether client is aggressively concerning with maintaining the firm's fees as low as possible, indication of an inappropriate limitation on the scope of work, indication that client may be involved in money laundering or criminal activity, reason for proposed appointment of the firm, and non-reappointment of the previous firm. What are they talking about? Integrity here. What is the reputation of them in the market? What is the nature of the business that they are operating? Are they involved in any illegal transactions? All of those things. What is the attitude of those charged with governance, managers, owners, KMP, and whether client wants to reduce your fees to the utmost lowest level, and inappropriate limitation in the scope of work. That means he will not allow you to do your work properly. Preconditions for audit is not present, or reason for non-reappointment of previous auditor. Previous auditor, if they leave the organization, what is the reason? It is our duty to ask them. So when we get the reason, why have they not reappointed them? All of these things will talk about the integrity of the client. Is that clear? The next is human resources. HR is very important because they will be recruiting the people for the job. That person should be for that job. In SQC1, the firm will establish what? Policies and procedures to provide reasonable assurance that sufficient personnel with capability, competency and commitment. They are talking about sufficient personnel with 3C. Sufficiency talk about quantity, so adequate quantity of people must be there for the 3Cs, that is capability, competency and commitment, for professional standard, legal standard and regulatory requirements. On the other hand, assignment of engagement team, who is responsible? The engagement partner is responsible, and he will ensure that all his engagement team members, along with any expert who has been recruited, they have the appropriate 3Cs. What are the 3Cs? Capability, competency and commitment with respect to the requirements, legal regulatory requirements. Is that clear? The next is engagement performance. This is the most important area. Here we will be talking about EQCR partner. EQCR stands for Engagement Quality Control Reviewer. Now who is this EQCR partner? Say KPMG is there. In KPMG, there will be one engagement partner who is taking care of one engagement. Apart from that, there will be 1,000 other engagements which is there and 1,000 other partners who are there. They will say this partner is going to be the EQCR partner of this engagement. Like that, they will appoint an EQCR partner. Now, what is this EQCR partner's job? Basically, whatever work is done by this engagement team, the EQCR partner is going to review that work. Whether the quality of that work is good, the EQCR partner will review. Is it compulsory to have EQCR partner? If it is listed entity, it is compulsory to have the EQCR partner. Is it clear? Engagement quality control reviewer partner. Significant judgments will be reviewed by EQCR partner for taking objective view before the report is issued. For all the listed entities, it is mandatory. For other engagements, the firm will say if it is risky area. In the Sentinel, basically it will give a score after seeing the background. Now, if that Sentinel says 3 out of 10 failed, in that case they will say that EQCR has to be appointed. If it is less than 5, like that, they will have the criteria in the firm itself. In case the engagement partner is there, EQCR partner is there. If there is some conflict between them, EP is saying something, partner is saying completely something else. If they feel like that, the report will not be issued outside to the client until and unless the issue is resolved. Is that clear? Now, there might be difference of opinion with engagement team and EQCR. The report will be issued only after resolving such issues. The matter of difference should be solved by establishing established procedures, that is consulting with another practitioner or another firm or a professional or regulatory body. Very, very important area, EQCR partner. SA 220 for audit engagement. What should we do? SA 220 is saying, you know that EQCR partner has to be there. The responsibility of the EQCR partner being appointed is that of the engagement partner. Everywhere for SA 220, if you see, engagement partner will be there. Engagement partner has the responsibility for direction, supervision and performance of the audit engagement. If EQCR is required, then engagement partner will determine that EQCR is appointed. He will discuss the audit report, he will discuss significant matters, and he will not date the audit report until EQCR review is complete. They can ask multiple choice questions here with regard to the date. Which date is correct? After EQCR date only, audit report dates must be there, and given to client must be only after that. Is that clear? EQCR is whom? For whom is it compulsory, mandatory? For listed entity, it is mandatory. EQCR is a person who is appointed by whom? By engagement partner itself. Now, if there is a conflict between the engagement partner and EQCR, then what will happen? It has to be issued before the audit report is given out. Now, if it is not issued, then the firm will have few policies for them to resolve it between themselves. For them, they will go for another practitioner or another firm or professional or regulatory body. The last part is talking about monitoring, because whatever is done, we have to monitor it, like how we are revising it again and again. Monitoring has to happen. Now here for SQC1, how will they start? Policies and procedures. Policies and procedures is how they will start, and SQC1 is talking about periodic inspection has to be done for completed engagements. For example, 5 years back, something has happened, opinion is given, signed, delivered to the shareholders also. Now I will take that from that burial ground and I will see if everything is correct or not. SQC1 is saying. So, completed engagements, periodic inspections has to happen. SQC1 is saying here, engagement partner will document 3 things. SA 220 is saying 3 things. The issues which are identified, conclusions on the complaints, and conclusions regarding acceptance and continuance of claim. Quickly, all the 6 again. First one we saw was leadership, where policies and procedures for the internal culture. Who is responsible as per SQC1? CEO or partner has the ultimate responsibility. On the other side, Engagement partner is responsible for the quality of each engagement. The second, we went for relevant ethical requirements. Here the policies and procedures for the firm and the personnel for code of ethics issued by ICAI. It should communicate, it should enable the firm to communicate the independence requirements. Here engagement partner should identify the threat to independence and reporting my engagement partner for determining the appropriate action. Acceptance and continuance, in both the cases 3 points are only there. Integrity, competence and compliance with ethical requirements. The next is human resource. Here policies and procedures to provide reasonable assurance that sufficient personnel, quantity of the people for that work should be adequate. 3 C's and laws and regulations. Same here, engagement partner for the engagement team members and also the experts who are employed. They should also have the 3 C's for the 3 laws. Engagement performance, most important area, we saw about EQCR partner, where EQCR partner will be appointed by the engagement partner. Where engagement partner is there, SA 220 is saying. About the EQCR partner, SQC1 is saying. Now what are they saying? It is mandatory for all the listed entities and the report must not leave the organization without the approval of EQCR. If there is conflict of opinion, then they have to resolve that issue, then only give it to the client. Is that clear? The last one is monitoring, where XQC1 is saying periodic inspection has to be done for the completed engagements. That side, documenting 3 things. What are the 3 things? Issues which are identified, conclusion on complaints and conclusion on acceptance and continuance of client. Easy. 10 minutes we finished SA 220 SQC1. Yes or no? Okay, 15. Shall we start off SA 299? Yes, in the mind mapping, we'll be seeing what is the meaning, how the work is divided based on responsibility. If work is going to be responsible, if work is going to be divided, which auditor is responsible for what work, what is the advantages and disadvantages, joint or combined responsibility and special considerations regarding joint auditor. Basically, what is the meaning of joint audit, guys? Joint auditor is 2 or more auditors, or you can say as more than one auditor or an audit firm is coming and they are doing the work. So how will the work be divided between them? It can be divided based on assets or liabilities, income or expenditure, geographical location, identified units and period. That means if they say that work is divided based on assets or liabilities, I am saying Samira Reddy will take care of assets and Sushmita Sen will take care of liabilities. Income and expenditure, Samira will take care of income, Sushma will take care of expenditure. Geographical area, north, south. So Samira Reddy will take care of north, Sushmita Sen will take care of southern operations. Identified units, for this we took the example of Tata. Tata has so many segments like car segment, fashion segment, textile segment. This is only textile segment, FMCG. Like that they have multiple segments. So each of the unit will be taken care of, each of the auditors, that is divided based on units. Or one financial year, they will break it into half. Or they can break it into 4 parts. And they will say first part you take care, second part you take care. Like that they can split the work between different auditors. That is how work is divided based on these 5 things. Joint audit implies pooling together the resources and expertise of more than one firm of auditor. They are saying more than one firm of auditors to render an expert job. Usually it is prevalent in huge companies and corporations. Usually in bank audits, if you see, we saw the audit report, correct? 2 auditors would have signed. So usually for huge corporations or for bank audits and all, there will be multiple auditors who are going to sign the same audit report. Is that clear? Now, responsibilities of the joint auditor. Now, if 2 people are going to do the job, who is responsible for which work? We have to know. So, if the audit work is divided, individual or separate responsibility, say for example, profit and loss one person is taking care, balance sheet is one person is taking care, work is divided. So separate responsibility for P&L will be there, separate responsibility for balance sheet will be there. But what about notes to accounts? It is not divided. So if the audit work is not divided, then both of them will be responsible for the notes to accounts, that is joint or combined responsibility. So responsibility of joint auditor, if audit work is divided, that work, that auditor, individual or separate responsibility. If audit work is not divided, then combinedly everyone will be responsible for that work. The next one, we are done with meaning, work divided based on, and responsibilities. The next is advantages and disadvantages of joint auditor. For this example, 4 people we took: investment advisory, Roshan, Naresh, Shiva, Hemanta. Only 4 people we took. Investment advisor only is Hemant. You don't know that also. Now, these 4 people, they are expert in their own fields. Roshan is expert in trust, Shiva was expert in Statod, Naresh was expert in taxation, and this guy is expert in investment advisory. So 4 of them are expert in their own field, so they can share the expertise. That is the first advantage. If they have any issues between themselves, or if they have any confusion between themselves, they can mutually consult with each other and they can proceed forward. Advantage of mutual consultation. If one person itself has to do the entire job, then it will take lots of time and effort, because it is split into these 4. Then workload is reducing. Because they are focusing on their niche of work, the quality is increasing. Improved service to the client, this is also increasing. Work will be spread using the expertise of local firm, which are in a better position to deal with detailed work. Now, if I have to send one person to north also, south also, east also, west also, how much time, how much effort, how much cost will be there? Now, because north person is taking care of north operations, south person is taking care of south operations, my cost, overall cost, and my staff development cost comes down. Now, when one person has already finished the job, other person slowly they are going, they're calling and asking. Same way when you're studying also. One person, if they finished, other person now only opening the book. Now you call that person, Macha, you started, hey, I finished. Now how you will feel? You will feel that tension. That is the healthy competition, sense of healthy competition towards a better performance. All of these are advantages. Whenever there are advantages, there will definitely be disadvantages also. For this, what example we took? PwC and who? PwC and Naresh. Say for example, if these 2 are there in joint audit, there won't be communication between them. The superiority complex, I am bigger than you, mutual consultation cannot happen. So psychological problems will come. General superiority complex, problem for coordination of work. Now P&L 1% take care, balance sheet 1% take care, notes to accounts, who will take care? No, one person is going to say, hey, that is your job. Other person is going to say, I thought you are going to do it. Like that, they are going to fight between themselves. So common concern, whatever is there, that may be neglected. Uncertainty about the liability for the work done. Last point is, you said that cost reduces. One person can't go to different places. Yes, overall cost reduces. Yes, overall the staff cost also reduces, but at the same time the fees that we are going to get, that also is going to split into half. So fees has to be shared. That becomes a disadvantage. How many points in advantage? How many points in disadvantage? 9 in advantages, 6 in disadvantages. How many are there in advantages? 9. What are the points? Sharing of expertise, advantages of mutual consultation, lower workload, better quality, improved services for the client, lower cost, lower staff cost, lower overall cost. Then finally, there will be healthy competition. Only 8 points is coming. Oh, for MNCs, based on their expertise, work can be divided based on that. What are the disadvantages? 6 points are there. What is the first one? Fees is being shared. Psychological problems, common concern gets neglected, superiority complex is there, coordination between work is difficult, and last, uncertainty about the liability. Now, for few works, they will have a joint or combined responsibility. What are the works for which they'll have the joint or combined responsibility? For any work which not being divided, they will have the joint or combined responsibility. If, one second, why it is coming like this? What is the reason for hiccups? Anyone knows? Someone thinking. Dr. Amaran told. Really, I am asking. Anyone knows why we are getting? No one knows. Stomach is settled. That is for babies. For kids, when they get the hiccups, they say they are growing. Now, what I'll do by growing more? Stomach is in good condition. Huh? They say it is good. One person will say, see, one person is saying someone is thinking about you. One person settlement of stomach. One person don't know. No one knows. What is the reason? What? I think that is the reason. I think that is the reason. I think body needs the oxygen. So, like that it will take. Come back, guys. Now, joint or combined responsibility, when will they have? The first one is if the work is not divided at all, then both of them will have joint or combined responsibility. For common audit areas, when they're splitting the work itself, you take care of P&L, you take care of balance sheet. Notes to accounts, both of us will take care. So commonly they are allocating the areas first itself. For that also, both of them will be responsible. If one person is bringing an issue and others have agreed for it, for example, everyone are saying it is a unmodified opinion, it is a clean report. One person has found out in one part that going concern is actually getting affected. Now he is coming with this matter and other people are looking at that matter and saying, yes, you are correct, going concern is getting affected. I am going to change my opinion to adverse opinion. Now everybody has changed their opinion to adverse. Now they have all accepted for it. That means everybody together they will be responsible. Matters brought by one and agreed by all. The next one is for the financial statements that it is prepared as per the AFRF. For the financial statements that it is as per the statute, that it is as per the law. Can you say this person is responsible for that? No. Everybody together, all the auditor and the audit firm together, they will be responsible for that. So financial statements as per law, financial statement as per AFRF. For that they will have joint or combined responsibility. Now audit report, how many reports they will be giving? They will be giving a single report. If they have common opinion, they will be giving only one report. For that one report, who is responsible? Everybody together they are responsible. So for audit report also they have combined responsibility. That audit report is as per all the ICAI pronouncements and other guidelines, they have combined responsibility. So joint or combined responsibilities, there are 5 points which is given here. The first one is for the work which is not divided. For all the common audit areas, they have joint or combined responsibility. If a matter is brought by one person and is agreed by all the other people, they have joint or combined responsibility. Financial statements as per law, financial statements as per applicable financial reporting framework, they have joint or combined responsibility. And lastly, for the audit report that they are giving, that the report is as per the ICI pronouncement, they have joint or combined responsibilities. Now coming to the report. Now you all tell me, if they all have one opinion, then they will be giving how many reports? Single report. Now if they have multiple opinions and if 10 different auditors are there, how many reports will they be giving? They will be giving 4 reports and not 10 reports, because there are only 4 types of opinion: unmodified, qualified, adverse, and disclaimer of opinion. There are only 4 different opinions, so 4 different kinds of maximum reports are possible. So if they have, it may be noted that joint auditors will be giving a common audit report. In case if there is a disagreement, then what will they do? They'll have separate audit reports. But whenever they're having a separate audit report, now you tell me, the users of the financial statements, when they see one report, they see that it is an unmodified report. But should he know that there are also other reports where adverse is there, qualified is there, disclaimer is there? For that, the reference has to be given in other matter paragraph as per SA 706. Is that clear? So if they all have a same opinion, then they'll be giving a common audit report and they will be signing together in that audit report. If they have any difference of opinion, then they'll get different audit reports. But in each of their audit reports, in other matter paragraphs as per SA 706, they must mention that there are also other opinions, there are also other reports. Please refer to that report, like that they have to mention in OMP. Is that clear? Now last part, special considerations regarding the joint auditor. Under that, few points are given. The first one is, see, whenever joint audit happens, whenever any kind of audit happens, the engagement partner will go for all the meetings. The engagement partner will plan everything and it will be communicated to the team members. But here in joint auditor, they are saying the engagement partner and the engagement team members must be involved in the planning process. From the beginning they have to be there, and they will be establishing an overall audit strategy for the entire team, and before the commencement itself the plan has to be made. The plan will be made when? Before the commencement of the joint audit, the plan has to be made. Now regarding joint audit, they will be identifying the risk of material misstatement even before they start the audit. Misstatement means mistake. Material misstatement means important mistake. Risk of material misstatement means there is a possibility of a mistake happening in a specific area. So if the risk of material misstatement is high, then they will do more audit procedures. They will increase their sample size and all of those things. So before they enter into the audit only, they will be seeing what is the risk of material misstatement. And finally, they have to document the nature, extent and timing for all the common problems and also for any specific issues if it is there. The engagement partner and other key members should be involved in planning the audit. The joint auditor should establish a overall audit strategy which sets the scope, timing and direction for the audit. Before commencement, they must have a joint plan. In developing a joint plan, the auditor should important these 5 points. Inside it is there possibility that ICI can ask. Directly if they ask what are special considerations regarding joint auditor, everyone will study this and go. But if they are going to ask before the commencement, how are they going to develop the plan, then you have to write these 5 points. Identify the division of audit areas and common areas. Ascertain the reporting objectives of the engagement. Consider the factors that are significant in directing the engagement team's efforts. Consider the results of preliminary engagement activity. Ascertain nature, extent and timing of the resources. These 5 points are written here. First one is division of audit and the common areas. Second, ascertaining the reporting objectives. Third, factors which is going to direct the engagement team's efforts. Fourth, what are the preliminary engagement activities? And last one is nature, extent and timing of resources. This is for which question? Before commencement, they are going to have a joint plan. How they are going to have the plan? They will be identifying the audit areas, common areas. They will be identifying the reporting objectives. They will see what is the engagement team's efforts. Then they will do the preliminary engagement activities. Now you understood from where this is coming. Now we are under special considerations regarding joint auditor. Under that, about 7 points are there. First one is engagement partner and engagement team member must be involved in planning. The second is they will have an overall audit strategy which is giving them the scope, timing and direction for the audit. Third point is they will have the joint plan, and before commencement the joint plan has to be there. For that only 5 points are there. The next one is risk of material misstatement which has to be communicated to all the other auditors. The next is documenting the nature, extent and timing of audit procedures, and finally there will be a common engagement letter and common management representation letter. Lastly, there will be something called as work allocation document where each of the partners or each of the auditors has to sign on that work allocation document so that I know that okay, you have accepted that duty. In case there is a problem in the future, I will exactly come and ask, why didn't you do your work properly? Like that I will be able to ask. This is SA 299, joint audit of financial statements. Easy guys. Very easy. Starting off with the revision of SA 505, that is external confirmations. What is the meaning of external confirmation? A direct written response, which is written response is obtained from the third party and it is directly given to the auditor. SA 505 external confirmation deals with auditor's use of external confirmation procedures. Now this standards on auditing is talking about what the auditor has to do with that external confirmation that he has received. That is the auditor's use of external confirmation procedures to obtain the audit evidence. SA 500 indicates that reliability is influenced by its source and by its nature and is dependent on individual circumstances. Now this source is from the organization or outside the organization? Outside the organization. So the reliability for the external confirmation is very, very high. Quickly going through the mind mapping, we will be seeing the objective of the standard, few definitions that you have to know, important terms, the uses of external confirmation, where and all you can use this external confirmation procedure, what is the procedure that you have to follow, 4 steps are there, and management's refusal to send the external confirmation. If the management is not allowing you to get the external confirmation from third party, then what should you do? Now, if the management allows and you've received that external confirmation, results of the external confirmation procedure, what should you do with that information? Can you rely on that information? And finally, we will be seeing what is negative confirmation and when we will be using negative confirmation. Is that clear? The first one is the objective of the auditor. When using external confirmation procedure is to design and perform such procedures to obtain relevant and reliable audit evidence. Why relevant and reliable audit evidence? Usually audit evidence has to be sufficient and appropriate audit evidence. Yes or no? Under sufficiency, it is quantity. That means quantity is affected by 3 things. What are the 3 things? Risk of material misstatement, size of the population and materiality. These 3 things are for sufficiency, that is the quantity of audit evidence. But now we are talking about external confirmation. That means we are only bothered about the quality, that is appropriateness. Under appropriateness only relevance and reliability comes into place. That is the reason why the objective of the auditor is, it is for such procedures to obtain the relevant and reliable audit evidence. Is that clear? Everywhere you will be seeing SAI. This is the only place you will be seeing R&R audit evidence. Definition. What is external confirmation? It is a direct written response to the auditor from the third party. It can be in paper form or electronic form or any other media. Say for example, the auditor is asking the management itself to get that
external confirmation. Now the management is getting from a debtor and giving it to the auditor. Is that okay? No, because it has to be direct only. The auditor is sending a friend to the debtor's place, getting that confirmation and coming. That also is not acceptable. It has to be a direct response from the third party to the auditor. No people in between these two people. Is that clear? That is the definition. Going to important terms, there are 4 terms that you have to remember. One is you will have to say yes or no. When you ask a girl out, what you will want, you will ask her to say yes or no. You all are accepting. If she says no also, it is okay. That is good. You should accept whatever is coming from that side. That is called as positive confirmation. If she doesn't say anything and go, and she goes off, but still you are considering that as yes, that is called as negative confirmation. Maunam samadam. That is negative confirmation comes only if that other person is disagreeing with whatever you are saying. Only then they will respond to you. Otherwise they will just stay silent, and you will, silence means acceptance. You will consider like that. That is negative confirmation. Non-response means what? The other person is failing to respond to you. Now say for example the other person is giving the information, but he is giving partial information. That is also called as non-response only. Non-response means failure to respond or failure to fully respond. Both are coming under non-response. Exception means I have this debtor's figure in hand with me for 5 crores. Now when I ask that person, he is saying that I need to owe only 1 crore. So the exception means the remaining 4 crores, the difference between the information that I am having and the difference between that confirmation that I am receiving. So that is called as exception. Read through the theory. Important terms: positive confirmation request, negative confirmation request, non-response and exception. A request that confirming party responds directly to the auditor whether he agrees or disagrees with the information in the request. Whatever it is, he will communicate. That is called as positive confirmation request. What is negative confirmation request? A request that confirming party responds directly to the auditor only if the confirming party disagrees with the information which is provided. Only if he says no, he is going to come and give the information. If it is yes, he will just stay silent. What is non-response? A failure of the confirming party to respond or fully respond to a positive confirmation request, or a confirmation request returned undelivered. Even if it doesn't go to that person in mail, there will be something called as mailer daemon. That means if you send an email to somebody and if it doesn't go to that person, that email address does not exist, this mailer daemon will send it back to you, and if you go inside it will say that this email ID does not exist or something like that. So this request has returned back to you undelivered. That is also considered as non-response only. Non-response means fully they are not responding, or partially they are not responding, or this is not going to them itself. In all these 3 cases, we will call that as non-response. What is the meaning of exception? A response which indicates a difference between information requested to be confirmed or contained in the entity's record and information provided by the confirming party. The exception needs to be assessed to the entire population after analyzing the reason for difference. Is that clear? What is the meaning of exception? What is the meaning of non-response? What is the meaning of positive and negative confirmation request? Use of external confirmation. Where and all can I use this? Where can I go and disturb that third party? You can disturb him if you want him to confirm any terms of agreement or contracts. Say for example, year on year rent is paid for 1 lakh rupees and suddenly there is an escalation. Rental always escalates every year. Escalation is of 5%. Now you want to know if this is correct or not. You will see the contract. You will see the contract. Yes, it is there. Now this contract is by the management and some third party. Now you will say, okay, you have this contract. I want to see the contract of the third party also. He will have a copy of the contract. So now I am going and disturbing the third party. So that is confirming the terms of agreement, contracts, transactions between entity and third party. For any transaction which is happening between entity and an outsider, the auditor can come inside and he can disturb the outsider. Purchase transaction, sale transaction, any kind of expense, you can disturb the third party to the organization, because expense can be for what? Rent, salary, wages, office equipment, stationery, all of those things. So even if you say stationery expenses 5 lakhs, from whom you got that stationery, you please give me that contact. I can contact him and I can get an external confirmation. Amount due to lenders, amount due from lenders, property title deeds which is held by lawyers and financiers as securities. Because sometimes what will happen, when they give collateral, they will give the property as collateral and get the money. Say for example, I want 1 crore rupees loan. If I want 1 crore rupees loan, I will give a property for 1.5 crores to the banker and I will get the money for 1 crore. Now that banker is having the title deed of this property. Now when I went and asked the management, what will the management say? I don't have the title deed, sir, the banker is having. Now you go and disturb the banker to get the external confirmation. External confirmation means you are going outside the organization. That only is third party. That's why direct written response from third party to the auditor. There are few procedures when you have to approach somebody. Now when you go and give that flower to the girlfriend, prospective girlfriend, and you want to propose, first you have to, step 1 is determining the information to be confirmed or requested. How you are going to say that I love you? Simply if someone comes and says, I love you, what you will give? Slap. Yes or no? You will give that tight slap. What is this? You have to put that mane, tene, punmane, and then frame that letter, and then you have to make a huge setup, beautiful setup. All these things are important. So you have to first determine the information which is to be confirmed or which is to be requested. Select the appropriate confirming party. Now say for example, Abdul Kalam wants to tell to some girl. What Abdul Kalam is doing? He is telling to princess. He is telling to Darshan and he is telling, can you tell to that girl? What Darshan will do? He will take that girl. From that time he is very bad in his behavior. So you have to be very careful. If you have to tell to girl, you have to directly go and tell to girl only. So selecting the appropriate confirming party. Don't select this stupid friend next to you. He will take your girl and he will go. So you select the appropriate confirming party. Designing the confirming request. The way you tell. That is the most important thing. This is the most important thing, because packaging, we love good packaging. Yes, you all told me some chocolate. Kinder Joy, worst chocolate, but beautiful packaging. Inside they'll give some toy and they will make all the customers buy this. All kids' favorite chocolate is Kinder Joy only. They have designed it so well, even though the chocolate is bad, they are able to sell those chocolates. That is designing the confirmation request. And finally, you will send that request. You will send that letter. Like Ambi, you will write that full paragraph, 5 pages, and you will give to Nandini. Now, will Ambi just give once and leave it? Again and again he is asking Nandini, Eppo solluva, when you will tell me, like that he will ask or not. So follow-up request is also important. Sending the request, including follow-up request. 4 steps are there. First one is determining the information to be confirmed. Second, select the appropriate confirming party. Third, designing the confirmation request. And fourth is sending the request, including follow-up request. All 4 points are important. The first step is determining the information to be confirmed or requested. External confirmation procedures frequently are performed to confirm or request information regarding account balances and their elements. Usually they'll go for balance sheet items.
they are saying. They may also be used to confirm terms of agreement, contracts and transactions between an entity. P&L items also will basically, for anything you can do that external confirmation, guys. Frequently they used for account balance, that is balance sheet items, but you can also use for P&L items, for contracts, for agreements and all of those things. Sometimes you will do the external confirmation to confirm the absence of side agreement. What is the meaning of side agreement? Side agreements are agreements which is basically like an addendum to the original agreement. For example, when you want to propose to girl, if she's already having the boyfriend or she's having a brother who is going to gym regularly, all these things are important. Who is around her also you have to know. Like that, when you are confirming an agreement, you also need to know if there is any side agreement which is attached to the agreement. Now usually whenever there is an engagement letter which is given, engagement letter is prepared usually for 1 year. So for the next year, if there are not many changes, I am only going to increase the period of that engagement letter. So instead of doing everything from scratch, I will just add a specific sheet of paper which is called as addendum, which is called as side agreement. Say for example, in the rental agreement, it is written that every year escalation clause is 5%. Now I don't want to change anything in that rental agreement except for that escalation percentage. I want to make it 7.5%. In that case, I will add a side agreement and I will say that all the agreement is same except for this para number 11. In para number 11, the changes are from 5% to 7.5%. Now both parties are agreeing, you put the signature. So for anything, if you want to make a minor change to the agreement, then you can have a side agreement. So as an auditor, whatever is given to us have to be complete. For that, we will be asking, is there any side agreements? So for confirming that, we'll have to ask, determine if the information to be confirmed or requested. What is the information? The information which has to be requested also should include any absence of side agreement. Are you giving me the complete information? Like that you have to ask. Step number 2 is selecting the appropriate confirming party. You have to select the people properly. Responses to confirmation requests provide more relevant and reliable audit evidence. When confirmation requests are sent to a confirming party, the auditor believes is knowledgeable about the information which is to be confirmed. Say for example, here in one case we saw property title deed held by financiers as security. The banker is holding the title of your property, of the management's property. Now we as auditor, we have to go to the banker and we have to get that external confirmation. Yes or no? What we are doing, we are going till the bank, but we are asking the security guard. Will he give any kind of information? No. Is he a knowledgeable person? No. He will not know the account details and all. So in the knowledge of the auditor, if he believes that this person has the appropriate knowledge, then you can ask the appropriate confirming party for the information. Step number 3, I told you design is the most important one. Designing the confirmation request. Factors to be considered by auditor when designing confirmation request include. There are a few factors that the auditor has to keep in mind when he is designing the confirmation request. Say for example, I want to know whether a particular asset is given to the banker as collateral. Now, if I give external confirmation asking what is the value of the asset, is it holding the same assertion? I am asking for confirming the valuation, but in reality I want to know the title. So I am looking at two different assertions. So the factors to be considered by auditor when designing the confirmation request. The first one is, what is that assertion that you are addressing? What is the risk of material misstatement which can happen here? What is the layout of the presentation? What is the prior experience on the audit or similar engagements? What is the method of communication? Is the management okay for me to go and disturb those third parties? Are the management authorizing or are they encouraging for those third parties to give us the information?
The ability of the intended confirming party to confirm. Now we are thinking that he has the information and we are going and telling the information, but they are not able to give us any kind of information. That is the last point. These are the factors when designing the confirmation request. There are 7 factors which you have to keep in mind. What are those 7? Assertions being addressed, identified risk of material misstatement, the layout and presentation of the confirmation request, prior experience on the audit or similar engagement, method of communication, management's authorization, and finally, whether the confirming party is having the ability to confirm or respond. So these 7 are the factors which is basically considered by the auditor when he is designing the confirmation request. Designing the request for third point. For which question? Designing the request is the third point for we are studying procedure. Procedures which has to be done by the auditor for giving the external confirmation. Under that, step number 1 was the information which has to be confirmed. Step number 2 was selecting the party who has to confirm the information. Step number 3 is designing the request. Under designing the request, the first point was for under design of a confirmation request. That was the first point. The second is factors to be considered when he is designing the confirmation request. The third point is positive confirmation request. Positive confirmation we already saw in the definition. Whether he agrees or disagrees, the confirming party has to respond. The positive external confirmation request asks the confirming party to reply to the auditor in all cases, either by indicating the confirming party's agreement or by asking confirming party to provide the information. This can happen by two ways. One is, I am telling you that the accounts show that the debtors is 5 crores and your name is there, 5 crores is there. Are you confirming this? If yes, you please respond. If no, also you please respond. This is one way of asking. The other way is, in my books of accounts, I can see that debtors is there. Can you please let me know the amount? That is another way of asking the same information. Now, in the second case, we are giving a blank paper where they are filling and they are giving us the information. Which one is more reliable? The second one is more reliable. The auditor may reduce the risk by using positive confirmation requests that do not state the amount on the confirmation request and ask the confirming party to fill in this amount or furnish other information. Is that clear, guys? Now the fourth one is determination of properly addressed requests. Determining that requests are properly addressed, including testing the validity of some or all of the addresses on confirmation requests before they are sent out. And finally, step 4 is sending the request, including the follow-up request. Sixth Roman is management's refusal to allow. Quickly, let's go to the mind mapping again. The first one was the objective, definition, uses of external confirmation. We finished the procedures and now we are going to management's refusal to send the external confirmation. Now say for example, management is refusing to go for external confirmation for the reason that that debtor is in coma. Is it reasonable? Yes, it is reasonable in nature. If it is reasonable, you perform the alternate audit procedures. Now in this alternate audit procedures, are you obtaining sufficient appropriate audit evidence? You are good to go. You have the sufficient appropriate audit evidence. Say for example, they gave the reason, it is reasonable, you are trying to do the alternate audit procedures, but you are unable to get any kind of information through these alternate audit procedures, or you are unable to do the alternate audit procedures. In that case, you will be going for SA 705. You will be going for SA 705 modification, but before that you also have to communicate with the TCWG, that is
SA 260 has to be done. Is that clear, guys? Now, if it is reasonable, if you are able to do the alternate audit procedures, then no problem, you'll be obtaining the sufficient appropriate audit evidence. If you are not able to do the alternate audit procedures, then nobody can save you. You have to take the weapon out, that is SA 705. But before you take the weapon, you please mention that to those charged with governance, that is SA 260. Is that clear? Now, in the second half, the information that they are giving is not reasonable. He is simply saying he is in coma, but you can see in Instagram he is dancing and he is putting the reels there. Then in that case, it is not reasonable. That means what? Directly you will go for modifications, and you will also have to inform those charged with governance. So again, refusing for external confirmation. If it is reasonable, you will be doing the alternate audit procedure and you will be obtaining the sufficient appropriate audit evidence. If it is not reasonable, you will go for modifications with SA 260. And if it is reasonable and if you are not able to do the alternate audit procedures, again you will go for SA 705 modification and SA 260, communicating with those charged with governance. Is that clear? Now going to the theory part. Management's refusal to allow the auditor to send a confirmation request. The auditor will first inquire as to management's reasons for the refusal and seek the audit evidence as to their validity and reasonableness. Evaluate the implications of the management's refusal. What is the management saying? Debtor is in coma. Please don't disturb him. That is the implication on the risk of material misstatement. Perform alternative audit procedures which is designed to obtain relevant and reliable audit evidence. If the auditor concludes that management's refusal to allow to send is unreasonable, or the auditor is unable to obtain relevant and reliable audit evidence from alternative audit procedures also, in that case, he will communicate with TCWG under SA 260 and he will determine the implications under audit and the auditor's opinion under SA 705. He'll go for modifications. If the management refuses to send for external confirmation, inquire management, evaluate implications. If reasonable, perform alternate audit procedures, obtain the SAI. If it is reasonable, cannot perform alternate audit procedure 260 and SA 705. If it is not reasonable, directly 260 and SA 705. Same thing is given in this paragraph. The next one is talking about the results of external confirmation procedures. Now say for example, the first part, the sixth Roman number, we saw that the management is not allowing you to communicate with the external party, that is a third party, confirming party. In the seventh case, the confirming party has given some information to you. Now you are having doubts about the reliability. Say for example, that debtor is his best friend. Now he has told that 5 crores I have written in my books of accounts. Oru loose varuvan, avan kepan, avan enna ketalum you say what is the answer as 5 crores. Like that they already have a dealing. Now in this case, you will have to see whether you can rely on that information which was given by the third party. If you have doubts about the reliability, you don't know whether you can rely on this or not. In our Pratap example, we didn't know whether we can rely on that or not. We had doubt initially, but after some days it was confirmed. No need after some days, after few minutes it was confirmed that he is a full fraud. If you have doubts about the reliability, you go for further audit evidences. If it is completely not reliable, then you evaluate implications on your risk of material misstatement. Is that clear? Reliability of responses to confirmation request. If the auditor identifies factors that gives the rise to doubts about the reliability of the response to a confirmation request, then he will go for further audit evidence to resolve the doubt, because it is only a doubt about the reliability. If the auditor determines that response to a confirmation request is not reliable, he has confirmed that it is not reliable, then he will evaluate implications on the wrong. If that is not reliable, can we give a modified opinion? No, only if there is a material misstatement in the financial statements, we will be going for modifications. If that third party is giving non-reliable information, what can the management do for that? It can be an error or a fraud by the third party. The management might not be involved.
So we will only evaluate implications on the assessment of risk of material misstatement. Now the last part, which is about negative confirmation. Negative confirmation means only if they disagree, they are going to respond to you. Otherwise, they'll just have a non-response and you will accept that as agreement. Yes or no? Now, can you use this negative confirmation for all the scenarios? No. You will be using the negative confirmation only in these 4 scenarios. The first one is the risk of material misstatement is very, very low and has obtained SAI regarding operating effectiveness of controls relevant to the assertions. Already I have the sufficient appropriate audit evidence somewhere else. So here I can be a little relaxed and ROM is very low. The second one is the population is subject to small homogeneous account balance class of transaction and disclosures. What is small homogeneous? Homogeneous means they are similar to each other. They are same. So if they are same as each other, in one place I have already gotten the audit evidence. In the other place, if I don't get an external confirmation also, it is okay. So in that case, I will go for negative confirmation request. A very low exception rate is expected. You know that this person will definitely respond to you. Only in that case, you will go for this. When will you know that that person will definitely respond to you? Say for example, he is a debtor. Debtor means what? Person who has to give or person who has to get the money? Person who has to give the money. He has to give the money. Say for example, the debtors is 5 crores and the auditor feels that debtor is overstated. If the auditor feels that debtor is overstated, that means in reality it might be only around 1 crore and in the books of accounts it's shown as 5 crores. Now he has to give the money. If in reality, if he has to give only 1 crore and in books of accounts it's shown that he has to give 5 crores, in this case, I can go for negative confirmation because I will be sure that if there is a mistake in the amount, especially if I know that it is overstated, then I can go for negative confirmation because you just think in the other person's shoe. I am suddenly going and saying, sir, you have to give me 5 crores. Is it yes or no? If he really has to give only 1 crore, will he immediately respond? Yes, you know that the exception rate is going to be low for overstatement of debtors. The auditor feels that debtors is overstated. Same way for creditors. Understatement of creditors. Creditors means the company has to give the money. Say for example, the company has to pay somebody 5 crore rupees and the auditor feels that this amount is understated. That means it is actually not 5 crores, it is 10 crores. So the company has to give 10 crores, but in books of accounts it's mentioned as 5 crores. In that case, I can go for negative confirmation because in the shoes of the other person, if you see, he will definitely respond if he has to get 10 crores. Yes or no? So depending on the assertion that I am addressing, I will decide whether the exception rate is high or low. If I know that the exception rate is going to be low, then I can go for negative confirmation request. Is that clear, guys? What is the last one? The auditor is not aware of the circumstances or conditions that would cause the recipients of negative confirmation would disregard such requests. They are using double negative here. The auditor is not aware that the third party will disregard. Disregard means he will not respond or he will just throw that question in the dustbin. He will just move your mail to the recycle bin. All those things. You know for sure that he will not disregard. He will not throw it in the dustbin. That means he will definitely respond. Only in that case you can go for negative confirmation. Negative confirmation, 4 points are there. What are the 4 points? The risk of material misstatement is low. He is obtained sufficient appropriate audit evidence somewhere else. Large number of homogeneous population, low exception rate, and auditor is not aware that he will disregard. So in these 4 cases you can go for negative confirmation request. What is positive confirmation request? Whether he agrees or disagrees, the confirming party will be responding. Results of external confirmation procedure, you have small doubts about the reliability. In that case, what should you do? Further audit evidence. You know for sure that it is not reliable. Will you go for modification? No, it is not reliable for the information which is given by the third party. In that case, you will just see whether it is implying whether it is affecting your risk of material misstatement. You will see the implications on the risk of material misstatement. Now, if the management is saying, no sir, you cannot go and disturb the third party, then you will ask for reasons for the same. If it is reasonable, you will obtain the sufficient appropriate audit evidence. If it is if it is reasonable, you will perform the alternate audit procedures and you will obtain the sufficient appropriate audit evidence. If you are not able to perform the alternate audit procedures, you will go for modifications, but you will inform to those charged with governance, that is as per SA 260. If the reason that the management is giving is not reasonable, then in that case also you will go for modifications SA 705. But before that you will inform to those charged with governance as per SA 260. What are the procedures that you have to follow for giving the external confirmation? There are 4 steps which is given here. The information which is to be confirmed. Selecting the party to get the information. Third, design of that request, and fourth is sending the request including follow-up request. Now under design we saw 4 points. The first one was design only. The second is factors to be considered for designing by the auditor. What are the factors? The assertions, risk of material misstatement, layout and presentation, previous year's experience of the auditor with that third party, what is the method of communication, and whether the management is authorizing or allowing the third party to give the information. Anything else? To ability to confirm of that third party, whether he has that ability, that also we'll have to check. All these are factors to be considered by the auditor for designing the confirmation request. And finally, what is it? Positive. Yes, what is positive request we saw, and last, whether it has been properly addressed. Next, what are the uses of this external confirmation? Uses: confirming the terms of agreement, contracts, transactions, and property title deed held as collateral with another financer. So these are just examples which is given. This is not a exhaustive list, it is a inclusive list, because if you see, amount due to lenders is given, amount due from lenders is not given, but for that also you can get an external confirmation only. What are the terms? Positive, negative, you know. Please tell me what is non-response. Non-response, they are not fully responding, or partial non-response is also non-response. Failure to respond or failure to fully respond is a non-response. What is exception? Difference between the amount as per the books and the amount that the confirming party is giving you. What is the definition of external confirmation? What is the definition? It is an audit evidence which is obtained as a direct written response from the third party to the auditor in paper, electronic, or any other medium. From back to front we have come, and with this SA 505 comes to an end. SA 510, SA 510 is initial audit engagement, opening balances. This standard is basically there because when the auditor puts his signature, he is not only signing for the current year, but he is also signing for the previous year information, because sales, purchase, everything you write, you will be giving the current year and you will be giving the previous year information. So this signature is valid for this figure also. Yes, that is the reason why SA 510 is actually there. And the standard deals with auditor's responsibility with relating to the opening balances. This opening balances is not only the amount but also the disclosures. You should not forget that. It is not only the amount but also the
Disclosures. So first of all, why we have the standard you understood, and what is covered in the standard you understood. Not only amount but also disclosures. Now you all tell me, in case the previous year is not audited at all, is it very risky? Yes, very, 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 very risky. So SA 501, 510 will come into place here. In the previous year, it is audited, but it is audited by some other auditor. That is, it is audited by a predecessor auditor. In this case, is it still risky? It is not very, very, very risky, but yes, it is risky. In the previous year, it is audited by the same auditor. One auditor can be appointed for 5 plus 5 years, then only cooling period of 5 years. So the same auditor is the auditor for the previous year also. Here, is it risky? No, it is not risky. So SA 510 does not cover the third area. The first and second area it definitely covers. What is the first one? In the previous year it is not audited at all, or in the previous year it is audited by a predecessor auditor. In these two cases SA 510 will come into place. And SA 510, not only the amounts but also the disclosures. Did you understand till here? Yes? Read the text till here. This standard deals with auditors' responsibilities relating to opening balances when conducting an initial audit engagement. In addition to the financial statements amounts, opening balance includes matters requiring disclosures also. Quickly, the mind mapping. Here SA 510 talks about the definition, objective, audit procedures, and 2 cases which is given here. Now, definition of initial audit engagement. An engagement in which either the financial statements for the prior period were not audited, or the financial statements was for the prior period was audited by a predecessor auditor. So there might be a case study based question where the financial statements are audited by, they'll give a name, they'll not use the terminology predecessor auditor. They'll say Darshan. Now the current year, Shalini is appointed as auditor. Now what you have to know, automatically your mind has to go to SA 510 because they're talking about some other auditor was there for the previous year. Going to the second one, objective of auditor with respect to opening balances in conducting an initial audit engagement. In conducting an initial audit engagement, the objective is to obtain sufficient and appropriate audit evidence with regard to 2 things. One is there any material misstatement in the opening balance which is predominantly affecting the current year position also? The second thing, the entire standard is talking about these 2 things only. One is whether any amount in the previous year is affecting the current year figure. The second thing is with regard to accounting policies, because accounting policy has to be followed year after year. Darshan, come back to auditing class. CA Darshan sonna odane, ma'am, CA Darshan, so nice to hear. He went off there itself. Come back to class. Now, where were we? Accounting policy has to be consistently followed. Appropriate accounting policy reflected in the opening balances have been consistently applied in the current period financial statements. If there is a change, whether it has been adequately presented, whether it has been disclosed as per the accounting standard. Is that clear? So basically the objective of the auditor with respect to SA 510 is to obtain the sufficient appropriate audit evidence with regard to any misstatement which is there in the opening balances, whether it is going to affect the current period. And the second one is talking about accounting policies, whether it has been consistently followed. If it is not consistently followed, whether it has been adequately presented and disclosed as per applicable financial reporting framework. Third is audit procedures regarding opening balances. Quickly just going to the mind mapping. We are done with the definition. What was there in definition? An engagement in which the financial statements for the prior period was not audited, or it was audited by a predecessor auditor. That was the definition. In the objective, what did we see? To obtain sufficient appropriate audit evidence. That is the way you have to start. Don't directly start off with misstatement in the
opening balance. Don't start with that. The objective as an auditor is to first get the evidence that if there is any misstatement in the opening balance which is affecting the current year balances. The second point is whether accounting policy has been followed consistently. If not, whether it has been presented or disclosed appropriately. Going to the third one, that is the audit procedures regarding the opening balances. The first audit procedures that the auditor has to do is read the recent financial statements and the predecessor's auditor's report thereon for any information regarding opening balances, which is including the disclosures. So the first audit procedure is reading the financial statements. That is the first procedure that the auditor will do. What is the second procedure? The auditor shall obtain SAI about whether opening balances contain misstatement that materially affect the current period financial statement by determining whether prior period closing balance have been correctly brought forward. For example, previous year it was written as 54,234. Now in the current year, when you are bringing it forward, it is written as 54,423. Is it possible? In olden days when the standard was created, it is possible. Right now the computer is doing the job. So right now this point is actually irrelevant. Determine whether prior period closing balances have been correctly brought forward to the current period or when appropriate any adjustments have been disclosed. Determine whether opening balance reflect the application of appropriate accounting policies. The first point is talking about opening balances, whether it has been carried forward properly. Second point is talking about accounting policies. Performing one or more of the following. What are they saying? Where the prior year financial statements are audited, perusing the copies of audited financial statements including other documents, evaluate whether audit procedures performed in current period provide evidence relevant to opening balance, perform specific audit procedures for the opening balance. Now, what are these 2 points talking about? This is easy. Whether prior year financial statements are audited, you will be reading the copies of audited financial statements or any other documents which is relating to the prior financial year. Now the second and third point you have to understand. Say for example, you are doing your audit procedures. In your P&L, there was something called interest expense of 5 lakhs. On this 5 lakhs, you are doing your audit procedures. When you are doing your audit procedures on the interest expense, you found out that the opening balance of that loan itself is wrong. What is interest expense? How is this calculated? A percentage of the opening balance of the loan. So you are basically doing the audit procedures on the current year for you to find out that there is a mistake on the opening balance figure. Is that clear? That is this point. Evaluate whether audit procedures performed in the current period provide evidence relevant to the opening balances. Are they giving evidence? This interest expense was giving evidence for the opening balance of loan, yes or no? The second one is talking about doing the audit procedures directly on the opening balances. In this case, we did the audit procedures on the current year figure. Then that gave some evidence with regard to opening balance. The auditor also has to do audit procedures directly on the opening balance, because to see the closing stock, he will see purchases, he will see sales, he will also see the opening stock, yes or no? In this case, he will be doing the audit procedures on the purchases, audit procedures on the sales, and audit procedures on the opening stock also. In this case, he is doing audit procedures directly on the opening balances. That is the next point. Performing specific audit procedures to obtain evidence regarding the opening balance. Is that clear? Yes. Now, audit procedures regarding opening balances. How many points did we see? The first point is the auditor has to read the most recent financial statements and also the auditor's report. Then he will obtain SAI by ensuring that the opening balances does not contain any material misstatement which is going to affect the current period by seeing that whether it has been brought forward correctly. That means whatever amount is there in the previous year has been correctly brought forward to the current year also. Determine whether opening balance reflect the application of appropriate accounting policy. Whether prior year, if it is audited, perusing the copies and evaluating whether audit procedures performed in current period provide the evidence relevant to the opening balance. This is the interest example I told you. The next one is performing specific audit procedures to obtain evidence regarding the opening balances. Here audit procedures will be done on opening stock to find out about closing stock. Here audit procedures was done on the interest expense, and by mistake he found out that loan outstanding, opening loan outstanding itself, there was a misstatement there. Going to the two cases. The first case is talking about if you have an audit evidence that you know that there is the material misstatement in the opening balance and it is materially affecting the current year figures also, then in that case what should you do as the auditor? Say for what should you do? Additional audit procedures is what you will do. Now in that additional audit procedures also you are concluding that misstatements exist. Then you will communicate with those charged with governance and management. Is that clear? Here will you go for any modifications? Will you go for any modifications? No, this is still pertaining to the previous year. Case number 1, if the auditor obtains audit evidence that the opening balance contained misstatements that could materially affect the current period financial statements, the auditor will perform additional audit procedures as are appropriate in the circumstances to determine the effect on the current period's FS. If the auditor concludes that such misstatements exist in the current period financial statements, then he will communicate with appropriate levels of management and those charged with governance. Now, if there is a material misstatement and it is material in the current period and it is misstated, then finally, after communicating with those charged with governance, they are not doing anything. Finally, you are going to use your weapon. You cannot do anything. But this standard is not talking about it. This standard is just saying if there is a misstatement and it is material and it is affecting the current period financial statements, see if it is material for the current period financial statements. And then you communicate with the appropriate levels of those charged with governance and management. That's all the standard is saying. Case number 2 is talking about accounting policies. Here there are only two things again and again. One is misstatements in opening balance, and the second one is accounting policies not consistently followed. So here case number 2 is the current period's accounting policies are not consistently applied in the relation to opening balance in accordance with AFRF, or a change in accounting policies is not properly accounted for or not adequately present or disclosed in accordance with AFRF. What are they saying? It is not as per applicable financial reporting framework means it is not as per accounting standard. If it's not as per accounting standards, there is a material misstatement. If there is a material misstatement, then you have to give what opinion? You have a sufficient appropriate audit evidence that there is a material misstatement. You don't know about the pervasiveness of the case. At that time, you will be giving a qualified opinion or a adverse opinion. Reporting by SA 705 by auditor regarding opening balances. If the auditor is unable to obtain SAI regarding opening balances, then the auditor shall express what opinion? Qualified or disclaimer of opinion, because if there is no sufficient appropriate audit evidence, he has to see that there is a material misstatement. Pervasiveness, if it is there, he will be giving a disclaimer of opinion. If it is not there, he will be giving a qualified opinion. So if the auditor is unable to obtain SAI, he will be either giving a qualified opinion or disclaimer of opinion in accordance with SA 705. If auditor concludes that opening balance contains a misstatement that materially affect the current period financial statements and the effect of the misstatement is not properly accounted for or not adequately presented or disclosed, then the auditor shall express now you have the sufficient appropriate audit evidence, but you don't know whether it is pervasive or not. Now you will be giving either a qualified or a adverse opinion. Is that clear between the first and second one? The first point is talking about having no sufficient appropriate audit evidence. The second point is talking about you have the sufficient appropriate audit evidence and it is
materially misstated. So regarding the pervasiveness, you will see if it is pervasive, you will be giving an adverse opinion. If it is not pervasive, you will be giving a qualified opinion. Is that clear, guys? Now quickly let's go through the entire standard. Essay 510 initial audit engagements, opening balances. What is the definition of initial audit engagement? First of all, this initial audit engagement, the auditor will be seeing only the amount or amount plus disclosure. He'll be seeing amount plus disclosures. Definition of initial audit engagement. An engagement in which either the financial statements for the prior period were not audited or the financial statements for the prior period were audited by a predecessor auditor. What is the objective of the auditor? It is to obtain a sufficient appropriate audit evidence for what? That the opening balances, if it contains any misstatements, whether it is going to affect the current period. If you see the objective, that only is the conclusion also. In the two cases when we saw, finally what did we see? That there was a material misstatement in the prior period which is currently affecting the current period. As an auditor, what opinion are you giving? If it is currently affecting and if it is material in the current year, you will be giving a qualified or adverse opinion. Like that they are concluding from that objective, if you see. Yes? So the second objective is appropriate accounting policies has to be consistently applied, and if there is any change, whether it has been presented or disclosed. What are the audit procedures that you have to do? You have to read the most recent financial statements and the auditor's report. See whether the prior period closing balances have been appropriately brought forward to the current year. Second is appropriate accounting policies, whether it has been followed. Evaluate whether audit procedures which is performed in the current year is showing any misstatement in the opening balance, or any audit procedures directly on the opening balance also you will be doing. Case number 1 is talking about what? That there is an audit evidence in the opening balance, and that misstatement, that there is an audit evidence that there is a misstatement in the opening balance, and that misstatement is material in nature, and that misstatement is also affecting the current period. In that case, you will be doing additional audit procedures and you will be communicating to those charged with governance. Now continuation to down. You have communicated to those charged with governance and you know that it is material for the current year also. Now that there is a material misstatement in the current year, you have the sufficient appropriate audit evidence regarding the pervasiveness of the case. You will be giving either a qualified or a adverse opinion. Now going to case number 2, if the auditor we left off in case number 1 only, correct? Case number 2, if the auditor concludes that accounting policies is not as per AFRF, they are not following the accounting standards, now you have the sufficient appropriate audit evidence that there is a material misstatement, but you don't know whether it is pervasive in nature. So again, you will be giving a qualified or a adverse opinion. Going to the next part. If the auditor concludes that, now I am in the second part, the first one we already finished. If the auditor concludes that the opening balance contains a misstatement that materially affects the current period and the effect is not properly accounted for or not adequately presented or disclosed, then he will be giving a qualified or adverse opinion. First part only we didn't do. The auditor is unable to obtain the sufficient appropriate audit evidence. Now he does not have sufficient appropriate audit evidence based on pervasiveness. He'll be either giving a qualified or a disclaimer of opinion. Few additional points to note. Consistency of accounting policies relating to opening balances. We saw that relevant information in the predecessor audit report has to be there. Audit conclusions and reporting should include the opening balance also, and modifications to the opinion in the predecessor auditor's report, we will have to take care of that. Say for example, closing stock, Nala they have given an adverse opinion in the predecessor auditor report. Now, should we also consider that? Obviously, it will have a direct impact on our opening stock and again our closing stock. So, as an auditor, we have to consider the modifications to the opinion in the predecessor audit report also. Is that clear? With this, essay 510 comes to an end.
705, I'm going to start off with the mind mapping for 705. Please be with me. Here we're going to see the scope of the standard, objective of the standard, types of modified opinion,
which type of opinion is appropriate. In case if you are not able to obtain sufficient appropriate audit evidence, what you have to do. Form and content of the audit report for modified opinion. That is, if it is a qualified opinion, what should be the text that you will be giving. If it is an adverse opinion, what should be the text and disclaimer of opinion. Basis for opinion, how should it be? 8 cases are there. Auditor's responsibility when the auditor disclaims. If there is a disclaimer of opinion, what should be there, what should not be there. And communication with TCWG. This is with regard to SA 705. The first one is scope. SA 705 is modifications to the opinion in the independent auditor's report. The keyword is you're modifying. When will you go for modifying? Whenever there is a material misstatement. Whenever there is a material misstatement, you will go for modifications. The scope of this standard is to deal with auditor's responsibility to issue an appropriate report in circumstances when informing an opinion in accordance with SA 700. Because when we were doing 700, we saw that what is the name of the standard? Forming an opinion and reporting on the financial statement. So SA 700 is talking about forming an opinion. So here a reference is given to SA 700 in the scope of SA 705. Because when you are forming an opinion only, you will be finding that a material misstatement exists or not. The auditor concludes that modification to the auditor's opinion is necessary. This essay also deals with how the form and context of the auditor's report is affected when the auditor expresses a modified opinion. The second part of the scope is basically talking about the form and content of the audit report, because here they are going to say what are the terminologies that you will be using. Instead of the opinion heading, you will be writing adverse opinion in the heading itself. And inside, instead of saying gives a true and fair view, what are you going to write? Like that, it gives the form and context. That's why the scope is split into two. The first one is talking about auditor's responsibility with respect to giving an opinion as per SA 700. The second part is talking about the form and context. The second is the objective. The objective of the auditor is to express clearly and appropriately modified opinion, because here we are in SA 705. He has to give an appropriate modified opinion on the financial statements. That is necessary when there are two parts which is given here. The auditor concludes, based on audit evidence obtained, that there is sufficient appropriate audit evidence that the financial statements as a whole are not free from material misstatement. That means material misstatement are there. Not free from material misstatement means there is material misstatements which is present here. So the first part is talking about there is sufficient appropriate audit evidence and there is a material misstatement. The second part is talking about there is no sufficient appropriate audit evidence to conclude that the financial statements as a whole are free from material misstatement. I don't even have any kind of evidence with me for me to even comment on whether there is a misstatement present or not. So these two cases is the objective of the standard. Types of modified opinion. How many types are there? 3 types of them. What are they? Qualified, adverse and disclaimer of opinion. What is this qualified opinion? That there is sufficient appropriate audit evidence, that there is a material misstatement, but it is not pervasive in nature. What is the meaning of pervasive? Pervasive means it is affecting all the other items in the financial statements. For example, going concern is getting affected and they have prepared the financial statements as per cash basis of accounting. Now with this information, can you tell me, is it affecting just one item in the financial statements or is it affecting all the items in the financial? Sorry, they have not prepared as per cash basis, they have prepared as per accrual basis of accounting. So that means there is a misstatement which is affecting all the items in the financial statements. That is why it is pervasive. Pervasive means paravaradu. It is affecting all the items in financial statements. Quickly, let's see the definition of pervasive. It is a term used in the context of misstatement to describe the effects on the financial statements of the misstatements, or the possible effects on the financial statements of misstatements, if there is any, that are undetected due to an inability to obtain sufficient appropriate audit evidence. In case if you don't have sufficient appropriate audit evidence also, it is undetected and there is a possible effect of this material misstatement being pervasive. So not only that there is sufficient appropriate audit evidence, you will say that it is pervasive. Even if there is no sufficient appropriate audit evidence, there is a possible effect on the financial statements of the misstatements for it to be pervasive. Pervasive effects on the financial statements are those that in the auditor's judgment are not confined to specific elements, specific account or specific item of the financial statement. They are not confined only to one area, but it is spreading to all the items in the financial statements. If so confined, represent or could represent a substantial proportion of the financial statements. For example, for a trading business, if closing stock is getting affected, then that becomes a substantial part of the business, and from closing stock the gross profit gets affected, from gross profit net profit gets affected, this net profit is getting carried forward to the balance sheet, so balance sheet is getting affected. So there is a pervasiveness of the effect of the closing stock, and in our case it is a trading business, so stock is extremely important, so it is material. If it is confined to one item, represents or could represent a substantial proportion of the financial statements, or in relation to disclosures are fundamental to users' understanding of the financial statements. Even if disclosure is not there, I can say that it is pervasive if it is fundamental to the users' understanding of financial statements. You understood what is the meaning of pervasiveness? Yes, qualified opinion. The auditor shall express a qualified opinion when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements which are individually or in aggregate are material but not pervasive to the financial statements. That is the thing which we saw here. The second one will come a little later. Adverse opinion. The auditor shall express adverse opinion having obtained sufficient appropriate audit evidence, concludes that misstatements are there which is both material and pervasive. If it is ticker, then you will call that as adverse opinion. Disclaimer of opinion. Unable to obtain the sufficient appropriate audit evidence, the auditor concludes that the possible effects on the financial statements of undetected misstatements could be both material and pervasive. If there is no sufficient appropriate audit evidence, you will say that if it is pervasive, I will go for disclaimer of opinion. Adverse opinion. There is sufficient appropriate audit evidence that there is a material misstatement and also pervasive in nature. Qualified opinion. There is sufficient appropriate audit evidence, there is a material misstatement, but it is not pervasive in nature. Now coming to the second part. The auditor is unable to obtain the sufficient appropriate audit evidence on which to base the opinion, but the auditor concludes that the possible effects of the undetected misstatements could be material but not pervasive. So whenever it is not pervasive, it will always be a qualified opinion. See this table which is given here. Whenever it is no for pervasive, it is a qualified opinion, and whenever there is no sufficient appropriate audit evidence, it is either a qualified opinion or a disclaimer of opinion based on pervasiveness. Is that clear? If sufficient appropriate audit evidence is not there, it will be a qualified or disclaimer of opinion based on the pervasiveness. If it is ticker, that is, there is sufficient appropriate audit evidence that there is a material misstatement and it is also pervasive, then you will be giving a adverse opinion. Is that clear? Now, which type of opinion is appropriate? The decision regarding which type of modified opinion is appropriate depends on the nature of the matter giving rise to the modification, that is whether financial statements are materially misstated, the auditor's judgment about the pervasiveness. See, closing stock, always can I say it is pervasive? For a service business, is closing stock pervasive? No, first of all, it might not even be material in the first place. So there is a lot of auditor's judgment also which happens with regard to the pervasiveness. So which type of opinion, how are you going to find whether I have to give an unmodified or a qualified or a disclaimer of opinion? How you will be finding is by your judgment and also the nature of the matter. These two things are going to tell you what kind of opinion you are going to give. The next one is inability to obtain the sufficient appropriate audit evidence due to a management imposed limitation after the auditor has accepted the engagement. That means what are they saying? As an auditor, I have accepted the engagement, but now the management is imposing a limitation. In that case, what should the auditor do? You will first request the management to remove the limitation. If the management removes the limitation, then do we have any problem? No, we will proceed with the audit procedures. If the management says, hey, get out, I can't remove the limitation and all. If they refuse to remove the limitation, then communicate with TCWG and try to perform that alternative audit procedures. In that alternative audit procedures, also you are not able to obtain any kind of sufficient appropriate audit evidence, then see possible effects, whether they are material but not pervasive. If they are material but not pervasive, nale, it is always a qualified opinion. If it is pervasive, possible effects are material and it is pervasive, you will be giving a disclaimer of opinion. But before giving a disclaimer of opinion, you see whether you are able to withdraw from the audit engagement. Is that clear? If the auditor withdraws from the audit engagement, before withdrawing, the auditor will communicate to TCWG, because here most of the cases the management is the problem. Just because you have management problem, if you go and complain to the TCWG, he will say, yes, he is a talavali for me also. I will push him outside of the organization. I will recruit a new manager who will be supportive for you. Like that, if they say, do we have any problem? No, we don't have a problem if they say that way. So, when we tell the management to remove the limitation, if they remove, we'll go and do our audit procedure. If they don't remove, then we will first itself go and communicate with those charged with governance, because pavam, they are not involved in day-to-day affairs of the company, so they are required to know whatever is happening here. So communicate with TCWG and try to do the alternate audit procedures. If you are able to find any alternate audit procedures there, if you are able to find any evidence, then you can proceed with that. But here you are finding that there is a misstatement, but it is not pervasive. If it is not pervasive, we'll go for qualified opinion. If you feel that it is pervasive, then you will be saying that you will be giving a disclaimer of opinion. But before that, you will check whether you are able to withdraw from the audit engagement. In case you choose to withdraw, again, you have to communicate with those charged. If the auditor withdraws, before withdrawing, the auditor should communicate to those charged with governance. Every time they say you have to communicate to those charged with governance, means you are giving another chance. Before going and using your weapon, they are giving another chance and telling them, this is the reason why I have to withdraw. Are you able to rectify the problem? If they are able to rectify, I don't have any problem. But communication to TCWG is our duty here. Form and content of auditor's report when the audit report is modified. First of all, in qualified opinion, we saw in unmodified opinion in essay 700, what was the form and context of auditor's report? Last row, what was the form and context of auditor's report? In unmodified opinion, we saw two ways you can have the form and context. Yes or no? What are the two ways? Last row, girls and boys. What are the two ways? Form and context of audit report. That means, how are you going to write the audit report if there is an unmodified opinion? You will be saying true and fair view, or you can also say it presents fairly. Yes or no? We saw that. What should not be there? Subject to, or with the foregoing explanation, these two words should not be there. We saw the form and context for unmodified opinion. Now we are going to see for modified opinion. If it is a qualified opinion, when the auditor expresses a qualified opinion due to material misstatement in the financial statements, the auditor shall state that in the auditor's opinion, except for the effects of the matters described in the basis for qualified opinion section, when reporting in accordance with fair presentation framework, their financial statements present fairly in all material respects in accordance with applicable financial reporting framework, or when reporting in accordance with compliance framework, the accompanying financial statements have been prepared in all material respects in accordance with the framework. When modification arises from an inability to obtain sufficient appropriate audit evidence, the auditor shall use the corresponding phrase except for the possible effects of the matters. So after they say yes, it presents a true and fair view of the accounts, then they are going to add something like except for the possible effects of the matter. Is that clear? This is for qualified opinion. Next is adverse opinion. Adverse opinion means what? There is a material misstatement and it is also pervasive in nature. So can we say that it is true and fair? No, we will be saying that it does not present fairly, or the accompanying financial statements have not been prepared in accordance with the applicable financial reporting framework. This is the terminology that we will be using for adverse opinion. For disclaimer of opinion, do we have any evidence? We don't have any evidence. When the auditor disclaims an opinion due to inability to obtain the sufficient appropriate audit evidence, he will state that auditor does not express an opinion on the accompanying financial statements. Basically, what am I saying? Disclaim means I am taking my hands off. I did not get any evidence. And according to me, this is pervasive in nature. So, I don't have anything to say because I did not get any evidence. The auditor does not express an opinion. State that because of the significance of the matters described in basis for disclaimer of opinion, the auditor has not been able to obtain sufficient appropriate audit evidence to provide a basis for audit opinion. Amend the statement required by SA 700, which indicates that financial statements have been audited, to state that the auditor was engaged to audit the financial statements. These 3 points you have to keep in mind for disclaimer of opinion. Now going to the basis for opinion. The first thing which you have to notice is that basis for opinion paragraph heading is there, correct? That will have basis for adverse opinion, basis for disclaimer of opinion. The heading will be amended first. Amend the heading basis for opinion required by SA 700 to basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion as appropriate. Within this section, include a description of the matter which is giving rise to the modification. Case 1. Quantitative disclosures. If there is a material misstatement of the financial statements that relates to specific amount, then you have to include that specific amount in the basis for opinion section and you have to quantify that amount. Not practicable to quantify. You are not able to say what is the amount and all. Going concern, how will you say what is the amount? You will not be able to quantify. In that case, you please mention in the basis for opinion paragraph that you are not practicable to quantify. Narrative disclosure. If there is material misstatement which relates to narrative disclosures, then auditor will include that also in the basis for opinion section and explanation of how the disclosures are misstated, because disclosure is supposed to be with regard to contingent liability. They have not put anything with regard to contingent liability, so I have to write it in detail. That contingent liability I found out that was 1 lakh rupees, but they did not show that like that. I have to write it. Non-disclosure. If there is a material misstatement of the financial statement that relates to non-disclosure of information which is required to be disclosed, then auditor will first discuss with TCWG, describe it in the basis for opinion section. Unless prohibited by law or regulation, he will include the omitted disclosures which is provided it is practicable to do so and the auditor has obtained sufficient appropriate audit evidence with regard to the non-disclosure. Inability to obtain sufficient appropriate audit evidence. If I am modifying because I am not able to obtain the sufficient appropriate audit evidence, then give that reason in that basis for opinion paragraph. Disclaims an opinion. When auditor disclaims an opinion, their audit report shall not include the following elements. What and all will not be there if you go for disclaimer of opinion. That is very important. A reference to the section where auditor's responsibility are described. You will not give that reference to this section. A statement about whether audit evidence obtained is sufficient appropriate to provide a basis for audit opinion, because we do not have the evidence in the first place. So you give a statement saying this is not a basis to provide the audit opinion. Unless required by law or regulation, when the auditor disclaims an opinion, the auditor's report shall not include a CAM in accordance with 701. We saw in essay 701 also. Yes, whenever there is a disclaimer of opinion, CAM will not be there. Then what else? Auditor's responsibilities reference will not be there. And that I have obtained the sufficient appropriate audit evidence, like that you will start your paragraph, correct? That sentence that you have obtained will not be there, because the sole purpose of giving the disclaimer of opinion is because you did not get the sufficient appropriate audit evidence. Is that clear? Three things will not be there if you go for disclaimer of opinion. If the auditor has expressed an adverse opinion or disclaimer of opinion, the auditor shall describe in the basis for opinion any reasons for any other matter of which the auditor is aware that would have required a modification. Now, if you are giving a adverse opinion or disclaimer of opinion, any other issue, if it is there also, you can put in the basis for opinion paragraph. Going back to the mind mapping, so that quickly we can put the tick and come back. Did we see the scope? Objective, types of modified opinion, 3 were there. Which type of opinion is appropriate? How will you find that? Based on auditor's judgment and the nature of the transaction. Inability to obtain sufficient appropriate audit evidence. He is not allowing you. Management is imposing a limitation. Then what will you do? You will ask him to remove the limitation. If he removes, no problem, will be doing the audit procedures. If he says, no, I will not remove, then communicate with TCWG. Then see if it is pervasive and see if it is not pervasive. If it is pervasive, you will be giving a disclaimer of opinion. Now, inability, we saw form and content of the audit report. For unmodified, we saw that presents fairly in all material respects, or it gives a true and fair view. If it is qualified opinion, true and fair view, subject to these qualifications. Next, adverse opinion. They do not present fairly in all material aspects, or you will say they do not give a true and fair view of the state of affairs. Disclaimer of opinion, what will you say? Did not obtain the sufficient appropriate audit evidence. Basis for opinion, 8 cases we saw. What they are saying, whatever is there in the basis for opinion, you please quantify. If there is a narrative disclosure, you please give that narrative disclosure. Whatever is the reason, you please show that. If there is any other reason also, no problem, you put it in the basis for opinion paragraph. Auditor's responsibilities when the auditor disclaims communication with TCWG. These two are there, correct? Description of auditor's responsibility for audit of financial statement when the auditor disclaims an opinion on the financial statements. When auditor disclaims a statement that auditor's responsibility should not be there. A statement that, however, because of matters described in basis for disclaimer of opinion section, that should not be there. Statement about auditor's independence and ethical responsibility. These 3 points should not be there whenever he gives a disclaimer of opinion. Already we saw previously, disclaimer of opinion should not be there. Auditor's responsibility reference should not be there. I have obtained the sufficient appropriate audit evidence. That point should not be there. And CAM paragraph should not be there. There is only one case where CAM paragraph can be there, whenever there is a disclaimer of opinion which is given. When law or regulation specifically says that CAM paragraph must be there. In that case, both is possible. Otherwise, it is not possible. Is that clear? Communication with those charged with governance. When the auditor expects to modify the opinion, whenever there is a modification, he will first communicate to TCWG what is the reason, the circumstances that led to the modification, and also the wording of the modification. How are you going to word it? Present fairly with all material respect, subject to, I am going to word it like this, sir. Like that you have to communicate it to those charged with governance. Is that clear, guys? That is essay 705. Going to 706, quickly let's go to the mind mapping. The scope, definition, objectives, EMP, separate section for EMP and some examples, important. Other matter paragraphs, separate section for OMP and communication with TCWG. I hope you guys would have already noticed that the keywords are given in red and whatever example is there is given in grey. Yes, and you would have seen in few places the text is given in dabba. text is given in box. That means in ICA also it was given in box. That means it is very, very important. Usually they will test from box. You can definitely expect one or two questions from box. Attempt on attempt I am seeing this. And for case study based question, they will take the case which is given in the example itself. Like how I told you for 570. There were so many examples which is given, and each of the examples can become a case study in itself. So all examples are important, guys. Now what is the scope of this 706? It is an additional communication apart from all the other things that they are doing with regard to the information either presented or disclosed or other than those presented or disclosed. If you see in the standard again and again, they are going to say the same thing. What is EMP? What is OMP? EMP is something which is already presented in the financial statements, and as an auditor we feel that this has to give more importance. Basically we are shedding light on that matter. Then you will be putting that in EMP. Now auditor feels that this is most important, but it is not presented in the financial statements. In that case, he will be showing that in OMP. That is other than those presented or disclosed in the financial statements, but which are relevant to users' understanding of the audit, the auditor's responsibility in the auditor's report. Definition. What is EMP? EMP is a paragraph included in the auditor's report that refers to a matter appropriately presented and disclosed in the financial statement. Already it is presented and disclosed, but in the auditor's judgment, he feels that it is important, that it is fundamental for the user's understanding of the financial statements. OMP is, this is also a paragraph which is included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statement, that in the auditor's judgment that it is useful for the users of the financial statements. What are the objectives of SA 706? After forming an opinion on the financial statement, he is to draw the user's attention when in the judgment of the auditor it is necessary to do so by way of clear additional communication in the auditor's report. A matter, although appropriately presented or disclosed, that is of such importance for the fundamental to users' understanding, as appropriate any other matter that is relevant to users' understanding. That is the objective of the standard, whether it is already there in the financial statements or it is not there. For example, there was a fire which happened on 28th of March and most of the stock is destroyed. Now this fire which happened and most of the stock is destroyed on 28th of March itself, they have shown it in the books of accounts. So on 31st of March when they prepared the books of accounts, this is perfectly reflecting there. Now as an auditor, he feels that this has to be given more importance because entire stock is being destroyed. I cannot modify my opinion because I will go for modification only when there is a material misstatement. Is there any material misstatement? No, they have showed in the financial statements as per AFRF, whatever they have to show, they have showed. So I cannot modify, but still I want to throw light on this fire. So what will I do? I will go and put it in the emphasis of matter paragraph. For example, this fire happened and stock is destroyed, but they did not give that notes to their financial statements. In that case, I will be going to the other matter paragraph. Emphasis of matter paragraph. The auditor shall include an emphasis of matter paragraph in the auditor's report provided the auditor would not be required to modify the opinion in accordance with SA 705 as a result of the matter. And when SA 701 applies, the matter has not been determined to be a key audit matter. Say for example, the auditor feels that in public interest this has to be shown as key audit matter. Now you decided this has to be a key audit matter. Again, don't come and put it in emphasis of matter paragraph. Same way, you are modifying your opinion because going concern was not followed appropriately. Don't put that same going concern point in the emphasis of matter paragraph. Basically what they are saying is, if you decide that something has to be modified as per SA 705, or if you decide this is a key audit matter as per SA 701, don't bring that same matter in that EMP also. There should be a separate section for EMP. When the auditor includes an emphasis of matter paragraph in the auditor's report, the auditor shall include the paragraph with a separate heading that includes the term emphasis of matter. Include in that paragraph a clear reference to the matter being emphasized, and where relevant disclose all the matters which is relevant to whatever should be there in EMP, and indicate that auditor's opinion is not modified, because here they said if you decide to modify, then don't come to EMP paragraph itself. So in the EMP paragraph, whatever issues that you are explaining, you please say based on this issue I have not given the modification. Is that clear? Some examples of circumstances, only I told you example is given, but it is given in blue. That means it is given in dabba here, means in your ICA also it is given in dabba. So it is very, 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 very important. Examples of circumstances where auditor may consider it necessary to include an emphasis of matter paragraph, and uncertainty relating to future outcome of exceptional litigation. Our Audi example. Future outcome we don't know, material uncertainty is there, they can come to EMP and they can show here. Significant subsequent event that occurs between the date of financial statements and the date of auditor's report. Date of financial statements in our example of SA 560 31st June. Date of audit report in our example of SA 560 21st June, 31st March to 21st June. Between this time, whatever happens in your audit report, you can put it in your emphasis of matter paragraph. Early application of a new accounting standard or a major catastrophe. Catastrophe means your earthquake, tsunami, all of those things. If that has happened, then if it has a significant effect on the financial position of the entity, you can show that as well. Now there are 4 examples which is discussed here. The first one is uncertainty relating to a future outcome. Second is significant subsequent event, but this subsequent event they are only talking in this time frame. What is that? Date of financial statements. 2. Date of audit report. Third is early application of new accounting standard, and fourth is a major catastrophe. The inclusion of EMP in auditor's report does not affect the auditor's opinion, because EMP is not a substitute for SA 705 modification. It is not a substitute for disclosures in the financial statements. It is not a substitute for SA 570. Did we read these points somewhere else? Where did we see it? 701. It is not a substitute for 4 things we saw. CAM is not a substitute for SA disclosures in the financial statements. SA 705 modifications. SA 570 going concern paragraph, or if a separate opinion has to be there, this is not a substitute for that. Same way for EMP also, 3 points they have given. All the 3 are same, only that separate opinion point is not there. 705 disclosure 570. Is that clear? Going to other matter paragraph, the auditor shall include an emphasis of matter paragraph in the auditor's report provided this is not prohibited by law or regulation. When SA 701 applies, the matter has not been determined by key audit matters. So for OMP also what they are saying, if something you have shown as key audit matter, don't again come here to OMP and show the same matter. Here again there is a separate section where with the heading other matters or other appropriate heading you can use. But if the auditor expects to include an EMP or OMP in the auditor's report, then definitely he has to communicate with TCWG. Everywhere we saw communication with TCWG is compulsory. Whether there is a modification, whether you are going to CAM paragraph, CAM and all, compulsory communication to TCWG, because any adverse consequence you cannot show in CAM paragraph. Same way for EMP, OMP also, communication with TCWG. A common point is there. Please make note. In the end here, common point for all 700 series. Unmodified opinion you don't have to communicate. 705, 706, 701. Common point is communication with TCWG. Is that clear? Let's start off with SA 315. SA 315 is identifying and assessing the risk of material misstatement through understanding the entity and its environment. Now, when will this 315 come? The middle of audit or start of audit, end of audit? When will it come? Even before you start the audit, you need to identify and assess the risk of material misstatement. In these places, there is a material misstatement, where there is a possibility of the misstatement. You have to identify and assess. And you also have to understand about the entity and the environment, that is the industry in which it is operating in. Basics before SA 315. Before we enter into the standard, there are a few things that you have to know. What is the meaning of audit risk? What is material misstatement? What is risk of material misstatement? Now, what is audit risk? Audit risk is the risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. Financial statements are materially misstated means financial statements are wrong, and auditor gives a inappropriate audit opinion. That means he says that the financial statements are right. This is called as audit risk. Why not? The financial statements are right and the auditor says that financial statements are wrong. Is this audit risk? This is not an audit risk, but what is the reason for that? The reason is that nobody is going to look at this signature and going to invest the money, give the loan, give their money. They are not going to deal with this company looking at this. But looking at this, they will definitely give the money to the company. So that is the reason as to why this is an audit risk, but this is not an audit risk. So only when the financial statements are materially misstated and the auditor gives an inappropriate audit opinion, it constitutes as a audit risk. The next one is, what is material misstatement? Misstatement means mistake. Material means important. But what is the meaning of this important mistake? The important mistake can be a difference in these four areas. A difference in amount, difference in classification, difference in presentation, or a difference in disclosure. Now, difference between what and what? Between what is reported in the financial statements and what has to be reported as per applicable financial reporting framework. Is that clear? So, misstatement refers to difference between amount, classification, presentation, or disclosure of a reported financial statement item and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with AFRF. Misstatement means the mistake can arise either due to fraud or a error. Now, whether it is fraud or error, who is going to determine? The intention of the management is determined. Yes or no? Whether the intention is there to make the mistake, then it is a fraud. Intention is not there to make the mistake, it is a error. Misstatement can exist at two levels: the overall financial statement level, risk of material misstatement that relate pervasively to the financial statements as a whole and potentially affect many assertions. Risk of material misstatement at assertion is assessed in order to determine the nature, extent, and timing of further audit procedures. So it can be at overall financial statement level or it can be at assertion level. Based on the assertion level, you will be finding the nature, extent, and timing of the further audit procedures to obtain the sufficient appropriate audit evidence. Now, what is this risk of material misstatement? Risk of material misstatement is split into two: inherent risk and control risk. Detection risk split into two. What is it? Sampling risk and non-sampling risk. So basically, audit risk is split into two: risk of material misstatement and detection risk. Again, risk of material misstatement is split into two: inherent risk and control risk. Detection risk is split into two: sampling risk and non-sampling risk. What is the meaning of audit risk? You all know. Yes or no? What is audit risk? The risk that auditor gives an inappropriate audit opinion when the financial statements are materially misstated. Now, the audit risk is split into risk of material misstatement and the detection risk. What is the meaning of risk of material misstatement? The susceptibility of the account balance. Wow, beautiful. He's telling the definition of risk of material misstatement. Now, again, this is split into. Sorry? Oh, he told inherent. Very worst fellow. You told the inherent risk, not risk of material misstatement. Inherent risk and control risk. Now, what is this inherent risk? That is the susceptibility of the assertion about a class of transaction account balance or a disclosure. So susceptibility of assertion about ABCD to the misstatement, whether it can be material either individually or when aggregated with all the other misstatements before consideration of any relevant controls. Control risk is what? The misstatement is occurring in the assertion that could be material either individually or when aggregated with other material misstatement, will not be able to prevent or detect or correct on a timely basis by the entity's internal control. That means the control risk means the internal controls are not operating effectively and efficiently. They are not able to prevent, detect or correct on a timely basis. That means the internal control is not operating effectively. The risk that the internal control will not operating effectively is called as control risk. Inherent risk means what? Susceptibility of assertion about class of transaction, account balance or disclosure to a misstatement that could be material either individually or an aggregate. Basically, if the entire industry fails, then the company who is part of that industry, nobody can save it, it will definitely fail. That is the inherent risk. If ICA determines pass percentage should be only 1% for CA Inter Group 2, if they determine like that, then what will happen? That is an inherent risk. It is no more in the control of you, it is in the control of God only. So that is the inherent risk. Don't worry, 21%. I have added the 2. Detection risk is the risk that procedures performed by the auditor to reduce the audit risk to an acceptable low level will not detect a misstatement. That means what? The auditor is unable to detect a misstatement. If the auditor is unable to detect a misstatement, that is called as detection risk. Why he will not be able to detect the misstatement? Either because of sampling risk or because of non-sampling risk. Sampling risk means that the sample is not representative of the population. If the sample is not representative of the population, can he detect the misstatement which is there in the population? No. Non-sampling risk means he has done the wrong audit procedures. In the case of external confirmation, he has done only inquiry. In the case of re-performance, he has done the inquiry. There is a non-sampling risk there. There also he will not be able to detect the material misstatement, but that is not because that the sample is not representative of the population. That is something else which is there. That is non-sampling risk. Audit risk is a function of risk of material misstatement and detection risk. Audit risk is inherent risk and control risk and detection risk. Basically, all you have to remember is audit risk is risk of material misstatement and detection risk. Risk of material misstatement is inherent risk and control risk. Is that clear? Read these questions, write what is there. Inherent, control, detection. Like that you will be writing. Essay 315. Now only we are entering into the standard, identifying and assessing the risk of material misstatement through understanding the entity and its environment. For every standard, if you see, there will be one mind mapping which is given here. This is a very simple standard. That's why the mind mapping is only risk assessment procedure and internal controls. That's all you will be studying in this entire standard itself. What is this risk assessment procedure? Objective of essay 315. Why do you have this standard in the first place? The first objective is to identify and assess the risk of material misstatement. What is the name of the standard? Identifying and assessing the risk of material misstatement. That is the first objective. To identify and assess the risk of material misstatement at two levels. One is at the financial statement level and the other one is the assertion level. Why are you going to identify and assess the risk of material misstatement? Based on this, you will be doing your audit procedures to provide a basis for designing and performing your further audit procedure. Now, for the purpose of identifying and assessing the risk of material misstatement, auditor will be seeing four things. What are the four things? He will first identify if there is a risk. Then he will assess the identified risk. Then he will relate the identified risk to what can go wrong at the assertion level, and he will consider the likelihood of the misstatement. Say, for example, girlfriend talking to Mama Kuti, boy bestie. Then first you will identify, okay, she is keeping secret code for the WhatsApp. In WhatsApp for chat also she has MK written. That means Mama Kuti. MK is written as the name. But she is not allowing you to enter. So first you identified the risk. Then you assessed the identified risk and then you are seeing whether that Mama Kuti is okay. Now the Chittappa is not there. So if Chittappa only is the Mama Kuti, then you will see whether the Chittappa has the capability. Is he there? No, there is no capability. So you assess the risk and evaluate whether it is going to pervasively affect the financial statements. Now you understood, okay, no use. This Mama Kuti is not no use for us. No need to invest the time. Relate the identified risk as to what can go wrong at the assertion level. Will anything go wrong? No chance of anything going wrong. So you will consider the likelihood of the misstatement. That means how many times the probability of that misstatement, how many times can it happen? Will it occur again? Like that you will see. So 4 points here. Identify the risk, assess the identified risk, relate the identified risk and consider the likelihood of the misstatement. For what are these 4 points given? For purpose of identifying and assessing the risk of material misstatement, auditor shall see, identify the risk, assess the risk, relate the identified risk, and finally he will consider the probability of it occurring again and again. Consider the likelihood of the misstatement. So first objective is to identify and assess the risk of material misstatement. How he will do the identifying and assessing of risk of material misstatement? The auditor shall see these 4 points. Is that clear? That is the objective of SA 315. Now going to risk assessment procedures. Risk assessment procedures means what? They are the audit procedures which is performed to obtain an understanding of the entity and its environment. Yes or no? So these are audit procedures which is performed to understand about the entity and its environment. For that, the risk assessment procedures includes IO. What is this IO? A stands for analytical procedures. I stands for inquiry. I stands for inspection and O stands for observation. Analytical procedures, inspection, inquiry and observation. What is the audit procedures? Overall audit procedures as per SA 500? Error. External confirmation, inspection, inquiry, reperformance, observation, analytical procedures and recalculation. Only risk assessment procedures. What are the audit procedures? IO. Analytical procedures, inspection, inquiry and observation. Now, inquiry of management and others within the entity. To whom and all are you going to inquire? First, you will inquire the internal audit personnel. You will inquire the employees, the in-house legal team, marketing personnel, sales personnel, people who are taking care of the risk management. Inquiry is directed towards information system personnel. So, this inquiry has to be done with all the people who are surrounding the organization. So, who are those people? Internal auditor, employees, in-house legal counsel, marketing personnel, sales personnel, risk management function and information system personnel. So the inquiry has to be done with all of these people. What is analytical procedures? Plausible relationship between financial and non-financial data. Analytical procedure performed as risk assessment procedure may include both financial and non-financial information. Observation and inspection. Now observation means you are going and looking into the process which is done by the management. Inspection means what? Inspection means examining the books and records. You are taking the books and examining. That is the inspection. So what should you inspect? First you take the internal control manual. There will be huge books with thousands of pages. You take those manuals and you inspect those manuals. Documents such as business plan, strategy, records and internal control manual again. Remove this. Reports which is prepared by the management and TCWG such as quarterly management reports, interim financial statements, all of those reports again you will inspect those reports. And finally you will inspect the entity's premises and the plant facilities. You will observe what is happening in the facility. You will observe what is happening in the premise. So for observation and inspection, premise is nothing but the premise means what? That land and building in which it is, that office. Reports which is prepared by management, documents and internal control manual and entities premises. What are all of these? You will observe and inspect all of these things. For what is the question for this observation and inspection? For risk assessment procedure, we said that it is IO. In that I and O is here, observation and inspection. Don't forget the question. Now, how are you going to understand the entity and the environment? It helps the auditor in planning the audit and identifying areas that require the special attention. Now, if you want to understand about the girl, what will you do? If you want to understand about the girl, what will you do? How is she? What? Follow her. Don't be stalker like that. How will you understand about the girl? You will see how she is coming to the class. Who is dropping her? Okay, one boy is every day coming and dropping her. Like that it will be. Then you will tell the friend, hey, already she is booked. Don't look at her. Already some boy is coming and dropping. Now, friend is the worst person at this time. What he will tell, hey, you look at his face. They have same nose. He is a brother. Like that he will tell. So if you want to understand about the entity, you have to see who are the people who are around that person, whether already booked, whether brother is there, how is the brother looking, is he having the big muscles, all of those things you have to see. So to understand the entity, you also have to see where the entity is operating. So for that, you have to see what is the industry of that entity, what is the regulatory framework of that entity, what is that applicable financial reporting framework of that entity. Now when you go for audit, now entity example, when you go for audit, how will you understand about that entity? How will you understand? You will ask questions to the management. What kind of questions will you ask to the management? What business are you in? What is your sales? Is it 4,000 crores? Like that, first you will ask the questions. You will understand the nature of the entity. Then you will see how is the financial performance. Last year, how was it? This year, how was it? All of those things will help you to understand the entity and also the environment. Understanding the environment is as equal as understanding the entity. Now, relevant industry, regulatory framework and other external factors including applicable financial reporting framework. How is the nature of the entity? You will have to know. Entity selection and application of accounting policy including the reasons for the changes. Entities objectives and strategies and those related business risk that may result in risk of material misstatement. The measurement and review of entities financial performance. You will have to see these 5 points to understand the entity and environment. What are those 5 points? The first one is you will understand the relevant industry, regulatory and applicable financial reporting framework. Second, you will understand about the nature of the entity. Third, you will understand the accounting policy and if there is any changes, what is the reason for the changes in the accounting policy. Fourth, if there is any business risk, every business will have a risk. A petrol business, what is the risk? Evaporation is a huge risk. Groceries business, what is the risk? It is perishable. It will go off. Algi poirum. Therapy business, what is the risk? Poaching. They will take the client and they will go away. So for every business, there is a risk. So when we understand about the entity and the environment, we also have to understand about the business risk that they are having. Apart from that, what else should you see? Their financial performance. What was your sale last year? What was your sale this year? Is there an increase? What is the reason for the increase? Is there a new product line which is developed? Like that, these questions must automatically, you should ask the management even before you start the audit because this only will help you to understand the entity and its environment. There are 5 points which is given here. All of you please tell me what are the 5 points. Relevant industry, regulatory and other external factors including applicable financial reporting framework. Second, nature of the entity. Third, accounting policies including reasons for the changes. Fourth, entities objectives and the business risk. And last one, measurement of the financial performance. Now the first one we saw that relevant industry, regulatory and other external factor. Industry factors include industry conditions such as whether it is a competitive environment, whether they are only a single player in the market, supplier and customer relationship, how are the technological developments, medicine industry, so much of technology developments are there. Have you adopted to the technological changes? Like that we should be able to ask the questions to the management. Relevant regulatory factors include the regulatory environment. Regulatory environment includes the AFRF and legal and political environment. Nature of the entity. How will you know about the nature of the entity? You have to ask its operations. It's the cash flow statement. I told you you can remember this based on the cash flow statement. So, operating activity, investing activity, and financing activity. Ownership and governance structure. This is an addition that you have to remember. Its operations, the types of investments that entity is making, the way that the entity is structured, and how it is financed. So basically, for the nature of the entity, you have to remember the cash flow statement, operating activity, investing activities, and financing activity. Example of matters that auditor may consider while obtaining an understanding of the nature of entity includes, again the same things will flow here: business operations, investment and investment activity, financing and financing activities, financial reporting such as accounting principle and revenue recognition practices. Again the same cash flow statement. This is basically for nature of the entity. Don't forget the question. You will remember cash flow statement. You will remember operating activity, investment activity, financing activity, but you will not remember for what you studied this. The nature of the entity. Where is that nature of the entity flowing from? Understanding the entity and its environment, we saw 5 points. The first one was relevant industry, regulatory and applicable financial reporting framework. The second one is the nature of the entity. Under nature of the entity, how you will remember the points is cash flow statements. The entity selection and application of accounting policy, including the reasons for the change, whether it is consistently followed from the previous year. If it is not, what is the reason? Why is there a change? Entities' objectives and strategies and those related to business risk. Examples: industry development, new product and services, expansion of the business. These three are examples for any business risk that may result in risk of material misstatement. Measurement and review of entities' financial performance. For this, key performance indicators, period on period financial performance analysis, budget forecast variance analysis and departmental or other level performance report, and credit rating agency report. How will you remember this? Past, present and future. What is the past? Period on period financial performance analysis, that is the past. What is the future? Budget forecast variance analysis. All of this is for the future. What is the present? Present is the key performance indicator. So present, future, past. Present, past and future. Yes. Apart from this, there is an addition: credit rating agency reports. This is for what? How are you going to measure the financial performance? And this is for what? Which question? Understanding the entity and its environment. Don't forget that understanding the entity and its environment, there are 5 points which is given. The first one is relevant industry, regulating and other external factors, including applicable financial reporting framework. Second, nature of the entity. What will you remember? Cash flow statement. Third, entity selection and application of accounting policy, including the reasons for the changes. Fourth is business risk. For the business risk, industry development, new product or service, or expansion of the existing product or service. And fifth one is measurement of the financial performance. For that, how you will remember? Past, present and future. Is that clear? Yes. Understanding the entity. It is a continuous process. The understanding establishes a frame of reference within which the auditor plans the audit and exercises professional judgment throughout the audit. For example, there are multiple standards which you will remember here. Assessing the risk of material misstatement. What is standard? Determining the materiality essay. Considering the appropriateness of the selection and application of accounting policy. What is the standard? Essay 510, we saw accounting policy has been consistently followed. Identifying areas and where special audit consideration may be necessary. For example, related party transaction. 550, the appropriateness of management's use of going concern assumption. or considering the business purpose of transaction, developing expectation for use when to perform the analytical procedures 520, evaluating when they have to get a written representation, that is essay 580. So how you will remember this? Understanding the entity, it is a continuous process. The understanding establishes a frame of reference within which auditor plans the audit and exercises professional judgment throughout the audit. They can ask this as question and say give examples. Is that clear? Don't only read like this is the heading. I will read like this only. This sentence is there, correct? This sentence can be a question. The understanding establishes a frame of reference within which auditor plans the audit and exercises the professional judgment throughout the audit. Give examples. Then the answer has to be, for example, when assessing the risk of material misstatement to the financial statements, determining the materiality in accordance with SA 320, appropriateness of selection application of accounting policy, identifying areas of special audit, for example, related party, going concern, all those things you will have to write. Performing the analytical procedures, written representation where he has to get. All these points you will be expected to write with just this given as the question. Is that clear? Yes? Now after this, there is only internal control. Again, quickly let us revise what we saw till here. What is audit risk? Risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. Multiple times we have said this again and again and again. Next time when I ask audit risk, it should not come from here. It should come from here. Like how you will sing a song. Are you thinking and singing? Automatically you will be singing to the tune. Same way when I ask audit risk, how it should come? Risk that auditor gives an inappropriate audit opinion when the financial statements are materially misstated. That's it. Simple as that. What is material misstatement? Difference between amount classification, presentation or disclosure of a reported financial statement item and the difference between amount classification, presentation, disclosure as per the item, which should be as per applicable financial reporting framework. Simple as that. Then misstatements can be either due to fraud or error and can be at two levels. One is at the financial statement level and the other one is the assertion level. What are the components of risk of material misstatement? Inherent risk and control risk. What is the meaning of control risk? That the internal controls are not operating effectively and efficiently. That is the meaning of control risk. Yes or no? What is the inherent risk? It is a susceptibility of assertion about a class of transaction, account balance or disclosure to that material misstatement, whether it could be material either individually or in aggregate. Next, what is the detection risk? Detection risk. A risk that the procedures performed by the auditor to reduce the audit risk that exists could be material either individually or in aggregate. There are two types of detection risk. What are they? Sampling risk and non-sampling risk. What is a sampling risk? Risk that the sample is not representative of the population is called as sampling risk. What is non-sampling risk? Inappropriate audit procedures, or he is not able to evaluate the results of the audit procedure, erroneous conclusions, all of those things are non-sampling risk. SA 315, identifying and assessing the risk of material misstatement. Here very simple, we only saw the objective of SA 315. What is the meaning of risk assessment procedure? What are the audit procedures as part of the risk assessment procedures, and how will you see the entity and its environment? And finally, few examples we saw. That's all we saw under risk assessment procedure. What is the objective of SA 315? The first one is to identify and assess the risk of material misstatement at two levels: financial statement level and the assertion level. For identifying and assessing the risk of material misstatement, the auditor shall see three things: identify the risk, assess the risk, relate the identified risk, and consider the likelihood of it occurring. Risk assessment procedure. What are the audit procedures? IO are the audit procedures. Analytical procedures: inspection, inquiry and observation. What is that? Inquiry. With whom will you do the inquiry? Inquiry with the internal audit personnel, inquiry with the employees, inquiry with the in-house legal counsel, inquiry with marketing or sales personnel, inquiry with risk management function, inquiry with the information systems personnel. Now today when you go back home, you will be studying the SA 315. You will revise it today itself. Don't do it from your summary notes. Don't do the revision from summary notes today, because here internal audit personnel, what you will inquire? You have to read the entire sentence. With the employees, what you will inquire? You have to read the entire sentence. Today, after going home, you read the concept book once. Only then you will know what you have to inquire. For now, you're understanding the concepts. You're putting the keywords into your head. You need to know how to frame the sentence from that keyword. For that, today itself, you go back home and you read the entire sentence just to understand as to what is given there. Analytical procedures. Plausible relationship between financial and non-financial data. What is this? Observation and inspection. What should you observe and inspect? Internal control, manual, documents and records, reports which are prepared by the management and TCWG or entities, premises and plant facilities. Understanding the entity and environment. How will the auditor understand the entity and environment? He has to see the relevant industry, regulatory and other external factors. Second, nature of its entity. Third, accounting policies including the reason for change. Fourth, entities, objectives and the business risk. And the last one, financial performance. Is that clear? Now you know what you have to write inside the each of the ones. Nature of entity, entity selection, application of accounting policy, under business risk what are the example, and financial performance how you will remember. Yes, take 5 minutes for, oh, this one is still there. Understanding the entity, a continuous process. You just have to remember the standards. Assessing the risk of material misstatement of the financial statements as per SA 315. Materiality as per SA 320. Appropriateness and selection of the application of accounting policy as per SA 510. Identifying areas of special audit, for example, related parties as per SA 550. Appropriateness of going concern as per SA, or considering the business purpose of the transactions. Developing expectations for performing the analytical procedures as per SA 520. Evaluating SAI for management's oral and written representation as per SA 580. So now 5 minutes, just read through the concept book. Don't see the summary notes. Read through the concept book and see if you are able to recollect all the points before we go to internal control. Let's start off with the internal control. Now we have mind mapping for internal control. Under this we will be seeing the definition, objectives, benefits, limitation, study of various aspects, and finally we'll go to evaluation, testing and special audit consideration. For now you can leave out this part. Only these first 5 we will focus on that, and then we will move to 6, 7, 8. First one is definition, objective, benefits, limitation and study of various aspects. What is the definition of internal control? First of all, you tell me what is the meaning of internal control. Meaning of internal control is, these are rules which is framed by the management and it is framed for the management. Basically for them, they are having their own rules. Say for example, PVR, there is one person standing outside. What is his job? His job is to allow the people inside only if they have the valid ticket. Same way for Swiggy. What are the internal controls? People who are getting the refund, whether they are really eligible for getting the refund, like that, they will have an internal control system which is framed by the Swiggy, by PVR, by the management, and it is for their own benefit. Now, what is the definition of internal control? It is a process which is designed, which is implemented and which is maintained by the management, TCWG or any other personnel to provide reasonable assurance about the achievement of entities' objectives. Now the first thing you have to remember is, this is providing the reasonable assurance. Usually as an auditor we will obtain the reasonable assurance, but this internal control is by management. So for management, you have to think in the shoes of management. The management is providing the reasonable assurance about achievement of entities' objectives. What is the entities' objectives that they are going to achieve? That is reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with applicable laws and regulations. Now, what is the meaning of each of these terminologies? Reliability of financial reporting means what? There is an internal control for the accounting process. If that internal control is operating properly, the auditor will be sure that he can rely on that financial reporting. Financial reporting is nothing but your accounting only. Effectiveness and efficiency of operations. There is internal control for access card, entry and exit. If you see that it is good, that the internal control is operating effectively and efficiently, then we can be sure that the operations are done effectively and efficiently. Safeguarding of asset. I have an internal control saying you can't remove this camera from here. If you remove the camera and go out, down itself Tata is there. He will ask the question, hey, where you are taking the camera? Like that I have the internal control. So this internal control is for the safeguarding of the asset. What is this? Laws and regulation? There are multiple laws, multiple regulations the organization has to follow. For them to follow that, they will have the rules and procedures in the organization. So to achieve the entity's objectives with regard to these four things: reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, and compliance with applicable laws and regulations. What are the objectives of internal control? Here we saw first one is the definition of internal control. The second one is the objective of internal control. What is the objective of internal control? For internal control, there will be general or specific order, special order. What is this general or special order? Say for example, there is petty cash. The organization is framing an internal control saying less than 10,000 rupees, you don't need anybody's approval. That means the general order has been passed there. After 10,000 rupees until 50,000 rupees, you please get the management approval. After 50,000 rupees till 1 lakh rupees, you please get the senior management approval. Post 1 lakh rupees, you get the CFO's approval. Like that, I'm having levels of approval where special order can be given by these three people and general order can be given by the petty cashier itself. So that is the objective of internal control. Transactions are executed in accordance with management's general or specific authorization. All the transactions are recorded at the proper amount, proper account and the proper period. Correct amount, correct account and the correct period. Assets are safeguarded from unauthorized access, use or disposition. Unauthorized access, unauthorized use or unauthorized disposition. The recorded assets are compared with the existing assets at reasonable intervals. That means physical verification of assets happens. So about assets, 2 points are there. First one is general or specific authorization. Second is it has to be recorded at the correct amount, in the correct account, in the correct period. So if all four are satisfied, then you can say that the objectives of internal control is satisfied. Is that clear? Objectives of internal control, 4 points are there. Actually only 3 points are there. The first one is general or specific order. Second is correct amount, correct account and correct period. Third is with regard to assets, safeguarding of assets and physical verification of assets. What is the definition of internal control? It is a process which is designed, implemented and maintained by management, TCWG or any other personnel for achievement of the entity's objectives. What are the entity's objectives? 4 objectives are there. Reliability of financial reporting. What is it? Effectiveness and efficiency of the operations. Safeguarding of the assets. And compliance with laws and regulations. What are the objectives of internal control? General or specific authorization. Correct amount, correct account, correct period. Assets are properly safeguarded and assets are physically verified. This is the objective of internal control. What are the benefits of understanding of internal control? Why should you understand the internal control? Now we already saw that if internal control is operating effectively, the auditor is satisfied that the misstatements here will be less or not. Yes, the auditor is satisfied that misstatements from this area is less. For reliability of financial reporting, they are having the internal control. I saw that the internal control was operating perfectly fine. So I can rely on the data which is given by the company. So the benefit of understanding is identifying the type of potential misstatement, identifying the factors that affects the risk of material misstatement. Now I know that okay, internal control is not operating properly, there is a risk of material misstatement which can happen here. Based on this, I will focus all my energies to that. I will do my further audit procedures to those areas, designing the nature, extent and timing of the further audit procedures. So the benefits of understanding of internal control is identifying the type of potential misstatement, identifying factors that affect the risk of material misstatement, and based on this I'm going to design the nature, extent and timing of the further audit procedure. This is what question? Benefits of understanding of internal control. Whenever there is benefits, whenever there are advantages, there will definitely be disadvantages also. That is the limitations of internal control. Internal control can provide only a reasonable assurance. In the definition itself we saw it provides a reasonable assurance. It is not a 100% assurance. It is not a guarantee from the management. It gives only a reasonable assurance. Human people are involved. That means if human judgment is involved, human error is also possible. That is the limitation. Lack of understanding the purpose in PVR. Internal control is there. That person there is standing, but does he understand why he is doing that? No. According to him, he should stand and he should see the people who are entering. He should see the phone, okay, enter. See the phone, okay, enter. If you show some WhatsApp chat also, okay, enter. You show some Instagram read also, okay, enter. He doesn't understand as to why he is standing there. So that is a limitation, lack of understanding the purpose. There can be collusion among the people. There can be fights among the people saying, you said petty cash, okay ma'am, till 10,000 rupees no one will do. 10,000 to 50,000 the next person has to do. Like that they have the levels. Now if it is 12,000 rupees, what they will do? They will just give it without any approval because it is just little more than 10,000 rupees. So there is some kind of misunderstanding, collusion which can happen between the people. Judgment by the management. Now this internal control is framed by the management for the management. So there is judgment which is made by the management to understand, okay, fixed asset is an important area. I need to make sure that this fixed asset is not disposed without my approval. Like that they are making the judgment that this is important. So that itself becomes a limitation. Limitation in case of small entity. There is only owner and one more person who is working under him. Between these two people, can I say petty cash less than 10,000, no approval, 10,000 to 50,000, you approve, 50,000 to 1 lakh, you approve. Irukkarade only two people. How can they have those bifurcation and levels? So, in small entities, internal controls are difficult to be implemented. These are the limitations of internal control. It can provide only a reasonable assurance. There is human judgment which is involved in decision making, lack of understanding the purpose, collusion among people, judgment by the management, and limitation in case of small entities. Again, all of you, what are the benefits to understand the internal control? Identifying the type of potential misstatement, identifying the factors that affect the risk of material misstatement. Based on this, he will be designing the nature, extent and timing of further audit procedures. What are the limitations? Internal control can provide only a reasonable assurance. Is there human judgment in decision making? Third, lack of understanding the purpose of the internal control. Collusion among the people can be there. Judgment by the management. And finally, internal controls cannot be implemented for small entities. Study of various aspects of internal control. Now in the mind mapping, we finished the definition, we did the objectives, we saw the benefits and we saw the limitations. Now we are going to study of various aspects. Under that we have 4 points: general nature and characteristics of internal control, controls which are actually relevant to the audit, because there will be thousands or even lakhs of control. As an auditor we need to know what is relevant for us. extent of understanding the control, how deep I have to go to understand the control, and the components of internal control. For components of internal control, again it is split into control activity, risk assessment procedure, information system, monitoring activity, and control environment. How will you remember this? Crime. C stands for control activity, R stands for risk assessment procedure, I stands for information system, M stands for monitoring activities, and E stands for control environment. Now before going to that, let us first finish off general nature and characteristics of internal control. Under that we will be seeing the purpose of the internal control. Why do we require the internal control? Reliability of entities' financial reporting, effectiveness and efficiency of operation, compliance with applicable laws and regulation, safeguarding of asset. New 4 points. Are you reading here? Where did you already see these 4 points? In the definition, you saw for achievement of the objectives, to provide the reasonable assurance for the achievement of entities' objectives with regard to these 4 objectives. So the purpose of this internal control is the objectives in itself. These 4 you have already seen as objectives as part of the definition. What are the 4? Reliability of the financial reporting, effectiveness and efficiency of operations, compliance with applicable laws and regulations, and safeguarding of the assets. Going to the second one. Existence of a satisfactory control environment is not an absolute deterrent to fraud. Just because your internal controls are operating effectively and efficiently, can I say that fraud will never happen in the entity? You cannot say that, because it's only giving a reasonable assurance. It is not an absolute deterrent to fraud. The existence of satisfactory control environment can be a positive factor when auditor assesses the risk of material misstatement. However, it helps to reduce the risk of fraud. It reduces the risk of fraud, but it does not become zero. Conversely, deficiency in control environment may determine the effectiveness of controls, in particular in relation to the fraud. The control environment in itself does not prevent or detect and correct a material misstatement, however, influence the auditor's evaluation of the effectiveness of other controls. The control environment means what? The control environment means the culture in which the organization is taking. Yes or no? Whether they have a conservative culture, whether they have a conjuice culture, whether they are spending eloquently, like that you will have to see. Are all controls relevant to the audit? Are all the controls relevant to the audit? No, only a few controls which are relevant to the audit. The factors which you have to consider to see whether a control is relevant to the audit is SLM, NCC, DRS. What are these factors? What is the size of the entity? If it is a small entity, you don't have to test all the controls. Little bit of the controls you can test. L stands for legal and regulatory requirements. There are a lot of legal issues already happening. Then in that case, we have to test all of them. Legal and regulatory issues. M, materiality. What is NCC? Nature of the business. C is component of internal control. Another C is complexity of the system. What is DRS? Diversity and complexity of the operation. R is related risk, and S is any specific control which is there to prevent, detect, or correct. Now this SLM, NCC, DRS is going to tell you whether all the controls are relevant for the audit. The answer is a simple no. All the controls cannot be relevant for audit. As an auditor, how we are going to determine if a control is relevant for my audit is based on the materiality, is based on the nature of the entity, is based on what is the complexity of the transaction which has happened. I will be considering all these 9 factors for me to take a decision whether this control is relevant for my audit or not. Only if it is relevant for audit, I will pick that and do my audit procedures. Otherwise, I will not even consider that internal control. I already told you there will be thousands or even lakhs of internal controls which is part of the organization. As an auditor, it is not possible for us to test each and every internal control which is there. So already we will be doing sampling basis only. When we are doing sampling, can we project it to the entire population as a whole? No. whenever you do the internal control sampling, you cannot project it to the entire population as a whole, but still you will be doing it on sampling basis, and you will be finding out which internal control is actually relevant for your audit. How you will find out which internal control is relevant for your audit? By way of SLM-NCC DRS. Is that clear? What is that SLM-NCC DRS? Size of the entity, legal and regulatory requirements. M is materiality. N is nature of the entity's business. C is complexity. Another C is component of internal control. D is diversity and complexity. R is related risk, and S is any specific control which is there for preventing, detecting or correcting a material misstatement. Is that clear? You understood why this SLM-NCC DRS is there? Because it is not possible for the auditor to see each and every internal control which is there. So he has to consider these factors to determine those internal controls that he has to test. That is, he has to do the audit procedures on those internal controls. Nature and extent of understanding of the internal control. How will you understand the internal control? If there is an internal control, whether it is capable to prevent, detect and correct a material misstatement. What is the capability of the design of that internal control to prevent, detect and correct the material misstatement? You will be seeing the design, and second you will be seeing whether it is capable to prevent, detect or correct the material misstatement. The second, they are talking about risk assessment procedures, and the last point is understanding the internal control is not sufficient to test the operating effectiveness of the control. Now in this risk assessment procedures, what will you remember? IIoT. First you saw error, second for risk assessment procedure you saw IO, now you are feeling like IIO. So IIO, add one T to it. You drink one tea, you will not feel like that. So IIoT. What is this IIoT? Inspection, inquiry and observation, and lastly tracing the transactions through the information system. What is this tracing the transactions through the information system? It is audit trail. Now we are under nature and the extent of understanding the internal control. Under that only 3 points are there for nature and extent of understanding of the internal control. The first one is evaluating the design of the control, considering the control is capable of effectively preventing or detecting or correcting. The second is risk assessment procedure, and third is understanding the internal control is not the sufficient way to test the operating effectiveness. Under risk assessment control you have IIoT, inspection, inquiry, observation and tracing the transactions. Controls over the completeness and accuracy of the information. Controls over completeness and accuracy of information produced by the entity may be relevant to the audit if the auditor intends to make use of the information in designing and performing the further audit procedures. Internal control over safeguarding of the assets against unauthorized acquisition, unauthorized use, unauthorized disposition may include controls relating to both financial reporting and operating objectives. The last one is the components of internal control. Components of internal control is crime. What is crime stands for? Control activity, risk assessment procedure, information systems, monitoring activity and control environment. He was telling something to this Abdul Kalam. After I saw in his ear itself, control activity, risk assessment, he started shouting like anything. Now what are the components of internal control? Control activity, risk assessment procedure, information system, monitoring activity and control environment. What is this control activity first of all? Control activity is the policy and the procedure in itself. That means this is the control in itself. What kind of controls that they can have? ISPA. What is that ISPA? I stands for information processing. S stands for segregation of duty. P stands for physical controls. Another P stands for performance review, and A stands for authorization. Control activity means this itself is the internal control. This is the policy. This is the procedure. In what ways they can have the policy and procedure. For the information processing, they can have a policy and procedure, who is going to process the data. Physical control, whether physically are they entering the office on time, exiting the office on time, that is a physical control. They will have the internal control, biometric, show the card and go, like that they will have. Segregation of duties, for petty cash we saw the example, less than 10,000 somebody was responsible, 10,000 50,000 somebody was responsible. Performance review, in every company there will be this performance review. HR will have the performance review, partner will have the performance review, whether are you working appropriately, can I promote you to the next level at adequate times, they will have the performance review. And finally, authorization. This is ISPA. ISPA is for the control activity in itself. The control activity means what? The control activity is that policy and procedure in itself. The control activity are policies and procedures that help ensure management activities are carried out. That is the ISPA. Is that clear? What is R? Risk assessment process. This is a component of internal control, the entity's risk assessment process. How are you going to identify the risk? This also, again, you will remember ISPA. There it was double P, here it is single P. What is this ISPA? Identifying the business risk relevant to financial reporting objectives, estimating the significance of the risk, assessing the likelihood, that is the probability of it happening, and finally deciding about the actions to address those risks. Any risk which is there, first you have to identify the risk, estimate the significance of the risk, assess the probability of it happening again, and finally deciding about the actions to address those risks. This is risk assessment procedure, ISPA. What does I stands for? S stands for, T stands for, A stands for actions. Here you cannot change the order, because first you have to identify, then you have to see the significance, then you have to see the probability of it occurring, and then only you can take the action. If you write action, probability, identify, then it doesn't make any sense. So here the order is very, very important for risk assessment procedure. What is the first ISPA we saw? What is the question for that? Control activity. What is the question for all of this risk assessment, control activity and all? Components of internal control. Under components of internal control, crime la, the first C was control activity. The R was risk assessment procedure. Now going to the I, that is the information systems, including the related business processes relevant to the financial reporting and communication. The auditor shall obtain an understanding of the information system, including the business process relevant to financial reporting. What and all are they going to see for information system? Procedure by which a transaction is initiated, procedure by which it is recorded, how it is processed, if there is any correction as necessary, what is the backup record, are they storing in cloud or are they simply having in books only, how the information system captures the events that are significant, financial reporting process and any controls which is surrounding the journal entry. All these points you will be seeing for information system. M stands for monitoring activities. What is the monitoring of control? Monitoring of control. The auditor shall obtain understanding of major activity that entity uses to monitor the internal control over financial reporting. What is monitoring of control? It is a process to assess the effectiveness of the internal control performance over time. Who will do this monitoring activity? Management only will do the monitoring activity. Auditor will not be doing the monitoring of the activity and all. The management itself will be doing the monitoring activity. It helps in assessing the effectiveness of control on a timely basis. It is an ongoing activity. Management's monitoring activity will include the communication from external parties such as any complaints or any comments which is there. In case of small entities, management's monitoring is often by the owner-manager relationship itself. So under monitoring, the management will be seeing the effectiveness of the internal control. That is the monitoring activities. What is E stands for? Control environment. Control environment means the culture, the ethics which is there. So that is shape PC. What is shape PC? S stands for organizational structure. H is HR policies and practices. A is assignment of authority and responsibility. P is participation by those charged with governance. E is ethics. Another P is philosophy of the management, and C is commitment to competence. Is that clear? That is shape PC. The shape PC is elements of control environment. Control environment means the culture of the organization, the ethics which is there in the organization. Is it clear? All of you, are you in this world or some other world? This world, the components of internal control is crime, control activity, risk assessment procedure, information system, monitoring activities, and control environment. In control activity, what is the mnemonic we saw? ISPA with double P. I stands for information processing, S segregation of duty, P what? Physical control, another P, performance review, and A is authorization. This is what? Control activity. That means this is the policy and procedure. This is the internal control. R stands for what is the mnemonic? ISPA again. What is that ISPA? Identify the risk, significance of that risk, probability of the risk happening, likelihood, and actions to be taken. So these four are for what question? Risk assessment procedure. Risk assessment procedure is where? Under components of internal control. I stands for information systems. Under information system, how they are recording, how it is being processed, who is initiating it, whether they have backup storage, all those generic points are there for information system. M stands for monitoring activities. Under that, what are the points? It is an ongoing process. It has to be done at a timely basis, and monitoring is done by whom? By the management at reasonable intervals, and all those points. E stands for control environment. That means this is the ethics, culture which is there. What are the elements of control environment? Shape PC. What is shape PC? S. Organizational structure. H. HR policies and practices. A. Assignment of authority and responsibility. P. Participation by those charged with governance. E. Ethics. P. Philosophy of the management, and C is commitment to competence. Is that clear? Are you understanding the crime? Yes. Under that crime, what are all the points? ISPA for what? Yes. Can we play a small game? Small game. 5 minutes game. And then we can close the class. 5 minutes now itself. And then we can close the remaining tomorrow. Is that okay? Okay. Now I will ask the question. You should answer. Is that okay? No, I will tell the answer. You should tell the question. Yes, sir. You have to read like that only, because in the case study the answer will be given. You need to know from where they are asking. So I will tell you the answer. You tell me the question. Is that okay? The ulta is only difficult. I ask the question. You have to tell the big answer. Now you please tell me identification of the misstatement, identification of risk of mental misstatement, and designing the nature, extent, and timing of the further audit procedures. Where did we see? Benefits for the auditor, yes or no, for understanding the internal control. Now the next one is SLM NCC DRS. Controls which are relevant for the audit. Very good. Narrative record, checklist. Mike is hungry. I gave the food to the Mike. Done. For you 2 minutes, 2 minutes. Just 5 more questions I will ask, okay? You tell me, judgment by management is what? It is the limitation of internal control. Others, were you able to tell that? Judgment by the management is a limitation of internal control. Collusion between people. Oh, now you all be like, yes, now I know limitation. Okay, safeguarding of assets. Objectives, where else? In the definition of internal control, safeguarding of asset is there. Compliance with applicable laws and regulations. Same thing. Okay. ISPA. Which ISPA? Double P ISPA. Control activity. Single P ISPA. What is that single P ISPA? Identifying the risk, significance of the risk, probability of it happening, and actions to be taken. What is that double P ISPA? Information processing, segregation of duties, performance review, physical controls, and the boys here, they are not telling. So 3 more questions I am going to ask. 2 more. What is this IO? IO is for what? For risk assessment procedure, under what it comes, IO? What audit procedures? Risk assessment procedure is correct. Under what it comes? Risk assessment procedure was the second point in that. Under that only you told IO. What is the question for that second point? Gone. Risk assessment procedure includes what? Oh, IO is risk assessment. Okay, IIoT. For that, nature and extent of understanding the relevant control. Which one is relevant for me? I have to understand. For that only. Shape PC. What is shape PC? Elements of the control environment. What is S? H. A. P. Participation by E. P. C. Commitment to competence. Okay, last one. What is no, I will not ask what is crime. What is the nature and extent of understanding the relevant controls? This is a question. What is the answer? Reasonable assurance. Wrong. That's a one more question. You didn't tell the answer correctly. It is neither effective nor efficient. You tell me nature and extent. Last time I will give you one more chance. Nature and extent of understanding the relevant controls. There are 3 points. Capable for what? Capability for what? For the design of the internal control and whether the internal control is able to prevent, detect and control. No one said that. Second point is what? Risk assessment procedure. Under that, IIoT. What is that IIoT? Inspection, inquiry, observation and tracing the transaction. T is tracing the transaction. Third one, understanding the internal control is not sufficient for the operating effectiveness of the control. Last question, very last question. You tell me past, present, future, where we saw. Under examples of what? Oh, examples of the financial performance. Where did we see that financial? Understanding the entity and its environment. Under that 5 points are there. What are those 5 points? Relevant industry, regulatory and applicable financial reporting framework. Nature of the entity. Accounting policy and reason for any changes. Fourth one, business risk and then only the financial performance. He told the wrong answer. He didn't tell correctly. What is the definition of risk assessment procedure? Risk assessment procedure definition. It is the audit procedure which is performed to obtain an understanding of the entity and its environment for what? To identify and assess the risk of material misstatement at the financial statement level and at the assertion level. All of you okay? Getting some clarity? Internal control is not over. Tomorrow we will be continuing this, but a small part is only pending. Only the evaluation and testing part is pending. Actually, we could have completed today itself. It is very small. Till here it's done. Only the evaluation, methods, testing. That's it. Only this. Hardly 10 minutes we will be completing it tomorrow's class. Is that all right? Okay. Thank you guys. I hope you got clarity.
Congratulations, guys, you have completed your part 1. That means you are half ready with your revision and you are half ready to go and ace your examination. The main reason why I wanted to come in the end note to tell you that SA 315, like how you all thought it is a difficult standard, I hope at this moment you all will change your mind and you will be waiting for the part 2. The part 2 will be in the description link itself, and you can also find it on the playlist at a later stage. Definitely complete the standard, and as much as standards are important, the other chapters are also important. 30 marks from other chapters are there. Don't leave anything. Attempt to finish 100% for your examination and then go and write your exams. I am sure you will ace your exams, guys. I have the confidence, and yes, see you again in part 2.